This is a Yahoo Finance special report. I'm Alexis Christoforous. We are coming on the air early this morning because it is promising to be another volatile day on Wall Street. Investors were fleeing global stock markets overnight amid new fears about the growing coronavirus outbreak. U.S. health officials say they expect a wider spread of the virus and are preparing for a potential pandemic. The virus has killed 2,700 people worldwide and continues to spread outside of China. With less than an hour to go before the opening bell, stock futures have been seesawing all morning long. As you can see there, they are in the green slightly right now. In Asia overnight, we saw more selling. The Nikkei, Hang Seng, and Shanghai indexes all down very close to 1% each. And getting a check of the action in Europe as well, which is still ongoing. We have the FTSE lower along with the CAC 40 and the DAX down more than 0.5%. The FTSE 100 index, by the way, briefly entered correction territory when it dropped over 10% from its recent high. It has since bounced back a bit. The global sell-off, we know, has been rapid and widespread. Here's a look at the damage yesterday. The Dow Jones Industrial Average plunged 879 points, or 3.1%. That's after losing more than 1,000 points on Monday in its worst single-day drop in 2 years. The blue chip index has now shed more than 1,900 points in just 2 days. The S&P 500 sank 3%, or 97 points, while the Nasdaq tumbled 2.8%, a loss there of 255 points. All three major indexes are now negative for the year. Investors are running to the relative safety of U.S. Treasury bonds. The yield on the 10-year Treasury up slightly this morning after falling to an all-time low yesterday of 1.32%. Heidi Chung is in our newsroom this morning. Brian Chung here with me at the desk when we have Jared Blickery over at the Wi-Fi Interactive Board. And Heidi, I'm going to start with you. Is the market still all about the coronavirus? We're seeing a bit of a bump right now in stock futures, but I'd have to imagine that continues to be the backdrop for investors.
That definitely appears to be the case, Alexis. I mean, we've seen futures fluctuate between positive and negative territory all morning, but at least for now, futures are indicating a higher open for all three of the major indices, and that's, of course, following the worst two-day slide for stocks in 4 years. Yesterday, stocks closed lower for the fourth consecutive trading session on mounting concerns over that deadly coronavirus that has been wreaking havoc across the world. The Dow's 879-point drop yesterday brought its two-day losses to nearly 1,900 points, while the S&P 500 wiped out $810 billion in just 1 day and a whopping $2.14 trillion in just a week. Yesterday marked the broader market's first back-to-back 3% decline since August of 2015. Now, as of this morning, there were more than 81,000 confirmed cases of coronavirus worldwide, with roughly 2,770 confirmed deaths. Europe continues to reel from this outbreak, with France reporting its second coronavirus death and Italy reporting its 12th death. Greece also reporting its first coronavirus case, and South Korea is still the worst affected outside of China, with more than 1,200 cases reported and 12 deaths. Yesterday, the CDC called the virus a, quote, serious public health threat, and the agency also noted that the coronavirus is likely to spread to the U.S., and that it is no longer a matter of if, but when. Alexis?
All right, thanks very much for that, Heidi. I want to get to Brian Chung here at the desk. And Brian, I want to dive deeper into the bond market, the yield on the 10-year near a record low. Do you think investors have basically been ignoring these red flashing signs the bond market's been giving us, saying, you know what, trouble's ahead?
Well, there definitely is some inflow into fixed assets, which some might perceive or interpret at least as a flight to safe assets. Again, as you mentioned, the 10-year did hit an all-time low of 1.328%. That was yesterday. It seems like before market open is nudging up just a little bit, but that is pretty far below where it was on Friday before the market sell-off really accelerated at the beginning of this week. At the time on Friday, it was at 150 basis points, so that is quite a decline. But I do want to note that it's been a broad-based increase in buying on treasuries on basically all duration of the curve. So we saw the 2-year, for example, also fall in yield. And when you look at that key 2 to 10-year spread, which everyone interprets as the yield curve inversion, if it is the case that the 10-year ends up falling below the yield on the 2-year, that hasn't happened. And actually, despite the big sell-off that we saw in equity markets on Monday and on Tuesday, the spread between the 2 and the 10-year is actually still about 12 to 13 basis points. So it's not that we're getting any closer to it inverting like we saw from a technical standpoint in August last year, as you recall, when markets markets did have quite a bit of a tizzy in response to the 10-year falling below the 2-year. So also worth watching. The 30-year, for example, is also seeing a increase in attention as well. It broke through 2%. That was actually a few weeks ago, but now it's been plunging to 1.80%. So definitely increased buying on all ends of the spectrum, but again, not necessarily pointing to an inversion as of yet.
Do you take that as a positive sign, the fact that we're nowhere near an inversion?
Well, it depends on, I guess, what you see as positive. It seems like regardless, everyone is buying into treasuries. People want U.S. dollar-denominated assets, especially those types of managers that are abroad, maybe those in South Korea, those in Japan, especially those affected by the coronavirus areas, just trying to hunker down in what would be perceived as safe global assets. But when you talk about the concerns over, let's say, this teetering into a U.S. recession, the U.S. bond market not necessarily signaling that because, again, the 2- and the 10-year spread appears to be holding steady. It appears that when we talk about whether or not people are running to safe haven assets, it's not necessarily as easy as, oh, everyone's flying to gold, because as we saw yesterday, gold didn't have much of a rally despite the sell-off in equities anyway.
Right?
So it's an interesting dynamic. It's not necessarily, oh, people are just running to safe assets.
Perhaps they're being very choosy about which safe assets those are. All right, Brian, thanks a lot. Want to get over to Jared Blickery now at the Wi-Fi Interactive Board. What are you looking at here as we move closer to the open today?
Well, it's a sea of red in Asia as well as Europe, but not the U.S. here. We have futures pointing to a positive open. The big question is it a dead cat bounce? And we can look at a chart of the S&P 500, and this is 3 months, and we can see this huge down day the day before and then yesterday. These kinds of capitulation moves tend to result in price bounces. So that's the good news, is that we could very well bounce from here over the next few days. To what level, we don't know, but we tend to come down and then retest these lows, even exceed them to the downside. So that's basically what we're dealing with. And then we can take a look at the Dow heat map, and a lot of red, that's from yesterday, but we can see in the pre-market, Microsoft is up 0.6%, as is JP Morgan. A little bit of relief from the 10-year T-note yield kind of staying steady, not crashing any further. And then we have Cisco up 0.9%. And just looking at the NASDAQ, we can see all the big cap tech names to the left are largely in the green this morning. So bottom line, we could very well bounce here, but probably going to retest lows in a couple weeks. And there's also the possibility that we go lower today.
Yeah, don't be fooled. Could be a false rally. All right, thanks a lot, Jared. Let's get another check of European markets this Wednesday. We saw they were under pressure earlier, continues to be the case here. Trying to come off, though, their lows of the session. We've got Oscar Williams Grootforus in London with more. What's the mood there? I know the FTSE 100 briefly stepped into correction territory yesterday. What are things looking like now?
Well, Alexis, it's all about volatility this morning here in Europe. Markets open sharply lower, extending the slide we've seen on Monday and Tuesday across Europe before paring back those losses across much of the morning. The FTSE really typifies that. It was down as much as 2% by 9 a.m. after an hour of trading. But now, as we've just seen there, it's around 0.2% lower. Now, I think the big driver of this bounce back across Europe is, well, initially, traders were reacting to this CDC warning overnight and the big fall in US stocks overnight. But since then, what we've seen here in Europe is not the same momentum of news flow around the coronavirus as the day has gone on. Yesterday, we had a flurry of new cases in new countries, places like Switzerland, Spain, Austria. Today, we've had Greece confirm that it has its first case, but beyond that, there's been less of these sort of new cases across the continent, which really created a lot of the panic selling yesterday.
All right, Oscar Williams Group, we're going to leave it there. Thanks so much. Let's bring in Greg Swenson now. He is founding partner at Brigg Macadam. He is in London this morning. Thanks so much for being with us, Greg. Would you characterize what we're seeing in the market right now as fear-based selling, or is it based in some sort of economic reality?
I think it's a lot of fear, and you know, you can see that in the flight to safety, the flight as earlier comments were talking about flight to safety and the rally in treasury yields. So look, I think there's a lot of that. You know, the market doesn't like uncertainty, and nor do business decision makers. So I think that's what the problem is. We don't know if this is going to be a near-term issue with the coronavirus, or this turns into a longer-term problem. But you know, it's impossible to calculate right now what the damage will be. I mean, obviously there is going to be some damage, even in the U.S. Aside from from China, obviously. But But look, I think there's going to be, damage to GDP growth, just looking at the obvious sectors like airlines and cruise ships. But, you have supply chain issues that are already starting to alert business decision makers in the U.S. So, there is going to be some of that selling for fundamental reasons, but it's hard to calculate that right now. So I think right now it's just fear. And as Oscar said, when there's news, when there's bad news coming out of different countries with new cases, that tends to spook the investors, whereas today there seems to be a little bit of a pause in that.
Is there a feeling that the selling has been a little bit irrational? Some sectors that would seemingly be untouched by coronavirus also falling. We saw all 11 sectors in the S&P 500 in the red as well. And is there a feeling that things have been orderly? Has this been an orderly sell-off, or are you feeling some panic seeping in?
Oh, for sure, there's some panic. I don't think you could have a 1,800 point drop, in 2 days without without pointing to some panic selling. And it is across the board. So I think it's just a risk-off trade right now. I think if you can trade it, there's some opportunities. One of which is just buying volatility, obviously. But look, I think there are some sectors that are going to be really cheap here. Notably, energy, which has been the most or the biggest underperformer in this sell-off. So there'll be some opportunities, but I think it's Adult Swim. I don't think I don't think this is going to be over in the next couple of days.
I want to talk about Disney because we got blockbuster news after the close yesterday. The stock is lower right now in the pre-market, coming under pressure after the surprise announcement that longtime CEO Bob Iger is stepping aside immediately to become executive chairman, and his handpicked successor is the Parks and Resort chief, Bob Chapek. And Greg, I know that Iger had said recently he was going to retire at the end of 2021, but even people within Disney are saying that the timing of this was such a surprise to them. Why do you think it was shrouded in so much secrecy?
Yeah, I think it was a pretty interesting move, for Iger to announce that. And I think, remember, he announced and then changed his mind on 4 different occasions. So I think, this was an attempt to really take some uncertainty out of the speculation. And I thought he made some good points in the press conference as well as on the networks that look, this is a way for the new CEO, for Bob Chapek to spend some time with him, to have a year before he takes over completely. He's got a year, to learn other parts of the business. But I think more importantly, it was just a way to take away the speculation. Now, announcing it during this, massive sell-off in the market, that probably wasn't perfect timing. But I think they just wanted to get the news out before there was too much speculation.
There was speculation that perhaps he would tap the head of streaming, Kevin Mayer, to take over that job, given the fact that they now have Disney Plus, that streaming is such an area of growth for Disney going forward. Do you think maybe the market, the reaction we're seeing in the stock is because investors don't love the fact that the head of resorts and parks is going to be heading up the whole kit and caboodle at Disney?
Yeah, you can make that argument that, that the future is digital, right? But the problem is, Kevin Mayer didn't really run a lot of businesses besides the one he's running right now. He's really a strategy person and came up in strategic planning. So he doesn't really have pure executive experience. And remember, Chapek, really knows the consumer. He's run consumer businesses throughout his 27 years at Disney. So, look, he doesn't have the charisma and the personality of Iger. And I think that those are going to be they are, hard shoes to fill. But he's got great experience running consumer businesses, and he's had some really, great records. He had 13% annual growth the last 5 years in his division. So yeah, look, I think there was some disappointment about Mayer, but I don't think he was the right person for the job.
All right, Greg Swenson, thanks so much. I know we're going to see you in our next hour to talk more markets. Appreciate your time.
Thanks.
Coming up, shares of Smile Direct Club are getting hammered here in the pre-market, off more than 23% as investors continue to worry about that company's bottom line. More on that company coming up.
Morning.
What are you doing?
We're delivering live market coverage and offering expert analysis completely free.
That's great, but why are you in my kitchen?
I love what you've done with the place.
Stream free anywhere.
Fears over the coronavirus and its impact on the global economy has wiped out $1.7 trillion in U.S. stock market value in just 2 days. And now members of the Federal Reserve are publicly commenting on the deadly virus. Our Fed expert Brian Chung is back with us for more on this. So Brian, little by little, right, we're hearing from the Fed. Yesterday it was Fed Vice Chair Richard Clarida in Washington, D.C. What is he saying?
Yeah, so Richard Clarida, this is basically his first set of remarks since the market sell-off really began. He did speak on Friday, but not since we saw the Dow fall as much as it did on Monday and Tuesday. And yesterday at a conference in Washington, D.C., he said the disruption from the coronavirus could spill over to the economy. And I want to read you exactly what he said as well. He said, "We are closely monitoring the emergence of the coronavirus, but it is still too soon to even speculate about either the size or persistence of these effects or whether they will lead to a material change in the outlook." And for the Fed, the material change bit is really the most important bit. They've been saying since the Fed went on pause after its 75 basis points of cuts last year that it needed to see some sort of material change in the outlook, not necessarily referring to the coronavirus, but any macro shock before they would want to change on where they are with interest rates right now, at least through 2020. So does the coronavirus really fit that profile? At least Clarida saying yesterday, not yet.
Any talk out there that maybe there could be an emergency Fed meeting? And would that actually maybe inflict even more pain on the market because people would say things must be really bad if the Fed has to hold an emergency meeting?
Yeah, well, we actually had former Minneapolis Fed President Narayana Kokerlakota publishing an op-ed in Bloomberg that was on Monday, where he argued that the Federal Reserve should hold an emergency meeting outside of its schedule. Its next scheduled meeting is actually on March 18, but he's saying they should call it earlier and then maybe enact a 25 basis point cut or as much as a 50 basis point cut right now to hedge the U.S. economic effect of what might be a spillover from the coronavirus. Now, no one inside the Federal Reserve is saying that, and an emergency meeting would be fairly unprecedented, but at large, it seems like markets are expecting heightened increased chance of a Fed rate cut in the Fed's next meeting on March 18. When I was last checking, it was about 26% chance when you're looking at Fed funds futures contracts of a cut in that meeting. And by the April meeting, the markets are pricing in a nearly 50% chance that we'll have at least one 25 basis point cut by then. Whether or not the Fed delivers on that is another thing. When I listened to the Fed speeches from Clarida, there was also Loretta Mester and also Dallas Fed President Robert Kaplan. They had commentary earlier this week. Neither of them really hinted that, at least for right now, they see a case for cutting. They say we want to be patient and see exactly how this is going to impact the U.S. economy before we act.
We haven't heard from Fed Chair Jerome Powell yet on this.
Not yet, so we'll be watching.
All right, thanks a lot, Brian. Well, there's not a lot for investors to smile about when it comes to Smile Direct Club these days. Shares of the controversial teledentistry company are tanking here in the pre-market after the company posted a fourth quarter earnings miss. Let's go inside the C-suite now with Yahoo Finance's Brian Sozzi. And Brian, I know you had a chance to speak with CEO David Katzman about this. What did he have to say?
Well, Alexis, I had a chance late last night, to catch up with CFO Kyle Wells. But David Katzman on the press release said they are looking for EBITDA profitability by the fourth quarter of 2020. But when you drill into this quarter, there was not a good quarter by Smile Direct's own admission. They missed on earnings, had a lot of inefficiencies in their plants. They're freezing U.S. Smile shop openings, and I'm just ticking down the list here. They cut their medium-term revenue guidance outlook to about 20 to 30%. A lot of people on the street that I've talked to were looking for about 45% growth and cash burn. The company burned $180 million in cash in the most recent quarter, and there's some speculation now, pre-market, that they may look to raise cash at some point this year. Now, I talked to Wells late last night, and I asked him, where are these cost cuts going to come from? You could see potential job cuts in the manufacturing plant, and again, I suspect slowing the growth rate on their Smile Direct shops will also save some money.
Brian, that could be a tough raise for them because they are facing a lot of legal challenges right now. Did they talk at all about the legal costs and how that might actually eat away at their cash burn?
I think the legal cost, Alexis, has been part of this Smile Direct story since the company IPO last year. They didn't directly address that, but I did ask Wells about the NBC News investigation that hit a couple weeks ago. I asked him, are you seeing an impact on your business? Now, he told me they're not disclosing the impact, but the optics on the earnings release don't look good. Their revenue outlook for this year was below consensus. So you're trying to put the pieces together. And as an analyst, you're thinking maybe that NBC News report has had some impact. Now, Wells did tell me part of the cost cuts will not include a cutback in the aggressive TV marketing that Smile Direct Club is very much known for.
I guess we'll keep seeing that. Thanks a lot, Brian Sozzi. In other earnings news this morning, both Papa John's and Lowe's are out with their results. Here to break it down for us is Heidi Chung back in our newsroom. Heidi, let's start with Papa John's. I don't know, I guess their turnaround strategy to reinvigorate that brand is starting to pay off.
Yeah, Alexis, it looks like Papa John's business is finally starting to show signs of life here. The company beating on all of the important metrics. Fourth quarter revenue totaling $417.5 million. Consensus expectations were for $403.8 million. Adjusted earnings per share of 37 cents. Consensus was for 32 cents per share. And U.S. same-store sales growth growing 4.1% during the quarter. Analysts were projecting about 2.3% growth. Now, the pizza chain's 2020 adjusted earnings per share guidance was a bit softer than expectations. Papa John's expects 2020 adjusted EPS between $1.35 per share to $1.55 per share. And the midpoint of that guidance range missed expectations of $1.52 per share. Now, CEO Rob Lynch did take the helm back in August, and in November, he announced a massive C-suite overhaul. This company has been in the midst of a big turnaround plan, but judging by the fourth quarter results, it looks like it's finally taking shape, Alexis.
Speaking of turnaround plans, Lowe's Home Improvement going through one of its own with its new CEO, Marvin Ellison, but it looks like results, at least this time around, disappointed?
Yeah, it did, Alexis, and it's actually quite a bit of a different narrative than rival Home Depot, which reported earnings yesterday morning. Looking at the numbers, fourth quarter net sales totaled $16.03 billion during the quarter, missing expectations for $16.15 billion. Adjusted EPS, 94 cents per share, did edge out expectations of 91 cents per share. Comp sales, though, fell short of expectations, growing at 2.5%. Expectations there were for 3.7%. Now, Lowe's did not provide sales for its online business. Instead, CEO Marvin Ellison said that nearly all of its sales growth during the fourth quarter came from its brick and mortar locations, Alexis.
All right, Heidi Chung in the newsroom, thank you. Well, just 18 months after taking the job, Salesforce's co-CEO Keith Block is stepping down, and co-founder Mark Benioff is now the sole CEO. Jared Blickery has been following the story for us. So, Jared, I don't know, is this like a co-CEO experiment that went wrong? What happened here?
I don't know. No, it didn't go wrong because Block has been instrumental in diversifying Salesforce's product line. The revenue has increased fourfold under his tenure since he became co-CEO 18 months ago. But Benioff said on the call yesterday that he supports Block in his next chapter. We just don't know what that's going to be. He might be going off to start his own venture. And I'd also note that there was a purchase of Velocity. So that's an M&A deal that Salesforce is going to do. That's with another closely related company. So I suspect that maybe Block is simply going off to do his own thing, and maybe will rejoin forces at some time. He's going to remain an advisor to Salesforce, and this leaves a little bit of a vacuum there because he was the guy behind the strings really running the day-to-day operations of the business. So he will be missed, but we'll see what happens. Maybe he'll resurface someday.
Any feel that perhaps there may be another co-CEO? Does Benioff want to go this alone? Because I would imagine trying to co-manage a company of that size can be difficult, especially when you're talking about different personalities.
Yes, and Benioff is very charismatic, and he also has political ambitions. So I think the original decision to become a co-CEO with somebody else was to free up his time, and so now this is going to take a lot more of his time. So I wouldn't be surprised if they groom somebody else to put in the position, but that's going to take some time. There's really nobody quite like Block at the company just yet. Might have to go outside.
All right, thanks a lot for the update, Jared Blickery. Starbucks is jumping into the plant-based meat craze. It is adding Beyond Meat to its breakfast menu in Canada. Brian Sozzi is back with those details. Brian, I know you've been waiting for this. What are the details?
Hey, dreams do come true, Alexis. So the details here, finally, the marriage between Starbucks and Beyond Meat is inked. You will see Beyond Meat breakfast sandwiches go into 1,400 stores in Canada. And I think a lot of people on Wall Street have long been waiting for this. Starbucks has not hidden the fact they want to get into plant-based foods. And if you're a Beyond Meat investor, I think this sends a couple signals. One, first and foremost, you get more sales. You're now shipping product to 1,400 Starbucks locations. And number two, it also sends a signal that when Beyond Meat comes out with earnings tomorrow, they could come out with some much better than expected in terms of sales and profit guidance for 2020. The company looks like it's not only continues to ink big deals, but they have the manufacturing capacity to service these deals and potentially bigger ones, likely with McDonald's.
Yeah, we see Beyond Meat up better than 5.5% here in the pre-market. What does this tell you about Starbucks? Are they focusing a little more on food now, or are they sort of pivoting away from beverages?
Well, Starbucks has made a big focus over the past 2 years, pivoting more to drinks. They have added more food, but I would argue the food doesn't taste that good. So this gets them a good sandwich in the door. It looks good. It creates more buzz, gets traffic into the restaurant in the morning. The morning is a very important day part. I will add this too. If you're the team at Dunkin' Brands here, you have worked closely with Beyond Meat. You were the first company to sign Beyond Meat for a breakfast sandwich last year. Now you have two very competing products in the market. So there's an all-out plant-based breakfast sandwich war right now. Dunkin' versus Starbucks, and it's going to be a big year for both companies.
Buzzy news for Starbucks. Well said. Brian Sozzi, thanks so much. Well, Apple is getting ready for its big investor day. We are live in Cupertino with a preview coming up. Good morning, everyone. I'm Alexis Christoforous of Yahoo Finance. Brian Sozzi is on assignment. This is the first trade for Wednesday, February 26th. Another rocky day. Futures are whipsawing as the markets struggle to find direction after 2 days of dramatic selling. We have everything you need to know. And changes at the top. Bob Iger steps aside as CEO at Disney, and the markets are asking why now and why pick the park's chief to replace him. And the apple of investors' eyes. Tim Cook is set to address shareholders in just a few hours, with coronavirus leading to big worries at the tech giant. We are live in Cupertino with the very latest. And here is a check of the futures ahead of the opening bell. After 2 days of big selling, we're seeing the market trying to bounce back. Dow futures up 80 points, S&P futures up 11, and NASDAQ futures rallying 47. Now let's get a closer look at today's markets in our Morning Buzz. Heidi Chung is live in the newsroom. And Heidi, markets slid for a second day yesterday over fears of the coronavirus coming to the U.S. What is sending stocks, we'll call it modestly higher this morning?
Good morning, Alexis. Yeah, so Futures have been seesawing between positive and negative territory, but for now, with 30 minutes or so until the opening bell, futures are indicating a higher open across all of the major indices. And like you mentioned, this comes after yesterday we logged the the worst two-day decline, for stocks in 4 years. Stocks closed lower for the fourth consecutive session yesterday over concerns over that deadly coronavirus here. As of this morning, there are more than 81,000 active cases of the coronavirus worldwide, with roughly 2,770 deaths that have been confirmed as well. France reporting the second coronavirus death, and Italy reporting its 12th. We have Greece also reporting its first ever coronavirus case. In South Korea still remains the most effective outside of China. Yesterday, the CDC calling the virus a serious public health threat, and the agency also noting that it is likely to spread to the U.S., and it is no longer a matter of if, but when, Alexis.
And Heidi, I want to talk stock-specific news now, because we've got very big news late yesterday from Disney. Bob Iger stepping down as CEO immediately. It came as a surprise to many, even within the company. What do we know about the move?
Hey, Alexis. Yeah, so it was actually very shocking. Very shortly after the closing bell yesterday, longtime CEO Bob Iger mentioned that he would be stepping down from his role as CEO effective immediately and will just serve as executive chairman through 2021. Assuming the new CEO role is Bob Chapek, who was most recently serving as chairman of Disney Parks, Experiences and Products. Chapek will continue to report to Iger for the time being, and eventually will also be added to Disney's board of directors. Now, even though Iger did push back his succession for quite some time, we had previously known that he was going to step down from his role as CEO in 2021. So this came as a surprise given the timing and the abrupt announcement. Now, also after Disney's former chief operating officer, Tom Staggs, resigned in 2016, it was assumed that Kevin Mayer, who runs Disney's streaming service Disney Plus, would be the heir apparent, but that is certainly not the case, as we found out yesterday.
Yes, indeed. We'll be following this story for some time to come. All right, Heidi Chung in the newsroom, thanks so much.
Thanks.
Now let's take a look at European markets. Here's a look at the European markets this morning, where things are mixed. Actually, the CAC 40 now slightly in the green as the other major indexes try to crawl their way back from big losses over the past 2 days. The FTSE 100 actually briefly sank into correction territory when it fell more than 10% from its recent high. I want to check back in with Yahoo Finance's Oscar Williams-Groot live for us in London. So how is Europe now reacting to the coronavirus? We see that it is spreading more there each day, Oscar.
Well, Alexis, I think the Stoxx 600 tells the story of today in terms of how financial markets are reacting, which is essentially they don't quite know how to react. The Stoxx 600, which tracks the 600 biggest listed companies across Europe, was down as much as 3% this morning, but now it's down only 0.3%. Part of that is due to the slowdown in negative news flow surrounding the coronavirus, but it's also, I think, due to the fact that the US futures have turned positives, as we've just seen earlier in the show. Investors don't quite know how to quantify the impact of the coronavirus, and they are looking for cues either from US investors or elsewhere from public health officials, and the cadence of news has slowed down, meaning there is less negative sentiment to provoke selling.
Also, bring us up to date on just what companies in Europe have been saying and doing about coronavirus.
Sure. Well, I mean, even though we're not seeing less proclamations from governments and public health officials, companies are still warning that there is going to be a big impact. Diageo, the drinks giant that owns Guinness and Smirnoff vodka, they warned today that the shutdown just in China and the wider Asia region is going to lead to a sales slowdown of between 225 million and 325 million this year. We've also had Chevron, the oil giant. They sent home 300 staff in a London office today after one of their employees came down with flu-like symptoms. And then finally, SSP, who are the group that own franchises for things like Burger King and Starbucks in rail and airports. They warned today that sales have fallen by between 10 and 12 million in February alone due to the slowdown in traveling in Asia.
All right, Oscar Williams-Groot in London, thank you. I want to analyze the latest developments of the coronavirus with Yahoo Finance's Anjali Khemlani and emergency room doctor Samson Davis, author of Living and Dying in Brick City. Good morning to you both, and thanks so much for being with us. Dr. Davis, I'm going to start with you. The Centers for Disease Control said yesterday it's not a question of if but when this virus makes itself known here in the U.S. in a larger way. They say it could lead to significant disruptions of daily life. What should we as Americans be bracing for?
This thing is all about precautions. We in the hospital are taking necessary precautions, face masks. We're screening all patients that arrive and travel with fevers, cough, symptoms of coronavirus. We have 57 documented cases. I think that number will rise, but at the same time, taking the necessary precautions is key. The same situations you would do for the flu, coughing into the crux of your elbow, making sure you quarantine yourself if you have fever, if you have children with fever, cough, keeping them home. I think it's most important to, at this stage, to treat it just as a simple, not as simple, but as the flu, in which we sort of isolate ourselves and quarantine ourselves when we're suffering from the flu itself.
Doctor, how are you testing patients? I know there was word of a coronavirus kit, and then I heard that those kits were not working properly. What are you doing really on the ground in hospitals to decipher if someone has the coronavirus versus the flu versus something else?
You know, interesting enough, I had a case the other day in the hospital, in the emergency department, where a patient presented who was traveling from out of the country. He had fever, he had cough, and the incubation period, the time that you can sort of have the coronavirus and show symptoms, is from day 2 to day 14. And he was at day 14. I spoke to the CDC, I spoke to the State Department, and we decided that the patient was not at risk for having the coronavirus. So we're identifying patients during triage, during the initial presentation in the emergency department. We ask questions as if there's any foreign travel, if there's anybody that they've been in contact with that they know that's been sick, so we can isolate those cases. As soon as we do, we quarantine them, we put them in a respiratory droplet room where the least of the spread of contamination is lessened. We all put face masks on as well to prevent the possibility of being sort of contaminated with the coronavirus, and then we take precautions. Now, the issue is that we're sitting off the testing itself is going to the CDC, which 6 days, so a person would have to be quarantined for days. We're still working on having the testing done locally at the city departments and the state health department, which would lessen the period of time to quarantine a person if we suspect that they have the quarantine virus. There has been some fault with the test itself, but the scientists are, of course, working on these issues, and hopefully they will be resolved soon, and we can do better, sophisticated testing closer and with a faster turnaround.
Yeah, Anjali, the doctor brings up a great point. You need to have speed when you're trying to determine whether or not someone has this virus, and then the steps to take thereafter. What are you hearing from U.S. health officials?
Well, I think what's important to remember about the announcement yesterday, and about that very strong showing of the officials yesterday, is that this is something that they have been saying for a while, right? The World Health Organization has repeatedly said China's containment bought the world time to figure out how to deal with it. And so the way that the U.S. has really, used their flu pandemic strategy to kind of, detect cases in all these major cities, because that's where the biggest impact can be. And so I think that's important to remember. And if you heard Health and Human Services Secretary Alexis yesterday, he did mention that. So listen to what he had to say.
The immediate risk to the general American public remains low. But as we have warned, that has the potential to change quickly. There is now community transmission in a number of countries, including outside of Asia. That's deeply concerning, and community spread in other countries will make successful containment at our borders harder and harder.
So as you can hear, he's talking about really the global effort of what it is going to take, and that's what the U.S. health officials are working on now, is how do they preemptively quarantine and contain this virus.
All right, I know you're going to be following it for us. Anjali Khemlani, thank you. And our thanks to Dr. Samson Davis. Thanks for the work you're doing, and stay healthy. Thank you.
Thank you.
We also want to note that in a tweet, President Trump has announced he will have a coronavirus press conference that's going to happen at the White House this evening at 6 p.m. Eastern. Coming up on the first trade, big attacks at the Democratic debate last night, but were any punches landed? We'll look at how the candidates did in just a moment. It's time now to head down to the New York Stock Exchange and check in with Yahoo Finance's Inez Ferre for an early look at what's going on there about 15 minutes before the opening bell. And Inez, I know you have a special guest with you, a floor trader, Tim Anderson, for a little more perspective on what we're seeing in this stock market.
That's right, Alexis. Tim, futures are pointing towards a green open. Is this sustainable for during today's session?
I think this is a perfect setup for a rally today. I'm not saying we're out of the woods. I'm not saying like everything we saw the last 2 days, it's over. But the market was down, futures were down a 1.5% overnight. The Dow was down as much as 400 points. We're looking at a moderately higher opening today. I would typically not like to see the market open sharply higher, but it's just a little bit. And I think that given that we had two very heavy down volume days in a row, 90% down volume days is a terrific indicator for a short-term trading rally for a day, day and a half, 2 days, depending on how sharp it gets. But I would just caveat that by saying we usually don't get sharp sell-offs like that so shortly after all-time highs. And also, we're still going to be very headline-driven on more news on the virus.
Let's talk for a second about Disney. Right now, it's a little bit under pressure in pre-market. Was it a surprise to Wall Street that Bob Iger would be stepping down as CEO?
Well, I think a lot of people have been talking about when he would be stepping down, and they have been messaging that 2020 is probably going to be his last year, et cetera, et cetera. I think what really surprised people was the comment that he's stepping down immediately. Now,
he's staying on as executive chairman? Through 2021?
Yes, although that cushions it a little bit. But I would just say he's had a phenomenal career. I can't imagine anyone having done a better job at that company. But anytime you see a headline that a CEO is stepping down immediately, they're always going to get some raised eyebrows about that.
Thanks so much, Tim. Alexis?
All right, thanks very much, Inez. We'll see you a little later on in the show. Well, the Democrats who want to be president are back on the trail in South Carolina today after a blistering debate that was big on attacks, but pretty light on substance. Frontrunner Bernie Sanders was the target, clashing at one point with Mike Bloomberg over who was the better choice to beat President Trump.
Well, you're right. The economy is doing really great for people like Mr. Bloomberg and other billionaires.
Vladimir Putin thinks that Donald Trump should be president of the United States, and that's why Russia is helping you get elected, so you'll lose to him.
Oh, those are fighting words. Let's talk about it with Ed Myles, Washington policy analyst at Raymond James. He's in our D.C. bureau this morning. Ed, always good to see you, especially the day after debates like yesterday. You called it a messy debate. The candidates certainly came out swinging against Sanders, but is it enough, do you think, to derail his momentum right now?
Yeah, I think it is a question of, is it too little too late? It is clear that Bernie Sanders is the front runner at this point after his performance in the first three nominating contests. He's within striking distance for the South Carolina primary on Saturday. And I think it was very clear that the other candidates on the stage last night are desperate to kind of establish themselves as the clear alternative to Sanders. I think it's going to be a big question on whether or not that support, kind of coalesces around one individual candidate. And for Sanders last night, he got a lot of blows, but he's also able to generally deflect that and immediately go on the offensive and go back to his talking points of exactly why he is running. And so, well, he was the focus of the debate last night. I don't think he came out of that debate any worse than when he walked in.
All right, let's talk Mike Bloomberg. Had a disastrous first debate, seemed to get his feet under him a bit last night. What do the prospects look like for the former New York City mayor?
Yeah, so for Bloomberg, he really was hoping that what happened in Vegas stayed in Vegas. And last night, what I've been trying to discern is whether or not his performance was kind of outright good or it was a relative issue. Senator Elizabeth Warren probably did the most in attacking Bloomberg. He generally stuck to his talking points. He put in a solid debate performance. He is the one individual on that stage with essentially unlimited resources to get his message out. And so the thing I'm looking for Bloomberg is Joe Biden has to have a poor performance on Saturday in the South Carolina debate, or in the actual primary, for Bloomberg trying to put that coalition together on Super Tuesday, him kind of being the receiving end of kind of the anti-Sanders vote rather than the disparate kind of options that Democrats have for them right now.
Yeah, you mentioned Elizabeth Warren. She really lit into Bloomberg yet again. I'm not so sure it was as effective this time. There were actually boos from the audience when she tried to bring up yet again the non-disclosure agreements. I don't know, but to me it sounded like she was gunning for perhaps Bernie Sanders VP. What do you think?
Alexis, I think you're right. We wrote that in our note in terms of, she was on attack mode, and she seemed to be much more anti-Bloomberg than promoting her own candidacy, which does raise questions on whether or not she views kind of an alliance with a Bernie Sanders campaign as her best chance of kind of advancing at this point. I think it was kind of awkward at times with how kind of those attacks went across, but I think it just goes back to show you is that, Elizabeth Warren is 2-0 against Wells Fargo CEOs. She's trying to kind of go 1-0 against kind of the clear billionaire in the race for presidency. She seems to kind of treat Bloomberg as a witness sitting in front of her at the banking committee, more so as a fellow kind of Democrat running for office on the debate stage.
Yeah, good analogy. Ed Mills, thanks a lot. This conversation will be a lot different after Super Tuesday for sure. Thanks for your time this morning. All right, can anyone or anything stop the Sanders surge? I talk about it in this week's Electionomics podcast with my guest, Lee Miringoff, director of the Marist Institute for Public Opinion. Be sure to check it out on Apple Podcasts or wherever you get your podcasts. Coming up on the first trade, Apple getting ready for its big investor day. We'll be live in Cupertino for a preview. Stay with us. Let's take a look at today's News Bites. The heiress to the Hot Pockets fortune has been sentenced to 5 months in prison for her role in the college admissions scandal. Michelle Janovis apologized to the judge, saying she was, quote, so very sorry that she tried to create an unfair advantage for her children. Prosecutors say she paid $100,000 to have someone take the ACT exam in place of her daughters, and also paid $200,000 to get one of her daughters into USC by pretending she was a beach volleyball recruit. The Transportation Security Administration, or TSA, has placed a temporary freeze on hiring and overtime pay until April or May as part of its effort to give raises to its employees. That's according to the Washington Post. This decision could mean airports will be short-staffed, which could be a problem during the busy spring break travel period. A Democratic congressional aide says they were told the freeze will help cover the cost of employees' 3.1% pay increase. And J.P. Morgan is issuing a stark warning over climate change. In its annual regulatory filing, the bank says that climate change poses a real risk to its business investments. The note comes after the bank promised to stop investing in certain types of coal-fired power plants. We have the opening bell coming up on the first trade, but first, here is a look at the action in overseas markets where things are lower this morning. We'll be right back.
Hey.
Welcome back to the first trade. We're about 4 minutes away from the opening bell. Futures trying to bounce back after 2 dismal days for the markets. So we are seeing some gains. They are modest, though, here in the U.S. Let's go around the bell with Aaron Gibbs, President and CIO of Gibbs Wealth Management. We also have Greg Swenson back. He's a founding partner of Brig Macadam. He's joining us from London. And we have Yahoo Finance's Jared Blickery at the YFI Interactive Board. All right, everybody, it's only Wednesday, and it's been quite the week for the markets. I'm going to start with you, Aaron. We're seeing a little bit of a bounce back this morning. Does it signal we're out of the woods?
Not just yet. I think we might sort of pause or take a breather for maybe the remainder of the week unless we really see some really nasty negative news. But I think there's real potential for this for further downside, particularly in the U.S. markets as well as in China. I think we've really underestimated how long this is going to take to recover, that this may hit the Chinese economy pretty significantly for 2 quarters, not just one, and that it may not be such a sharp V rebound. We really may not see that full rebound until fourth quarter or maybe mid third quarter. So for me, if our investors are thinking about, is this the time to buy right now? I think we could go down a little further. I think if you're really looking for a cheaper valuation to come in, I would wait more until, let's say, end of second quarter, third quarter, when we see some of our better clarity and earnings estimates stabilize. I don't think it's time to jump in. And I think we could easily go down another 9%. That would take valuations down to about 17 times, which is actually much closer to our 3-year average and a more healthy valuation point than what we are now. We're still pretty rich. So that's another reason that I feel that we could go down further and it would still be a healthy market scenario.
Greg, would you agree with Aaron? Could this market fall yet another 9%? And would you feel comfortable getting into the market at that point?
Yeah, I think, look, you're never going to catch the absolute bottom. And I think I'd rather be patient and wait and maybe miss a couple of points or miss 5 points rather than catch the falling knife right now, which is basically what you'd be doing. So, look, it seems like today the panic selling has stopped and the risk-off trade, the complete risk-off trade has slowed down. But it doesn't mean there's massive buying either. So, yeah, I would agree. It might be best to be patient here and maybe pick some spots, to dip your toes in the water.
All right, Jared Blickery, what's the world looking like this morning?
Well, a bit of red in the east and also in Europe. Interestingly, I was just looking at the DAX. It turned positive very briefly here, but that is a positive development over in Europe. We can see the S&P, Dow, and NASDAQ futures all up. NASDAQ up the most at 0.6%. And we can also take a look at what happened yesterday. These two huge red candles, those are the last 2 days. We are a bit oversold right now, and we could bounce. And in fact, seasonality does favor a bounce over the next 3 to 5 days. We could see as much as 3 to 4.5% here, according to Almanac Trader, but intermediately, probably going to retest the lows.
All right, we shall see soon enough as the opening bell sounds at the New York Stock Exchange and the NASDAQ. The Dow gave up 1,900 points in the past 2 trading sessions, trying to bounce back this morning. Looks like the Dow Jones Industrial Average is going to start on the plus side by about 110 points. Here are the headlines making the first trade front page this Wednesday morning. The coronavirus continues to dominate the headlines. Cases of the virus have jumped in South Korea as the first U.S. soldier has been infected. We also learned this morning that Brazil has its first case. That's the first presence of the virus in South America. Next, we have a C-suite shakeup at Disney. Longtime CEO Bob Iger is out and is being succeeded by Bob Chapek. Chapek has been with the company for 27 years. He helped open the Shanghai Disney Resort. By the way, Iger is going to stay on as executive chairman. Don't get too worried just yet. And another change, this time at Salesforce. The company's co-CEO Keith Block is stepping down. He's going to become an advisor for the rest of the year. Mark Benioff, well, he's going to be the sole CEO of the company. Want to get back to our roundtable now. And Aaron, before we went to the opening bell, Greg talked about maybe picking and choosing some winners here. Where do you see some opportunities amidst all of this? It's a broad-based sell-off.
Yeah, but we have seen some industries that have been hit particularly hard. And so a lot of that is consumer discretionary. People aren't, particularly your travel, some autos, and then energy, right? Because if China's not producing, they're not buying as much energy. So energy, again, that might be something where you really want to wait until you see the Chinese recovery, and that's where you want to get in. I certainly think that we could see some further downside. So, shorting your ETF energy sectors, that's one option if you really want to play something short term. I think the areas where you might see a rebound, where you're seeing some slowdown in purchasing and production in consumer discretionary, more on the, let's say, technology side, buying your gadgets, you don't get your new phone, that type of thing. Mm-hmm. That is more of a pent-up demand, where if we do come to recovery, people are just going to go out and hurry up and spend more. So with more of those physical items, you might see that nice luxury goods, for example, great place where you might see a really nice rebound. Where you won't see the rebound are experiences, so your hotel, your restaurants, because it's not like you're going to go out and eat 4 times because you stopped going out to eat 2 times a week, right? You don't make up exactly. Right. So you got to kind of sort of look at consumer discretionary, because they're getting hit the hardest, and figure out, okay, well, what industries can you make up for it? Sure, I can go buy another 2 pairs of shoes as soon as they start coming and producing. Mm-hmm. But will I go and spend twice as much on going out to hotels or going out to restaurants, or buying twice as many airline tickets? Probably less so. And so that's where you want to pick and choose. So I really see that textiles are actually an area where you could see that rebound in the fourth quarter. And so once we really hit those lows, that might be some of your big winners.
Where are you seeing opportunities, Greg, for a little entry point for investors who may want to still participate in all this?
Yeah, look, for individual investors, it's hard to pick the bottom, but I think some of these energy stocks that have just been crushed. I mean, you saw Exxon the last couple of days. It's trading at 16 times with a 6.42 dividend yield, with 10-year treasuries at 133 or wherever they're trading right now. Look, that's making these high dividend stocks really attractive. The energy sector, started trading down massively starting on January 20th with the first news of the virus, and it's obviously the worst sector, and you've got down almost 10%, I think, since Jan 20. So at some point, it's interesting to layer in, especially if you can do it with these high dividend. BP, granted, maybe a little pricey at 28 times, but it's a 7.5% yield, 7.56 yield. I mean, that's fantastic as an alternative to bonds, with the 10-year now trading, well below the historical averages and even at the recent lows in terms of yield.
Talk about alternative people running to the safety of the Treasury market as we're seeing. We were seeing gold rallying really nicely. Greg and Aaron, maybe you can help me understand this. Greg, to you first. Why are we seeing gold lower for the second straight day? I'm seeing it now off nearly 1% at $16.36 an ounce.
Yeah, it's hard to make sense of it because the bond market was a really good, a good leading indicator. The bond market was sending all the signals in the last few weeks before the equity market sell-off. So you think that gold would be rallying as well. So I was a little bit surprised to see that. There is some, diversion. Not everything's made sense in terms of historical correlations in the last few weeks. And as I said, you saw that with the bond market behaving the way it was without having stocks sell off at all. So it just took, I think it took a few weeks for equities to catch up, and you might be able to say the same thing for gold.
Not always rational, right, Aaron? But what's your quick take on gold?
I think maybe investors are looking more for safety in just other. Yeah, it's interesting that I think the gold play this time is because I think investors are seeing this as such a short term. We still are seeing it as more of a short term pandemic. This isn't a long term where we might really face, like a 10-year recession. We're eventually going to get the virus contained. We're eventually going to get a vaccine. There is going to be a rebound, and so that might be a reason that investors aren't going so full force into the safeties trade.
All right, Aaron Gibbs, Greg Swenson, Jared Blickery, thanks to you all for joining us this morning. All right, we are about 6 minutes into the trading day. I want to check in with Inez Ferre down at the New York Stock Exchange for what she has her eye on. Inez?
And Alexis, we're seeing a bit of a rebound right now with the Dow up 150 points, the S&P and NASDAQ also in the green. We're watching Wendy's this morning after the company reported its fourth quarter results with its revenue coming in above expectation. North America, same restaurant sales were up 4.3%. That was better than what the street had been expecting. Its full year earnings guidance came in short, though, of what the street was expecting. And looking at Lowe's earnings per share for its latest quarter came in as a beat. Its revenue came in short of expectations, and its full year adjusted earnings guidance just below what the street was expecting. The company says it is 1 year into its multi-year turnaround plan. And we're watching PG&E after the company announced that it plans to sell securities to raise more than $25 billion. PG&E is going through restructuring as it goes through its Chapter 11 process. It's hoping to exit bankruptcy by June 30th. Right now, we are looking at the Dow that's going higher, up more than 200 points. You've got financials and tech, which are leading the gains. Alexis?
Yeah, higher. How do you like that? Some green arrows. Yeah. All right, Inez Ferre, thank you. Of course, we also have our eye on Disney. No green arrow here. The stock is off better than 1% right now after that huge shakeup in the C-suite. Bob Iger is going to be stepping down immediately to become executive chairman, and the parks chief, Bob Chapek, is the new CEO. Dan Roberts is joining us now. And Dan, you are always on the Disney beat. How much of a surprise? First of all, the timing was a bit of a surprise, but how much of a surprise that it is Chapek and not perhaps Kevin Mayer, who heads up streaming?
Well, I actually think the fact that it's someone who's been running parks makes sense, because for all the glitz and glam and splashiness to the content right now, and the fact that we and everyone in the business media has been so focused on what Disney has been doing with streaming, which I think is fair and makes sense because Iger has said streaming is our #1 priority. Despite all the focus on that and the buzz around that, parks is the profit engine of this company. company. I think people forget that. Parks kind of just hums along and performs quietly. But you know, Iger in his book that came out last year actually opened the book talking about the opening of Shanghai Disneyland. And he called that my biggest achievement as CEO. It was Chapek who was running Parks underneath Iger and led the opening of Shanghai Disneyland. So I think it makes a lot of sense. Now, of course, ironically right now while we're discussing this, you have coronavirus going on and Shanghai Disneyland was shut down temporarily. But Parks is the huge moneymaker for this company. I mean, Parks and Cruises. So I don't think it's too much of a surprise. And since the news came out, some people have reportedly said that Chapek has been known as the next guy up for a while inside the company. They obviously kept that very quiet.
Yeah, I'd say when you look at his tenure there, Bob Iger, 14 years. I think the stock was up something like 5-fold during that time. He brought a lot of assets in, Lucasfilms, right? Star Wars, Pixar, Marvel, opened the Shanghai park. What do you think, though, he's going to be most known for? What is Iger's legacy?
Well, so I think it is the M&A activity. I think it's 5 huge deals. I would add to the list you just said ML BAM Tech, or nicknamed now just BAM Tech, which was sort of not a consumer-facing business, but inside the industry it was known as the best back-end video streaming company in the industry. It was part of Major League Baseball. Then MLB spun it off. Disney at first took a minority stake for $1 billion and had the option later on to buy the rest of it, but then sped up that process. And Iger said, you know what? We just want all of it. We'll buy it right now. Ended up spending $2.58 billion. And that is the little company now that powers ESPN Plus and Disney Plus. So I think he'll be remembered for 5 big acquisitions and for pushing streaming, direct to consumer.
We know he had political aspirations, of course, not in the presidential race this time, even though Oprah Winfrey apparently said she really tried to talk him into it. You think we might see him in political life, maybe part of the cabinet if a Democrat gets in?
I think we could, or he runs in 2024. There are people wondering, is there some hidden reason why he stepped down now? And he has said, no, I wanted to focus on the creative side. Maybe it'll soon come out what it really was. But regardless, in the end, he's going to be at the company as long as he originally had said, which is till the end of 2021, simply as chairman instead of CEO. So it's a shock. Stock down 1% right now, but he's clearly not stepping away from the company yet. He just won't be its face.
And the story perhaps is just the beginning for Mr. Iger. Thanks a lot, Dan Roberts. Another CEO in the hot seat today is Tim Cook. He's going to be meeting with shareholders in Cupertino as Apple warns over the impact of the coronavirus. Tech editor Dan Howley is there. He is live for us right now. Dan, we're just a few hours away from this big meeting. What should we expect?
Yeah, this is going to be a meeting where obviously the first point of order will be discussing the impact of the coronavirus on Apple's supply chain, as well as the ability for them to get units out the door to customers. China, obviously, their stores were closed either fully or partially, so consumers couldn't buy those products. And then there's the supply chain issue where they still haven't had factories up to full speed yet, and there's fear that that could start to impact the next couple of quarters. Right now, they've already warned that Q2, the revenue guidance is going to be way off what they originally had predicted. They didn't even give us a new guidance range once they had made that announcement. So we're thinking that maybe Q3 could be impacted now because of the iPhone 11 stock not being there, potentially the AirPods stock not being there, the Apple Watch and what have you. But investors are looking forward to the impact that this might have, believe it or not, on the iPhone 12 or whatever the next iPhone is called, because they believe that a pent-up demand for the iPhone 11 and its lack of availability may push consumers to purchase that device. There's already thoughts that that might lead to a super cycle, a huge uptake of sales of that device, because it will be the first 5G iPhone. So it could be good in the end for Apple.
Yeah, that would certainly be a way for them to spin it positive if they had to. Do you think, though, we might see any new tech revealed, maybe a little teaser here at the Investor Day?
There's very little as far as consumer tech goes. Usually, though, we have heard before last year, Tim Cook said that they were very excited about their upcoming roadmap. They'll have new devices that'll blow your minds. And he did mention stuff like the uptick of the AirPods, how popular they were, how they're iconic now, as well as the Apple Watch and how well that's performing. So we may get a tidbit here or there, but I'm not expecting anything too big.
All right, we know you're going to be all over it. Dan Howley, live for us in Cupertino. Thank you. Fintech companies are changing the way younger generations handle their money, with millennials expected to contribute over $11 trillion to assets in the U.S. over the next decade. Joining me now is Acorn CEO Noah Kerner. Noah, great to see you.
Good to see you.
I'd love for you to give us paint the picture for us right now in terms of millennial investors. What are they doing during this really scary time for some? This is the first time they're living through a market downturn such as this. What are they doing with their money?
So a lot of them are saving and investing through Acorns. And actually what we see, because we focus a lot on education and making sure during these times people are focused on the long term and not focused on panicking during a dip. So we see a lot of them sticking with it. And that's really important, obviously, for the long term.
That's actually really encouraging.
Yeah, totally.
Are they saving more as well, or what are they doing with the extra change they have at the end of the day?
Yeah, so we obviously help them round up and invest the spare change. So we're seeing a lot more of that happen. We're seeing them stay committed to it, and it's exciting to see that, because if they do that, over the long term, we're going to have a better society.
Now, at Acorns, I guess the goal was always to be more than what you are now, to maybe someday be a full-on service bank,
yes.
Especially for the younger generation. To that end, you are now offering insurance.
Yeah.
Tell us about that.
Yeah, so our vision is to build a financial wellness system that enables everyday Americans to save and invest every day. And what that means is everything you do in your financial life impacts how well you save or invest. So how much you spend, how much you earn, how much debt you have, and how well insured you are. So we just rolled out Acorns Protect to make sure everyday Americans are insured in case of emergencies and things like that. And pet insurance is really interesting. So you think 70% of Americans have a pet.
Yeah.
1% of Americans are insured with pet insurance. For example, for me, I had to spend $20,000 on my dog, who went through like a really difficult 2-month period with the vet. She had pre-existing conditions, so I was only covered up to 50%.
Okay.
If you get it before that, you're covered fully. Now, I would have probably ended up having to euthanize my dog if I couldn't afford it, and that's what happens to a lot of people.
That's a real reality for some folks.
Yeah.
Your company, you have 7 million customers now. How many of those, though, are actually actively investing or saving with you?
Yeah, so 7 million are doing something. They're either actively investing and saving, they're using our Found Money program where brands invest in you as a reward for shopping. They're consuming our financial literacy content. So we create a lot of stuff. We also do that in partnership with CNBC. But we're producing financial literacy content that people are reading every day. And so
you do make your money by charging folks to hold an account with you, anywhere from $1 to $3. I'm not sure what the exact amount is, but how did you convince them to say yes to that? Because big banks like Bank of America wanted to charge people $5 for their debit cards on a monthly basis, and there was a big backlash.
Yeah, our business model is subscription service, and we believe that's the model for this category. So we actually have the largest subscriber base in all of financial services. It's pretty simple. It's $1 a month for the basic tier, and you get a bunch of products that help you save and invest. And then as you level up, it's more money per month, but that helps you save and invest even more money. So it's a kind of a simple value proposition. And yeah.
Noah, before we let you go, some big name celebrities, Ashton Kutcher, Jennifer Lopez, who used to DJ for, Alex Rodriguez, are investing, Kevin Durant investing in the company. You use them sometimes as influencers for some of your products, do you? And what ideas have you gotten from them?
Yeah, I mean, I think they believe in what we're doing, so they just support it generally. So if we're launching something new and they think it's good for people, they'll talk about it. It's not really much deeper than that. We try to keep it organic. Like for us, we're not paying people to promote these. Our partners are investing in Acorns, and they believe in what we're doing, and they believe it's good for people, so they support it. That's really it.
Noah Carter, good luck with the insurance products.
Thank you.
Thanks for stopping by. Sure. Coming up on The First Trade, more problems for Mattel as it faces a federal investigation. Your companies to watch up next. Now for a look at some of the companies and stocks the Yahoo Finance team is watching for you today. We are going to begin with Tesla and Panasonic. They are walking away from a partnership here in the U.S. Panasonic says it will no longer produce solar cells at Tesla's factory in Buffalo. Tesla insists the move won't have any bearing on its operations. Panasonic does plan to continue producing batteries at Tesla's Gigafactory in Nevada, but those are for cars, not solar roofs. Tesla pretty much unchanged right now, but as you can see, a rough 5 days really for most of the market. Stock off about 13% in that time. Next up, we have got Mattel on the plus side by about 1%, but off 8% over the past 5 days. Mattel's rough year continues. The SEC is looking into the toy company's accounting practices now. It wants more information on financial discrepancies found by a whistleblower that caused the company's CFO to exit back in October. Mattel said it's cooperating with that investigation, and the company is still searching for someone to fill that CFO job. And finally, Hilton Worldwide. Nice rally here, up better than 1 1/3% right now. The Waldorf Astoria Beverly Hills Hotel is being accused of stealing secrets from a rival. The Peninsula Beverly Hills is alleging that the former Waldorf manager worked with a Peninsula employee for over a year, acting as a mole to gain information to help win more luxury Middle Eastern clients. The civil lawsuit names Hilton Worldwide Holdings, owner of Waldorf Hotels, as one of the defendants. In just a moment, we're going to head back to the New York Stock Exchange with a look at how Salesforce stock is doing after a C-suite shakeup there. Stay with us.
Fios TV app, the only streaming app you'll ever want. Watch sports and never miss a moment. Watch your favorites on demand or from your DVR. Watch over 200 channels and binge watch data-free with Verizon Wireless. And search for movies and TV shows on
Learning about investing is not easy, especially when the markets are volatile. But one Harvard student saw an opportunity to not just educate himself, but others on campus. To do that, Angel Anoha created BLK Capital Management. It is 100% Black-owned, and it is a student-run hedge fund with, I think, about $100,000 in assets. He joins us now along with Yahoo Finance's Kristen Myers. Good morning to you both. Angel, I love this story. First off, just tell us, why did you want to start this a couple of years ago?
Absolutely. You know, there's a Forbes article that just came out that was talking about how if the wealth gap continues at the same rate that it is today, that by 2053, the median wealth of a Black family will be 0. And so BLK Capital Management really got started because we're looking to fight the systematic oppression that we face within the financial services industry that has not only prohibited us from being able to obtain knowledge about finance within itself, but then also build generational wealth for our families. And so we're starting at the college level because we really believe that it's a nascent time for students that are really looking to build the financial foundations. They're going to have such ramifications on our futures. College is a time that African Americans and really any student really start to look at taking on and exploring credit, taking on debt in order to afford going to college. And so I really believe that this is the perfect time to empower them with the financial literacy knowledge that they'll need in order to make and understand the right decisions.
So talk us through how it works. It is a actual hedge fund, right? Completely run by the students. Now, the students aren't just at Harvard. They're students anywhere around the country,
nationwide,
correct?
yeah.
Okay.
And so the way that it works basically is we have sort of this application process. You don't need to have any sort of financial background in order to apply, because the whole point is that we want to educate these young African Americans. And then once you're part of the program, we actually have sort of three parts of the program that we really focus on, which is education, mentorship, and then pre-professionalism. And so on the education side, we actually do teach our students the fundamentals of investing. And then on the mentorship and pre-professional side, we actually partner with large institutions on Wall Street, such as Goldman Sachs, Bank of America, Morgan Stanley. And they provide the capital that we use to actually invest, but then also provide mentors for our program and help us run the program.
Okay, so students are not investing their own money here.
Absolutely not, no.
Okay, very, very cool.
So how has the fund been doing lately? I know we've been talking a lot about the markets the last couple of days, but you guys are not doing so bad?
Yeah, so we actually made our first investment late last year. And one interesting thing about our fund is that we focus on small cap opportunities. And so those are usually companies with a market cap under $1 billion. And so typically those types of companies aren't really affected by what's happening in the broader market, which is really interesting. And we also think it gives us sort of a bit of an advantage because we're not competing against, companies that a Goldman Sachs might be looking into investing and have more information on. But we're actually investing in companies that we can call and we can do further due diligence on.
I want to ask you really quickly about the quote-unquote success rate. How are the people that have gone through this program, what are they doing now? Do they all get placed at firms, financial firms, after graduation?
So a lot of them do go into finance, but interestingly enough, a lot of them sort of have a broad sorts of ranges of industries that they choose to go into. And so the main focus of our program is really to educate students in financial literacy so that they'll have the skills to really go into any industry. If you want to go into finance, that's great. If you want to go into consulting, entrepreneurship, any sort of field that you want to go into, you need to understand personal finance, really. You need to understand the importance of saving and investing.
Good luck with the hedge fund, Angel Anoha, and you've got a bright future ahead. I can see it. Kristen, thanks so much.
Of course.
All right, we want to now get a check of the markets with Inez Ferre down on the floor of the New York Stock Exchange. That's going to do it for this hour here of the first trade. I'm Alexis Christoforous. Let's see what Inez is working on there as the market continues to try to find its footing, now rallying. The Dow is up better than 200 points right now.
That's right, Alexis, and all the sectors right now are in the green. Technology is leading this rebound. We want to take a look at Salesforce. This is after the company announced that its co-CEO, Keith Block, will be stepping down. Mark Benioff will be sole chairman and CEO. Block will stay on as advisor to the CEO. And also looking at Moderna, that it has really been soaring over the last couple of sessions. This is today, the company reported its quarterly results, but also the company said that it has an experimental vaccine for a virus linked to birth defects that's advancing quicker than expected. This is the second piece of good news this week for the company, because also Moderna earlier this week had also announced that it is sending an experimental coronavirus vaccine to U.S. researchers, and trials for this vaccine could start in April. And Fossil plunging after a disappointing quarter. Gross margins decreased year over year. The company said that its top line was affected by more promos, and inventory write-downs impacted gross margins and also profits. Make sure to stay with us, because On the Move starts right after the break. The Dow's up 240 points.
1 year into a multi-year turnaround plan. Julie, Adam.
Inez, thank you. Our top story is coronavirus turmoil as stocks rebound from yesterday's sell-off, which was the second sell-off of the week. The total death toll now stands at more than 2,700 worldwide, with over 800,000 confirmed cases. 80,000 confirmed cases. The news further increasing worries that the economic disruption of the outbreak may have a wider impact than initially first expected. With us now to discuss this is Matt Orton, Carolyn Tower Advisors, VP and Portfolio Specialist. Thank you for being here. One of the things you pointed out in a recent note to your clients is that the sell-offs we saw on Monday and Tuesday help us get, quote, a meaningful correction to reset prices. Are we there, do you think?
Well, that's a great point, Adam, and I think we are getting there. When we came into this week and we were looking at a very, very overstretched situation in equities, and basically one of the challenges is that we were trading at 11% over a 200-day moving average. And in addition to that, there were a lot of signals technically in the market that we were a little bit stretched and ahead of ourselves. So whether or not the market traded down with respect to coronavirus or some sort of other disruption, it was inevitable that we were due for some sort of pullback. And when we historically contextualize the pullback that we've had from the virus, it looks very in line with what we've seen in other pandemic type situations. And in fact, we still haven't even done near the type of damage that we had over the SARS pandemic back in 2003.
That said, yes, maybe we were ripe for some kind of pullback, but obviously there are some fundamental concerns here about what is going to happen next with coronavirus. Today's bounce notwithstanding, you have companies like the Chinese social media company Weibo, you have Toyota, both of them coming out with comments on coronavirus today and what that's going to mean for their business. So given that they're likely the first, or not even first, the middle of many to comment on this, do you think that the bounce today is warranted?
I think the bounce today was probably inevitable. When the market gets to be extremely oversold, heading into today, 98% of the S&P 500 was selling off, which is a very, very high component technically to be having. So it looks like the bounce is probably warranted. And when we look historically at any of these other situations where we've had very, very fast sell-offs, there tends to be a bounce as the market digests information. I personally think that even if we bounce, there could still be room to go to the downside because there's still uncertainty. And uncertainty is really the enemy of the markets. And until we have a little bit of a better understanding of what the full implication could be of the coronavirus on supply chains and on potential earnings guidance for companies, the market could still be trading in a very, very volatile range. That said, I think medium to longer term, the fundamental outlook for the U.S. economy and the fundamentals supporting the market are still in place. We're still in a very easy accommodative monetary policy situation in the U.S. And with interest rates hitting record lows over the past few days, equities are still going to be the place to be. And the consumer in the U.S., which is a little bit more insulated than the rest of the world, at least right now, has been holding up fairly well and is likely to hold up better than maybe what we've seen in China. And the U.S. itself is much better prepared to address a sort of outbreak if and when that were to happen than some of these other countries might have been.
Well, Matt, you talk about the accommodative policy. What about the Fed? I mean, the market's pricing in one Fed cut just a week ago. Today, it's two. Is that going to be enough to help?
You know, Adam, that's exactly right. The market is now pricing in 2 rate cuts for the rest of this year. And the commentary that we've had from the Federal Reserve over the past few days has really been, let's wait and see. We need to get more information on what the potential impact could be from the virus on the economy and on the global economy before making any moves. But we're in an environment where the Federal Reserve and really global central banks as a whole have been very, very willing to step in and make sure that they are early rather than late to making sure that we're keeping the overall economic recovery on track.
But Matt,
so
you
I certainly wouldn't be...
You pointed out just a few minutes ago that you still expect there could be more trajectory to the downside. And I'm curious, we were approaching a correction, at least on the S&P 500 from our peak. We weren't far from it. I mean, we were down almost 8%. Do you think we're going to see that correction? How do I, as an investor, how do we position ourselves?
I think you need to look at sectors that are a little bit more insulated from the virus, or sectors that could actually benefit from the virus. And one area that I've been talking to clients about has been healthcare. Healthcare has been very interesting because when you look at Monday's sell-off in the market, healthcare really was reacting to Bernie Sanders' victory in the Nevada caucus rather than the implication of the coronavirus. And healthcare itself, really for the past 6 months or so, has been very, very reactive to political wins rather than fundamentals themselves. So when we dive into the healthcare sector, and when I've been talking to clients about areas of opportunity in this sort of market, finding companies that are producing that are more cash pay generated companies, so companies that are producing products, veterinary care companies, companies that are producing medical equipment or aligners for your teeth, things like that's more consumer driven, that people are going to want regardless of the overall situation and from coronavirus, I think should hold up fairly well.
Yeah, it's a good point.
In addition to that,
It's a very good point. Listen, Matt Orton from Carolyn Tower Advisors, VP and Portfolio Specialist, we appreciate your insight here on The Move.
It's great to be here. Thank you.
Just wanted to mention new home sales for January just coming out a few moments ago. 7.9% increase in January to a level, a seasonally adjusted annual pace of 764,000. That is the highest level since July of 2007. So something Matt was just referring to, perhaps some positive underpinnings in the economy in evidence in that number. We'll talk more about that later in the show. But now let's get to Disney and that surprise announcement that is pressuring the shares this morning. Longtime CEO Bob Iger is stepping aside. He will become executive chairman. His handpicked successor is the parks chief, Bob Chapek. Yahoo Finance's Dan Roberts has the latest. And of course, Iger has had a history of saying he was leaving and then changing his mind. But the timing of this was, and perhaps his selection, were most surprising.
Yeah, I agree with you, Julie. It is a surprise, and I think that's why the stock is down only a little right now. You know, if it had all been pre-planned, maybe you would have seen a bump after it was announced. It's interesting, we had a guest on the final round yesterday afternoon who said Disney is usually much more scripted than this with announcements, and I agree. Now, that said, Iger will still, in the end, stay at the company for the same amount of time he had previously said. He'll be there until end of 2021. What's new is he'll be chairman and not CEO, which is obviously a huge change. Interestingly, he said yesterday on CNBC that what he now wants to focus on is the creative side. And if you look back at some of the things he had said on the last few earnings calls, I think there were a few hints that this was the case, that the creative side and the content was becoming his passion. Obviously, the content, really the biggest story with Disney in the last year, streaming, direct-to-consumer, Disney+, The Mandalorian, and the original content in the franchises are what helped Disney dominate the box office in the last couple of years, Avengers, Star Wars. Now, all that said, anytime that a big, iconic CEO, and he's been CEO since 2005, suddenly steps down, you're going to have questions about, is there a health issue? Is there some kind of scandal that's soon to come out? And there are people asking those questions. I'm inclined to take him at his word and think that, you know, he wants to focus more on the creative side. What he said is, we've made all these acquisitions. We have a lot of good assets and businesses. Now the issue is just firing on those cylinders. And so he wants someone else to be doing that. But yeah, I understand that, you know, people are going to be surprised by this. And it's interesting that it's Chapek. It's someone from the park side, not someone from the studio side, although Chapek did work on the studio side years and years ago, but he's been running parks for 5 years.
All right, Dan Roberts, thank you. Let's hone in on Disney a bit more and bring in Needham analyst Laura Martin, who joins us via the telephone. I want to ask you what Dan just closed with. He was talking about Kevin Mayer. We made such a big deal last year about Disney+, and Kevin Mayer has been part of the digital force at Disney. What happens to him?
Well, I think that's going to be the challenge for the new CEO, is he's got to keep these really mission-critical content and distribution people in place. Kevin Mayer is a really integral part of the streaming situation, and he needs to not lose Kevin Mayer as part of the organization. And similarly, he needs to not lose the Pixar and Marvel and Star Wars teams as part of the team, because those are really the juggernauts for earnings in this company going forward. So he needs to make sure that all those executives stay in place now that he has been selected as the new CEO.
Laura, a lot has been made of Iger's charisma, his ease at sort of presenting on behalf of the company. Chapek, by the accounts I have read, is sort of a more cerebral leader, perhaps not going to be that face and that charisma that we've seen from Iger. How important has that been to Disney, and how is that going to change things for the company going forward?
Oh, I think Bob. First, I think the CEO of Disney is an impossible job. It is a combination of IQ and warmth and politics and creativity, and Disney's it's a global brand that the CEO has to embody, and everything is, channels Walt Disney the man. So it's a really hard job to actually live up to, if that's a good word. So almost nobody could do what Bob Iger has done. Like nobody. Like wouldn't matter who you picked. So it's a hard job. I would say that Bob Iger's personality has created enormous amounts of value, like the fact you could get George Lucas to sell Star Wars, Lucasfilm to him, or the fact that Steve Jobs was willing to sell Pixar to him. Bob Iger has created a lot of value because Fox, Rupert Murdoch was willing to sell $70 billion of assets to Disney and take shares in return, and mandated that Bob Iger stay longer because they were giving up, they were going to hold so many shares. So, I think people really do trust him as a business builder and as a high-integrity person. And so the new Bob is going to have to follow in those footsteps. And if he doesn't have the personality that the old Bob Iger did, he won't create as much value through that type of personality that the old Bob Iger did.
Hi, Laura. Maddie Doppler here. So that's my question for you. Where does the stock go from here, particularly for taking the chief of parks, which were going to be under pressure because of coronavirus? We know Shanghai's been closed and other properties in Asia. Where do you think the stock's going to go with this new leadership in this transition, especially if you're keeping those other leadership positions in place for the streaming and the content and direct-to-consumer entities?
I think shares fall, because Disney's EPS is under downward pressure because of losses at the Fox assets. Iger has told us he's going to go work on for 2 years, which implies it's worse than we think, that he needs 2 years to fix those, and because that Disney is investing in streaming. So EPS has been under pressure. What's held the stock up is that Bob Iger has this 15-year track record of creating value, so people are giving him the benefit of the doubt. Now, with him not in charge of the day-to-day operations any longer, you're going to have EPS under pressure still, but with a guy that's unproven in the top job, I think shares fall.
Laura Martin of Needham, thank you very much. We'll keep an eye on those shares. They are falling in today's session. Let's move on to some earnings reports now. Lowe's posted mixed fourth quarter results. The home improvement giant reporting a beat. Adjusted earnings per share were ahead of estimates. Sales, though, weaker than expected. And the company also provided a disappointing forecast. So we are looking at those shares under pressure. So even as we see market rally overall today, some of these companies, obviously out with specific news, are still seeing a little bit of pain. Same-store sales in particular up 2.5% versus the 3.6% that were estimated. When you look at a name like Lowe's and you look at it in the context of the sort of retail earnings we've gotten, Randy, what's your take on what we're seeing across retail?
Well, retail is an interesting space. Obviously, you have the traditional brick and mortar retail, which I think primarily Lowe's and Home Depot and those type of companies fall into. And then, of course, there's the Amazon and the other online entity. What's fascinating, I think, in the context of this coronavirus environment is that you actually might see online do a little bit better as long as they can control their inventory, because when people start to get worried about going out into public spaces, that includes retail, and they might be more inclined to stay home and purchase things online. On the other hand, we also have now historically low record interest rates, which we know will ultimately translate into mortgage rates, which will encourage people to buy more homes as opposed to go to Home Depot or Lowe's to buy materials to rehab their existing homes. And so you have all those sorts of dynamics. There's quite a few things that are impacting this.
You know, one of the things with Home Depot and with Lowe's that you always hear is in a downturn, in a slow economy, people are more inclined to do it themselves, so they go to Home Depot or Lowe's. And to the point you just made, with low interest rates, people want to do it, they might do it themselves. I focused on the same store sales number, 2.5% growth at Lowe's, but at Home Depot it was 5.3%. It beat, it surprised. How crucial do you think is the message that we're being sent about same store sales for both of these companies?
Well, competition for Lowe's was certainly one of the things that depressed their earnings report. But I want to pick up on a trend that you just mentioned, which is this notion of people refitting their homes in the time of an economic downturn. The problem that we have right now is the lack of housing stock that's available, particularly for first-time buyers. These boomers aren't moving out of their houses the way that they were anticipated to do so. That means there's less available for people to be buying. buying, which means there is more of this housing renovation, more people outfitting their homes than we would have expected at this point in the cycle, which will be interesting to see in the coming months. Lowe's and Home Depot both do benefit from that. So far, Lowe's is showing that they can't do so.
Let's move on to what's going on in clothing retail, sort of department stores, discount department stores. In this case, TJ Maxx's parent company, TJX, they reported a fourth quarter earnings and sales beat. Their same-store sales were up 6%, blowing past analysts' expectations. Remember that the company also owns HomeGoods, it owns Marshalls. All of those divisions reported same-store sales increases, and those shares are popping today. And this is an example of a company, TJ Maxx in particular, initially didn't have much of an online presence because it was betting on that sort of treasure hunt kind of aspect at the stores. And that still seems to be working for it. It really has consistently done better than a Macy's, for example.
Well, and the thing to keep in mind is that we had a very warm winter up until this point, so that has certainly helped fuel retail and those buyers going into the actual stores, where otherwise I think other pressures such as cold and flu season, bad weather, certainly the threat of coronavirus, if that materializes even more, will continue to depress those numbers. I think it's a wait and see right now. I think that warm winter certainly helped a lot of these retailers, but you're right, the transition for some of these retailers staying out of the online space has been interesting and been beneficial for some of these places that can really capitalize on that.
We're going to turn to politics because the Democratic presidential hopefuls, they're back on the campaign trail today in South Carolina. That's after a blistering debate that was big on attacks, but pretty light on substance, according to some viewers. Frontrunner Bernie Sanders, the target, clashing at one point with Mike Bloomberg over who was a better choice to beat President Trump.
Well, you're right. The economy is doing really great for people like Mr. Bloomberg and other billionaires.
Vladimir Putin thinks that Donald Trump should be president of the United States, and that's why Russia is helping you get elected, so you'll lose to him.
One of the things that was very interesting about this debate was the cheering, the booing that they allowed for the audience. There was a huge boo, actually, after Bernie Sanders made that billionaire comment to Michael Bloomberg.
There were some folks saying online that perhaps Bloomberg had some
stack the audience
help in the audience.
Yeah.
Who knows?
Look, does anyone pay attention? I mean, a lot of people watch these debates. We're still waiting for the ratings, but the one prior to this was a huge rating success. Do, other than the echo chambers, do people pay attention to this?
I think it's great political theater. Now, whether it has any impact on the economy or the markets right now, frankly, I don't think it does, to be quite honest with you. Really, if you look back to the 2016 election, the markets really didn't pay any attention until about September the 1st. Then you had quite a bit of market volatility leading up to the election, and of course we know what happened after that. I think, frankly, you'll see the same thing this year. Now, in the lack of any other news, including the coronavirus, you might see people pay a little more attention to it, but it's just far too early with that many different choices on the left side. There's no impact on the market or the economy.
So on the question of whether the debates matter, I am inclined to believe they don't. Bloomberg, of course, had a horrific performance the first debate, and his bump, he came down a couple percentage points off of that, had pretty much been erased by the time he moved into this debate. And remember, Bloomberg's whole strategy is to be on debate stages in states where he's not even on the ballot, right? He's not competing in South Carolina. He's looking at Super Tuesday, which is a week from yesterday. But who's counting? That is really what's going to determine the inertia of the race once we get past that Super Tuesday and see if Bloomberg can perform. Now, I do think it's interesting, the question of the stock market and how it's going to respond to this primary. I think right now the twin threats of coronavirus and Bernie Sanders are playing off one another. Without coronavirus threat, Bernie Sanders isn't seen as a serious contender. Without Bernie Sanders potentially taking over healthcare, you don't see as much of a stock market effect. So I'd keep watching that.
But I think it's important, though, to not just automatically assume that if Bernie Sanders gets the nomination that he can't win. Remember, no one expected Trump to win either. And Bernie Sanders in some ways has used a strategy similar to what Donald Trump used, and that is he is speaking to a large contingency of the population that has never had a voice. It's a completely different group than the ones that Trump spoke to, but he's speaking to the young, to the not wealthy, the both in many cases urban.
And I don't know that it's a completely different group, by the way.
There may be some crossover, but ultimately that strategy could very well work. I wouldn't say that it's. Just as likely as it is that Trump will get reelected, Bernie Sanders could very well be elected as well.
All right, we're going to talk more about this later, but coming up, wild swings on Wall Street, what high trading volume in the options market could mean for stocks and what it told us before we saw this big drop. Plus, no more sharing at Salesforce. What investors need to know as founder Mark Benioff takes over as the company's sole CEO.
Welcome back to On the Move. I'm Jared Blickery. We got stocks bouncing here. Dow is up 305 points. Nice change from the prior 2 days. And the S&P 500 up about 1.2%. And the NASDAQ up the most, 1.5%. Tech outperforming. Here's a look at the intraday price action. We gapped up and we're testing the highs right now. Over the last 5 days, though, we can see haven't made much of a dent in those losses just yet. Got to check out the VIX because that is still elevated. Although it is off the highs yesterday, it hit 30, which it hadn't hit in several months by now. And then the 10-year T-note yield is finally bouncing 2 basis points, not a lot, but we'll take it. Has been under pressure, down 55 basis points for the year. Also seeing the yield curve expand by 5 or 6 basis points. That's giving financials a bid. We've got to check out the 30-year too because that is still close to its record low, up 4 basis points there. And then the U.S. dollar index up again, and that is recovering some of the losses over the last few days. But if we look over the last basically month, we can see still elevated and threatening to go higher. Want to keep an eye on that. And then crude oil. Can't really catch a bid either. It's trading under $50, taking out those lows and threatening to go down to 46, which is the next support level. Here is our Dow heat map. Big change from yesterday. We see Microsoft up over 2% along with Apple. Visa in the same boat. Financials outperforming 1.5% for JP Morgan. Only 2 stocks to the downside. Walmart just barely. And then Disney down 0.75%. We're going to be right back.
So as stocks continue to sell off, investors are keeping an unusual option market volume. They're looking at option market volumes, looking for signals that we may be approaching correction territory. Randy, you've voiced concerns recently about the unusual option market volumes. And how do we as investors take what you've noticed, the pattern, and use it to our advantage?
Yeah, so what I noticed, which is highly, highly unusual, is we were hitting record option volume levels prior to the market pullback. That's extremely unusual. Big volumes on days like today or yesterday are very common. When the market goes into a correction or a pullback, it's real common to see volumes spike because people, first, they sell out of their profits as quickly as they can before they lose them. Secondly, they start putting on hedges to try to protect from further downside. And then third, the last thing they do is they step in and start bargain hunting, which we see that happening now. So all 3 of those things tend to drive volumes way high when you have a pullback. But we were at record high level volumes for the last couple of months prior to this, which is just unheard of. So what it told me was I started digging further into it and looking at things like the put-call ratios and the volumes on equity options, which has a very high retail component. And there were a lot of very troubling signs. So I've been putting out warnings for the last few weeks on this stuff, was that people were buying calls like crazy on the equity side, in the retail part of the market specifically, and leaving the upside open, as opposed to a lot of spread activity, which we typically see. So what that means was that people were not only bullish, they were bullish and they wanted to leave the upside completely open. That's just really to the point of irrational bullishness, frankly. And those are not things that cause pullbacks like we've had, but they make people a lot more vulnerable to getting hurt when we do get one that's caused by a black swan event like this virus.
So as you say, it's not unusual then when the selling happens to see the spikes in volume. So what are you seeing now, especially, now we've got a bounce back, at least for the moment. We'll see if it's as short-lived as yesterday's. And can that options activity tell us anything about a more sustained move in markets, or is it more useful as a short-term tool?
Well, definitely volume in options markets, as well as put-call ratios based on volume, which are driven by that, are very, very short-term, and they're very reactive to the market. So, for example, we went from like a 45 put-call ratio, which means there were people who were only buying or trading 45 puts for every 100 calls, to immediately like a 90 or a 95 the day the market starts going down, like yesterday. So those kinds of things are very, very short-term and very reactive. If you want to look at a longer-term thing, you have to look at put-call ratios that are based on open interest, which is total number of outstanding contracts. So far, we really haven't seen a huge shift there just yet. So long-term, people are still pretty much where they were.
And just a little translation for folks who are not as familiar with put and call ratios, right? A put is effectively a contract to sell a stock in the future. A call is to buy one. So puts are bearish, calls are bullish. In the most simple of terms. All right, let's move on to a corporate story that we're paying attention to. Just 18 months after taking the job, Salesforce's co-CEO Keith Block is stepping down. Co-founder Mark Benioff is now the sole CEO. Now, when Benioff sort of stepped aside, he was doing so in part so he could spend time on other things. He's been involved in local politics in San Francisco and housing efforts. But it is interesting that he's now stepping aside. The stock is down about 0.8%. And you have to wonder, when you have a sort of forceful founder like this who steps aside, is it just inevitable that they're going to come back?
Yeah, it was a weird experiment in corporate governance to begin with. Dan Roberts actually pointed out something interesting on Twitter yesterday about CEOs stepping down. I mean, you have the Disney news, you have Salesforce. I believe you had another big one yesterday that's escaping me. MasterCard as well. Yeah. So what was going on? Was it the companies were trying to bury their news in a down day on the market, hoping that they didn't have to take too many questions on it? Or was this long-term planning, as Disney was saying, that, you know, this has been in the works for a while? I'm not sure. Salesforce is an interesting question if they were trying to time the media specifically for this announcement, and what the thrust of the decision was. I don't think we know yet.
I'm going to throw the word conspiracy. Do you buy into a potential conspiracy theory that all these CEOs are bailing out? I mean, there is a natural, for instance, at MasterCard, he had been there almost 10 years. So.
And he's not leaving right away.
Right. Neither is Iger. So
I would be very cautious to say that. I think you'd have to dig into each individual story to know whether or not that's the case or not. I mean, certainly there's always an argument about stepping out when you're on top because the only place left to go is down. But some of these decisions that happen immediately, I don't think you just make the decision on the spur of the moment on a given day. Oh yeah, today I'm going to retire. I mean, those are things that take time. So I'd be very cautious about making that assumption.
Salesforce is hard too, right? Because of the breadth of the business. I mean,
it's a relatively new company too.
It's a relatively new company, but it's also got huge clients. I mean, Amazon, Toyota, these companies that are pretty much ubiquitous in consumer life. Salesforce has a piece of it. So the question is, what motivates Salesforce executive decisions? I'm not sure we can point to just one thing because of the nature of their business.
All right, well, coming up, crude awakening. Oil is hovering around $50 a barrel over the concern about demand. Plus, before we go to break, take a quick look at some of the biggest winners in the Dow today.
It's about 10:30 a.m. here in New York City, an hour into the trading day. Stocks are bouncing back, and the bounce is intact, at least for now, with all three major averages rising by more than 1%. Let's look at oil prices as well, because we are still seeing a decline, but it is a very small one. Right now, it's only 2 cents. 49.89 the barrel is where we stand. We'll talk about oil more in a moment. Moving beyond the burger, Beyond Meat scores a deal to serve its plant-based sausage at Starbucks. The college cheating scandal heats up. An heiress to the Hot Pocket fortune gets 5 months to cool off. And taking Sprouts off the menu, sandwich chain Jimmy John's receives a warning from the FDA. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Inez Ferre is on the floor of the New York Stock Exchange. And as you're watching the 10-year Treasury yield, where do we stand?
The 10-year Treasury yield, that's right, Adam, it is at 1.36%, bouncing back from those record lows from yesterday. And as Julie was just mentioning, this bounce back is really holding up right now. We're looking at the Dow that's up 380 points. All the sectors are in the green and being led higher by technology. And almost every Dow component also right now in the green, being led higher by Boeing. And I want to show you shares of Moderna. This is a biotech firm which went public back in 2018. The company reported mixed quarterly results, but that's not why you're seeing the stock in the green. Actually, yesterday, this stock was in the green, spiking yesterday despite the sell-off because the company had announced that its experimental vaccine was being sent to U.S. government researchers for the coronavirus, and trials of the vaccine could start as early as April. Now, it would take about a year for all the testing and approvals, but still, this Wall Street analysts have been weighing in on this development, with Oppenheimer writing a bullish note on Moderna, and also why you're seeing extended gains for the stock. Adam, Julie?
Inez, thanks very much. Let's also talk about what's going on with oil prices, because we've seen, as I mentioned a moment ago, a little bit of bouncing around here. It is not seeing the recovery that we are seeing in stocks today, as we are seeing persistent concerns over coronavirus and the effect it could have on demand. Joining us now from Chicago is Bubba Trading founder Todd Horowitz. Todd, it's good to see you. So as we see more of a risk-on tone today in this bounce back, why isn't oil participating?
Good morning, Julie. It's great to be back with you. Look, oil is under a little bit of pressure right here, and I think that, this 50 level, it got down to 48.99 overnight. It looks like 50 will hold a little bit, but I don't see it going past 54 anyways. So I think we're going to probably test the mid-40s. Listen, we have plenty of supply, and that hasn't changed. And of course, with the coronavirus, with the lack of flights to China, with the lack of shipping and everything else, it has cut down the usage, so that glut is going to grow. So it's going to be a supply issue pretty soon, because we are a net exporter and we cannot, we can't sell enough for what we're producing. So it can only lead prices lower. Now, at some point, they will find a real bottom and make another move. But again, I think the days of $80, $90, $100 crude are over anyway. So I think that we're in this range here, in probably 50 to 55 to 60s are the right numbers anyways. And we'll probably see some pullback here. And I'd say mid-40s, 45 would be a spot I'd look to be a buyer and look for a ride back up.
Okay, so Bubba, I'm curious, what advice would you give to an investor who's chasing a dividend yield? Because some of these the big oil companies, ExxonMobil, just before we came into the segment, they've got a dividend yield that's about 6%. You've got Chevron, I think, it's at 5%, BP, 7.5%. What warnings or advice would you give to the investors who get seduced by those yields?
Hi, Adam. Listen, I think that if you're a long-term investor, you have a different point of view of what's going on in the market. Again, long-term investing, I don't even look at my long-term account. I'm always 100% long the market, and I use a hedging strategy, but that's besides the point. Even if I wasn't, being long the market has proven over 150 years to be the right strategy. So you're getting those dividends. If you don't worry and look at your iPhone every 5 minutes for the peaks and valleys of the market, you'll be fine. There's going to be a pullback here. There's going to be a big sell-off in markets in general. But at the end of the day, we always end up, on average, for the history of the markets, 8 to 8.5% higher. So I think if you put away everything and just let the markets trade, and then they will come back and show you. I mean, Exxon's not going out of business. Chevron's not going out of business. I wouldn't do anything with those companies. I continue to collect the dividend, and if I need the money, I'd put it in my pocket. If I need it, or I would just let it reinvest back in the stock. I think investors have to look at this market right now today, or over the last few days. It's a completely different animal. Be patient, be cautious, and just don't panic and sell out when it's something you want to own anyways. I think that's the view people have to take.
And you gave us a kind of metric to look at, the $45 base for WTI. But I'm curious, at what point does oil demand is what, 100 million barrels every day worldwide. It is still growing despite all of the headwinds, despite environmental movements. At what point do we see that changing? Is that years and years away?
You know, it's been, as long as big oil kind of controls a lot of things around here, you know, we should be far past this already based on technology, based on everything else we do. So I think one day you're going to wake up and you're going to find out that, well, you know what, we don't need as much oil. We figured out a way to use sun better. We figured out a way to use wind better. And we've got other areas to use. I mean, so again, I think, but as long as big oil stays in control, you know, that's one of the things that I think has been one of the issues for many, many years. And as they try to develop other types of sources of energy, I think we're going to continue to stay somewhere around here. But eventually, I do think you will see, you know, not the end of big oil, but I think you'll see the end of this major usage in these 50s. I would certainly expect, you know, many, many years from now, oil to be much lower than it is today. But that's, again, that's based on we get some alternative energy going, and the technology should be there. But it's not, they're not using it yet because, of course, the oil companies, like the tobacco companies, when they had their issues, haven't figured out that alternative income stream yet, so they're still working on it.
Bubba Trading founder Todd Horowitz, always good to see you.
Thank you very much, Adam and Julie. Appreciate it.
Coming up, beyond breakfast, Starbucks embraces the plant-based meat craze. Plus, before we go to break, let's take a quick look at some of the top trending tickers on Yahoo Finance today. With that CEO announcement, Disney shares top the list. Let's take a look at two stocks making big moves this morning. We've got Fiat Chrysler, FCAU. Those shares are on the upside. Now, the company itself didn't report anything, but the company that is in the process of trying to acquire it, PSA, reported its earnings. That's, of course, the parent of Peugeot. PSA Group profitability rose to a record in 2019. However, it did forecast falling sales in Europe this year. The CEO of PSA said he does not see any regulatory hurdles to its deal with Fiat Chrysler, getting done. So that's perhaps one of the things that's boosting those shares. On the downside, we're taking a look at Smile Direct Club. Those shares are falling very sharply after it reported a 25-cent loss versus the 11-cent loss that analysts were predicting. Revenue rose 53%, but that too was slightly light of analysts' predictions as well. And the pace of revenue growth is going to slow further this year. So a big negative for those Smile Direct shares.
You almost imagine the Federal Reserve doing the old Mad magazine, what, me worry? The Federal Reserve's wait-and-see attitude on interest rates this election year, it's being tested. Alexis Christoforous is here to break down details for us in today's Morning Call. Alexis.
Well, Adam, the Fed has clearly indicated that it wants to keep interest rates steady this election year after navigating both a trade war and a global downturn in 2019. Top Fed officials say it's simply too soon to determine the full economic impact of the coronavirus, but it certainly does complicate things for central bankers. Fed Vice Chair Richard Clarida said yesterday during a speech in Washington, D.C., that monetary policy is not on a preset course and decisions on interest rates will be made on a meeting-by-meeting basis. Now, Clarida went on to say that the disruptions from the outbreak in China could spill over to the rest of the global economy, but it's still too soon to even speculate about either the size or the persistence of these effects or whether they will lead to a material change in the outlook. Clarida said the Fed does not set policy based on day-to-day market movements. Instead, policymakers look at whether broad and sustained changes in the markets impact things like business and consumer confidence, as well as household health. But now the U.S. stock market has given back all of its gains for the year, and a growing number of investors are betting on an interest rate cut from the Fed sooner rather than later. In fact, Fed funds futures contracts show a 1 in 3 chance the Fed cuts rates at its next meeting March 17th and 18th. A week ago, that probability was about 1 in 10. There is some talk of a possible emergency meeting. The former Minneapolis Fed president wrote an op-ed in Bloomberg on Monday arguing for the Fed to hold an emergency meeting and enact a 25, even 50 basis point cut in rates to hedge the U.S. economic impact of the virus. We should note no one currently inside the Fed is calling for such an emergency meeting. Adam and Julie?
Thanks, Alexis. Appreciate it. Beyond Meat is making its way to Starbucks now. The coffee giant announced today that it will add a Beyond Meat cheddar and egg sandwich to more than 1,400 Canadian stores beginning March 3rd. The plant-based meat company expected to report its latest quarterly earnings on Thursday after the bell. Here to break down the details is CFRA analyst Arun Sundaram. Thank you so much for joining us, Arun. So how big of a deal is this for Beyond Meat? We've heard these various other chains partnering either with Beyond or mostly also with its competitor Impossible. That's its main competitor, I guess. So how significant is this particular win for it?
Yeah, I mean, this news is certainly a positive for Beyond Meat and really the entire plant-based category if you look at it. But it's important to note that this partnership with Starbucks is not that surprising. You know, Starbucks had previously stated that it was going to introduce more plant-based products this year. And, you know, given the recent success you saw with Beyond's partnership with Dunkin', it only makes sense that Starbucks launches a competing product. As you know, late last year, Dunkin' expanded its Beyond sausage sandwich to all of its U.S. stores. But again, it's important to note that this partnership with Starbucks is still a limited partnership. We've seen these so-called pilot programs not work out for Beyond Meat in the past. One example is Tim Hortons, where just last month, Tim Hortons pulled all of its Beyond Meat products out of its stores in Canada. But we think things could be different for Starbucks. We think they can have a lot more success with Starbucks.
So there's a lot of craze for imitation meat or fake meat, depending how you want to describe it. But you also warn your clients that this is a risky, stock, these stocks in general, to look at these imitation meats. Why is that, especially if we go into an economic slowdown?
Yeah, that's exactly it. Because, as you know, these alternative meat products, their price point is at a premium to traditional meat products. And for the most part, these products are competing on the shelves directly next to the refrigerated traditional meat products. So we think if there is an economic downturn in the near future, consumers will have less discretionary income, meaning these alternative meat products could be more significantly impacted in terms of consumption trends than traditional meat products.
Arun, talk to us about the supply chain issues that these companies have had. Pea protein apparently is not in huge supply, and that has created some bottlenecks for some of these companies that make this stuff. Are we going to hear Beyond talk about that when it reports earnings? Is that going to be something that could put a cap on some of its growth?
Yeah, exactly. So as you may know, in the past, Beyond Meat had some supply issues, had some trouble meeting customer demand, customer orders, but they've since fixed those issues. And now they're really focused on adding capacity so they can avoid these issues in the future. But yeah, I think tomorrow, one of the big focus points is going to be capacity constraints and how much additional capacity that they're going to bring in. That's something that they typically talk about on a quarterly basis. I think last quarter, they mentioned that they significantly increased capacity. We estimate that Beyond has the capacity currently to generate about $1 billion, a little bit of $1 billion in sales. And this year, we're projecting just a little under $300 million in sales. So we still think there's some capacity room, but that's something that is going to need to be addressed going into the future as more of these partnerships expand.
Hi, Arun. Maddie Doppler here. So supply chains have been all the rage right now because of the trade tensions that the United States has been suffering, mostly with China, but with other trading partners as well. So is Beyond mostly exposed to those trade tensions? Is it possible? Is that something that we're going to see show up when we're talking about how much room there is for growth for these companies?
Yeah, so I mean, so both Beyond and Impossible Foods has talked about expanding into the Asia market, specifically China. Maybe late this year, early next year. But more than a supply issue, we think that the market right now for alternative meat is very attractive in China and Asia. As you know, from this coronavirus, there's a lot of negative sentiment right now in the wet meat market in China. So meaning that there could be a little bit more demand for these alternative protein products that don't necessarily have the same kind of health concerns that you see with some of the fresh meat right now.
Arun Sundaram of CFRA, thank you. Appreciate it.
Before we go to break, we want you to take a look at stocks. We are bouncing back. Long way to go still, but look at that. The Dow is up almost 1.7%, up 442 points. S&P 500 and NASDAQ are also climbing higher today. Coming up, the Hot Pockets heiress landed in hot water thanks to the college admissions cheating scandal, and now she's heading to jail. Plus, the House of Mouse chooses Impossible Foods to be its preferred meat substitute. The grandfather charged in the accidental death of his 18-month-old granddaughter who fell from the upper deck of a cruise ship will change his plea. Salvatore Anello will now plead guilty to a charge of negligent homicide. Anello had lifted the infant to a window so she could bang on the glass, but she slipped from his hands. Michelle Genovese, the heir to the Hot Pockets fortune, was sentenced to 5 months in prison after pleading guilty to charges related to the National College entrance cheating scandal. Genovese paid $300,000 in bribes to help her daughters win admissions to universities. She was ordered to also pay a $250,000 fine. The FDA sent a letter to Jimmy John's sandwich chain warning it that vegetables used in some of their sandwiches are linked to 5 outbreaks of E. coli or salmonella over the last 7 years. The letter accuses the chain of selling, this is a quote, adulterated fresh produce, specifically clover sprouts and cucumbers. Jimmy John's CEO told CNN food safety is a top priority, and they have removed sprouts from the menu. Impossible Foods scored a big contract yesterday with the announcement that makes Impossible the preferred plant-based burger served at Walt Disney World Resort and Disneyland Resort and Disney Cruise Line. Disney expanded its vegan menu offerings last year. Disney's head chef says it is a game changer because the Impossible meat substitute has the flavor and texture Disney customers want.
So one for Beyond, one for Impossible today. All right, it's time for Word on the Street, where we check in with our panelists and find out what stories they're watching. Randy, we've been talking about the snapback today. You're watching healthcare stocks in particular as one area to watch potentially. Why?
Well, healthcare is the one sector we've had an outperform on for the longest time. And part of the reason for that is that it is one of the few sectors that has not become overpriced in terms of valuation. It's been a bit of an underperformer. And I think there's been a conventional wisdom out there, or maybe just a belief that everything that's going on with regard to politics is going to be a net negative for healthcare. That may not be true. I'm a baby boomer. I'm a big demographic, and we're all getting older and living longer. So if you just look at it in a real broad sense, the healthcare industry has a lot more customers now. And ultimately, even if you were to get someone like, say, a Bernie Sanders elected, and the House and Senate both became Democratic and they were able to pass universal health care, well, now all of a sudden, maybe that's negative for the industry of the insurers, but it certainly wouldn't be a negative for the people who run hospitals, for the pharmaceutical industry, for the doctors. All of them would have more customers. So I don't think that wisdom that it's always negative is necessarily true.
Glad you brought up healthcare, because it was a little itty bitty bit of the discussion with Larry David. No, Bernie Sanders. USA.
And since this is my lot in life, Adam, I will point out once again that the promises that are being made on the Democratic primary stage are not ones that can be fulfilled the way that most of these Democrats are talking about. Now, last night, I missed Andrew Yang. Anyone else? Because they talked a lot about math and about how things are going to add up. But because the primary stage is still so big, none of these candidates get pinned down on what their plans will actually cost. I just want to make one argument about Bernie Sanders. Yes, maybe he wants Medicare for all, and that would be great for portions of the healthcare industry, but he can't pay for it based on the taxes that he's proposing. And Bernie Sanders, too, wants to talk a lot about how all these other countries have some kind of universal healthcare. Why can't we have it as well? Well, those other countries don't pay for their plans the way Bernie's talking about paying for his plan. He says the wealthy and corporations will pay for it. In Scandinavian countries, you've got an income tax for middle-income earners that's above 50%, and a VAT, a value-added tax, that adds 25% to the cost of every purchase. That's the way we'd have to look at financing something here. You can agree with the goals that Bernie Sanders has put out for his presidential campaign, but you got to have the math that adds up to.
Well, didn't he say that he wanted to cut defense spending to help pay for it?
So he wants to cut defense spending by about $1.5 trillion. The defense budget's $7 trillion over the next 10 years. That's not even going to get you close. Medicare for all is going to cost anywhere from $30 to $60 trillion. So that's it. A couple trillion here, a couple trillion there. All of a sudden, you're talking real money. But cutting defense spending, I think, certainly is something that can create a coalition for fiscal conservatives and for the left out there. That has been a long-standing coalition that hasn't gotten a lot of progress in Congress and in Washington, D.C., but it doesn't get you even anywhere close to paying for some of these proposals.
Let's not forget any fiscal conservatives left.
Let's not forget what a presidential candidate promises and what he or she can actually get enacted are two entirely different things.
Yep.
Most of these healthcare proposals, especially the ones that are most radical, have no chance at all unless you have a single party controlling the House, the Senate, and the presidency.
Remember, when we had a single party controlling the House, Senate, and
they
the
couldn't
White
pass
House,
it.
they still couldn't get a public option done.
And on that note, Apple, because an apple a day keeps the doctor away. Anyway, Apple holds its annual shareholder meeting today. What that company could reveal about coronavirus and the impact on smartphone business. Plus, dramatic shakeup at Disney, why longtime CEO Bob Iger says the time is right to call it quits.
It's about 11 a.m. here in New York City, 90 minutes into the trading day. Stocks are following a massive two-day sell-off with a bounce as fears over the coronavirus outbreak escalates. Stocks are bouncing. Let's take a look at the 10-year Treasury yield as well here today. There, too, we are seeing a bounce, but it's a pretty minuscule one, only 2 basis points, still at 1.35%, so still within spitting distance of that record low for the 10-year. The coronavirus will be at the forefront of Apple's shareholder meeting today amid growing concerns of the impact the crisis will have on the company's supply chain. We're going to take you to Cupertino straight ahead. And Tesla trouble. The NTSB calls on the company to improve the safety of its automated driving technology. Welcome to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Joining us for the next 30 minutes, we have Schwab Center for Financial Research Vice President Randy Federick and National Taxpayers Union Senior Fellow Maddie Duppler. But right now, we want to talk about your investments and the markets. Inez Ferre is on the floor of the New York Stock Exchange. And Inez, markets in the green and doing a lot better than the last time we checked with you.
Adam, that's right. We're looking at the Dow that's up 340 points. The S&P's up 41 points. The NASDAQ also in the green. All the sectors right now are in the green. Even energy, which yesterday was the biggest laggard. These sectors are all now in the green with technology. Technology's leading the gains right now. And if we just take a look at some of the Dow components that are leading, you're looking at Boeing at the top of the list, the top performer, Boeing up more than 3%. Yesterday, it actually closed at 304. Also, United Technologies, Apple, which has really gotten hit over the sell-off in the last couple of days. Apple is one of the leaders as well. 3M, Pfizer, and Microsoft. Big tech really got hit during the sell-off. Microsoft today in the green.
I saw it, yeah.
Thanks, Inez. Investors, of course, are also still talking about this strong warning about coronavirus from the CDC yesterday. A top official there asking the public to prepare for the expectation that this might be bad. Joining us with more is Anjali Kamlani. Anjali, after we got this warning yesterday, we saw stocks take another leg lower. We seem to be recovering, but nonetheless, there's a lot of talk about these dire language that they used.
Absolutely. I think one of the things to keep in mind, as you mentioned earlier, there is, some recovery as we're still worried about the virus. The officials seem to have sort of mixed messages. There was a strong showing from health officials yesterday. Meanwhile, President Trump has been tweeting that everything is okay and under control. So we are going to be expecting, some news from that and some sort of reconciliation on that message later today with that 6 p.m. press conference. But yesterday, Health Secretary Alexis did mention that this is not something new. The idea that the virus could in fact be spreading to the U.S. is not something that is unexpected. So listen to what he had to say yesterday.
We don't want people surprised if they see more cases here in the United States. That's an important part of transparency. People shouldn't panic when they see new cases. They should know their government predicted we would have them, and we have plans in place.
So as you can hear, it's something that they're really trying to get the message out for transparency's sake, and that's something he reiterated over again. Meanwhile, we are watching, as the pharmaceutical industry is also, really playing a key role here right now in terms of trying to find the vaccine or a treatment that could work in time to respond to this outbreak globally. We know the numbers right now, more than 81,000 cases, more than 2,700 deaths, still largely in China and in South Korea, even though China has seen that recovery, and then those isolated cases across Europe. Of note right now, Moderna yesterday, with its note on shipping a vaccine to the National Institute of Health was, really interesting. We're gonna keep an eye on just where, some of these stocks land up. Adam and Julie, back to you.
Anjali, thank you. Apple investors are also keeping a close eye on coronavirus. Dan Howley is in California for Apple's annual shareholder meeting and joins us with the latest. So what do the people you've talked to expect to hear from Tim Cook and company?
Yeah, they're essentially going to try to cover whether or not we'll see the continued impact of the coronavirus in quarters going forward outside of what the company has already said about Q2 2020. You remember that Apple had sent out an investor letter saying that they were going to miss revenue guidance for Q2. They did not offer revised guidance, which leads you to believe that it could be off significantly. And this all has to do with the factory shutdowns in China as a result of the coronavirus, as well as the fact that stores were closed in China, so consumers there couldn't get products even if they wanted to. The stores have opened up. Factories are respooling and getting back up to speed, but not quite as fast as may have originally been predicted. So that's really where the concern is. There's a few resolutions in front of the board, adding another director from public shareholders, as well as where Apple stands on freedom of expression. That relates to its operation in China and whether or not apps can be able to be taken down as a result of Chinese law. Now, Apple opposes both of those, saying that another director would simply mar the process of voting because they have such a small board already, and that they have to comply with laws in every area as it relates to China. And they believe that having their products allows them to offer greater privacy to users than not being in that area. So those are some of the resolutions that are up for vote. Again, Apple opposing both of them, but really what we're expecting to hear is how well the company has been doing and what they expect to see going forward in the future as it relates to the actual business of Apple. There is every once in a while a little tiny tidbit of news related to products. Last year, Tim Cook had discussed the Apple Watch as well as AirPods, saying how they were almost as iconic now as the EarPods. Those were the original wired headphones you had from the iPod, so we may hear some tidbits along those lines as well.
I know you get excited about that stuff. Dan Howley, we're going to check back in with you in a bit. I'm going to go to the panel and talk about not so much the product or the shareholder proposals, but the coronavirus impact, because obviously that was big, not just for Apple, but for the overall market. How much of a weight do you expect this to be on these individual companies?
Well, in Q1, it's definitely going to be a challenge. And I think if you look at companies, Apple, and another example that comes up to mind is Nike. These are two companies that not only produce a lot in China, but also sell a lot. Yeah. Mm-hmm. If I'm not mistaken, last time I checked, 15% of Apple's retail sales were in China, 17% of Nike's. So they're getting hit on both sides for sure. For the most part, up until now, I think most people have seen this as a Q1 issue, but we're only 4 weeks from starting Q2. It almost certainly seems like it's going to spill into that. So it's not going to be, unfortunately, just a one-quarter hiccup, I don't think.
And of course, as it spreads around the globe, also, it's problematic.
Yeah. But the other factor, though, is that so much of the parts and the components that go into the phone are in the coronavirus hotspots.
Right.
So can Tim Cook say anything? I mean, the bottom line for someone as powerful as Tim Cook and the rest of the world is they don't know.
They don't know, but I would say that retailers like Apple are not necessarily a harbinger for how coronavirus is going to play out across the globe. The real economic impact is in services industries, places where you can't make that revenue back up. Someone who's going to order an iPhone is going to order that iPhone regardless of if they have to wait 4 weeks or 6 weeks for it, right? Like those sales will still probably be made up, even if there's less traffic in these Asian properties. We're still going to see probably a Q2 or a Q3 bounce back. The airlines, the casinos, the cruises, those are where you're really going to see a hit because you're not going to retake the trip that you had scheduled for several weeks during the Chinese Lunar New Year that you now can't take because that time has passed. I would keep an eye on those properties more than I would on a Nike or an Apple, where I really think they will be able to make up the slack.
And that's why I think it's important to drill down into individual companies, because you're right. You don't go to dinner twice next week because you missed it this week.
Right.
But if you needed an Apple product, you wait a month or two, you go then. And so is it a consumable product or is it a durable good? If it's a durable good, chances are it can be made up in Q2. And you could see an enormous rebound, maybe not in Q2, but potentially in Q3. But not for those consumables where they just pass on that.
Keep in mind the timing of this, right? All of this is against the election backstop. So if this ends up being an end of Q2, beginning of Q3 story, that lines up nicely for President Trump, his reelection, for good economic numbers, even if they're somewhat superficial because they're a bounce back from the coronavirus earlier in the year.
All right, you get the last word on that. Bob Iger's exit from Disney is well-timed with the continuing spread of the coronavirus. According to our next guest, who says Iger's early departure will now allow him to focus on Disney streaming content instead of being burdened with managing the impact of the virus on park attendants. Joining us now is Bernie McTernan, Rosenblatt Securities Vice President. And Bernie, so it's a good time for Iger to maybe check out, but it puts a lot of pressure on Mr. Chapek.
Well, it's not checking out, though, is the thing. So he's stepping down as CEO, but he's still the chairman of the company. Bob Chapek is still going to be reporting to Bob Iger. So he's still going to be with the company for 22 months. And it's really resource allocation. And this is going to allow Bob to move off from the day-to-day, which could be becoming more burdensome because of the coronavirus as that continues to spread, and focus on what he does best, and that's content creation. And content is the lifeblood of Disney. And they're at a very interesting time with the launch of Disney Plus, the end of the most recent Star Wars trilogy, the end of Iron Man, and just acquiring these Fox assets where you can restart some of those franchises and Disneyize them.
Bernie, I want to take a beat to ask you about how this was all managed, because there are a lot of reports that people inside the company weren't necessarily aware this was happening. It felt rushed when it came out in terms of them scheduling the conference call quickly to talk about it with analysts like yourself. So what do you make? I mean, Bob Iger's supposed to be this amazing leader of this company. It doesn't seem like this follows in the narrative of that leadership to have this announcement happen like it did.
So it certainly felt sudden to us. And just from speaking with the company, if the board voted and they unanimously decided that Bob Chapek would be his successor, so let's move quickly. The question is, did something with the coronavirus kind of spur the board to move more quickly? Potentially, we're not sure. They're having another investor meeting tomorrow, actually, that we'll be at, so hoping to learn more there. But Bob Iger generated tremendous shareholder returns, made some great acquisitions along the way that's really setting up Disney for that next decade. So I think his legacy, and hopefully the legacy over the next 22 months, will be setting up that next decade of content, so it's more to look forward to.
What's the question you would ask at that meeting?
I think it's where he's going to spend his time. And
Where Iger
Bob Iger will spend his time.
And is Kevin Mayer going to let him? Well, he doesn't have a choice, but
it seems from the Bob Chapek point of view, it will be kind of just moving forward with the continuation of the Bob Iger strategy, especially through the end of 21, which is Bob Iger's contract ends. And so, where is Iger going to spend his time? What franchises from Fox are they going to reset? We know the Planet of the Apes is going to be early on, but where else? What else can he push? And what can he supercharge by giving this greater focus?
So it's a weird time at parks, though, right? I mean, they've been raising prices, which seems somewhat inelastic because people are still going to the parks. You mentioned the coronavirus pressure that is certainly on those enterprises. So how does this play when you have the guy who's in charge of those decisions moving over into the chief executive role at a time, as you mentioned, content is king?
Yeah, so pricing power has been the story of the parks for years now. They really went to a more demand-based pricing model and increasing prices on parks at really the peak times. And that should continue to play out. And really, hopefully, at this time next year, we're looking at coronavirus as more of a transitory issue. We estimate that every day that Disney World and Disneyland are shut down, it's about 2.5 cents of earnings per day. But thing is, even though China's been closed for a month, they don't like to close Disneyland and Disney World. Over the last 20 years, Disney World has been closed for less than 10 days, and that's all hurricane related in 9/11. So it's not, the shutdown isn't taken lightly. And granted, this is kind of that, in the black swan event where we're just not sure.
Let me ask you a question. So who's taking over the parks? Do we know yet? And what's the strategy there?
So that's a good point. I think Bob Chapek will still be heavily involved, but we're not sure who's going to be replacing him as the chairman. They just promoted a lady to the head of the U.S. parks, which I'm blanking her name, but I think Bob Chapek will still be heavily involved, especially over these next 22 months where Bob Iger is still the chairman.
Bernie, good to see you. Thanks for coming
Thanks
in.
for
Bernie
having me.
McTernan of Rosenblatt. Appreciate it. Well, Tesla needs to do more to improve the safety of its self-driving cars. That's the verdict from the National Transportation Safety Board following an investigation into the fatal crash of a distracted Tesla driver 2 years ago. That driver was playing a game on his smartphone when his Model X crashed into a highway barrier. Joining us now, Yahoo Finance's Pras Subramanian. And Pras, the NTSB also saying regulators need to step in some way. But this, again, seems to show that autonomous driving is just not as mature as perhaps the promises said it was.
Right. I mean, you have it's a combination of, like you said, driver error, but also, Tesla overhyping maybe their autopilot system. They're criticized for, not monitoring the drivers as much as they should. Cadillac Super Cruise has a camera that watches your face, so you kind of know when you're kind of moving around. But so it's a combination.
Looking at your phone and playing a game?
Yeah, I mean, the guy's playing a game. I mean, what do you expect to happen if you have a semi-autonomous system that's not always keeping track of things?
I'm glad you say semi-autonomous. I'm going to call out my older brother in Atlanta, who's not watching. He's got a Tesla, loves his cars, had a couple of them. Mm-hmm. And he picked me up at the airport and he said, look, and he took his hands off the wheel. And I was yelling at him. I said, you're not supposed to do this. Yeah. I mean, it's semi-autonomous. And I believe Tesla had told people like my brother and the other drivers is you have to still pay attention. You still have to be ready to grasp the wheel.
Well, even calling it autopilot is a little bit misleading.
Yeah, that in and of itself is sort of giving me the impression that you can just sort of sit back and relax. I mean, they've added more, monitoring of like keeping your hands on the wheel, things like that. Rick Newman and I tested the Model 3 last year with the autopilot system. It's been upgraded since then, but we were still driving around, 2-lane highways, and sometimes that it wouldn't turn all the way around the curb. Like you had to kind of nudge it. So there's still a long way to go in terms of like following lane traffic and also avoiding barriers. And
autonomy has 5 levels, and I think we're only at level 3 at this point. We got to get to level 5 autonomous before it's fully functional on its own, right?
Well, it's because when Musk talks about end of 2019, in 2020 we'll have full you can just let the car drive itself. That's not happening.
Yeah,
he's such a weird CEO. Why would you set that expectation? Right? I mean, when we're seeing the problems they have right
now. He likes to set up the shorts. So.
Yeah, right, exactly.
I mean, I think if you're Musk, you're thinking to yourself, I just want to keep pushing as much as I can, as fast as I can. That's how my company goes forward. Look at the stock price.
But now he's getting pushed back by the regulators. So are we indeed going to see some sort of regulation from the NTSB, whether it's, put more warnings on these things, maybe call it something different so it's not misleading? I mean, what does that look like?
And the other problem we have in D.C. is it's an infrastructure problem, right? All of these systems are supposed to be built on 5G, which we don't have yet. So the regulators essentially are searching for more faculties in order to regulate when these companies are building on incomplete systems to begin with.
I mean, I think with NTSB's initial recommendations are the Tesla needs to monitor their drivers better. That's first and foremost. And then limit the use of the automated systems where so GM Super Cruise is only on highways, only on interstate highways. Tesla, you can use it at any time.
Yeah.
So that's problematic when you're in a 2-lane highway or even possibly in a semi-urban setting too. So.
New York City streets, no thank you.
No,
All right,
no,
Pras,
no.
thank you. Coming up, a bounce or a real rebound. Stocks are on the rise as Wall Street tries to climb a so-called wall of worry surrounding the coronavirus. Plus, before we go to break, take a look at some of the most active stocks by volume on Yahoo Finance today. Ford, interestingly, topping the list.
Welcome back to On the Move. I'm Jared Blickery. We got stocks extending their gains. The Dow is closing in on being positive 400 points. Market reversal from the last 2 days, up 1.4%. S&P up the same amount. And we'll check out the intraday price action, kind of building on gains over the last hour, trending slightly up. But again, over the last 5 days, just making a small dent in that decline that we saw. Also, the Russell 2000 is up 0.8%, so kind of underperforming the others, but it is up. And we see the VIX is slightly down now to 25.3. It did hit 30 yesterday. That's an important threshold to watch. And then we got to check out bonds because the 10-year T-note yield is still up 2 basis points, had been up 4 basis points, but importantly, the yield curve is expanding. The 2s10s is up about 3 or 4 basis points right now. And then we got a crude oil inventory report. Should have been bullish, but we got a very mild reaction. This bounce right here. Now, we did dip below 50, which is support, but coming down and testing those lows right now. We'll be back in a minute.
Global markets took a hit this week on fear of the coronavirus outbreak. We're seeing U.S. stocks rebound today, and our next guest says despite the volatility this week, there is still an 85% probability of positive total returns in global markets. Joining us now is Riverfront Investment Group Senior Portfolio Manager Rebecca Felton. It's good to have you here. Did we get that right? An 85% probability that in December of this year, we're going to have a discussion and we're going to be thumbs up about it?
Well, that is what we published in our Outlook, which came out a few weeks ago. And frankly, the headlines, while frightening and very tragic around COVID-19, we still don't really have anything different to hang our hat on from a fundamental economic basis. So if you're looking at it strictly from fundamentals and what we know that we can measure, we are still in the optimistic camp.
So what data are you looking for then that will give you more information on this front? I mean, certainly we have more information on the corporate front, anecdotally with various companies coming out and discussing its effect on their outlooks. We haven't yet necessarily seen it in the U.S. economic data. So what's going to be the point you're looking for?
Well, we're still monitoring the housing, markets, and certainly the housing numbers this morning were good. And the consumer is still 70% of U.S. GDP. So that is a very strong signal, in our opinion, that the consumer is bullish, because what more bullish signal could you send than a long-term purchase such as a home? And of course, the knock-on effects that could potentially come from that. No. But again, if you think about where we were last week, we don't have anything that has fundamentally changed that would cause us to necessarily change our outlook long-term. Our tactical rules are still in place in terms of an accommodative central bank. The 200-day trend is still rising at a probably 18% clip. And investor sentiment, which was quite optimistic last week, is now back down into more neutral territory, which is positive over the near term. Now, I think certainly we have to think about each individual investor's risk tolerance and time horizon, but longer term, still positive.
So let's build out, though, on your thesis about household formation, because millennials are now buying homes, and we've already seen, I know Lowe's missed, but we still saw same-store sales at Lowe's up 6%, and Home Depot same-store sales were up 5.3%. So that's kind of what you're talking about, the spillover, especially as the millennials start buying.
Yes, and Gen Z behind them. The surveys have shown as well that 86% of them rate homeownership as a huge positive and a goal for them. So that backlog, if you will, demographically of folks wanting to own homes will continue, we believe, for a long time. And with mortgage rates being at these low levels, it's really easy to envision that.
Rebecca, this is Randy Frederick. I have a question for you. So the coronavirus almost certainly could cause negative GDP globally in Q1. If that spills over into Q2 and we have 2 consecutive quarters, which would be classified technically as a recession, would that cause you to change your outlook for the year?
Well, I think then we would have more solid fundamental data to hang our hats on, and I think we would have to revisit. But I would also come back to the fact that it's going to depend on investor time horizons. Are you looking at 5 years, 10 years, and what is your, your downside volatility appetite? So I think it's going to be unique to each investor, but from our perspective, I agree with you that if you have that kind of ongoing concerns going into Q2, that you would have to revisit.
Well, thank you very much. Riverfront Investment Group Senior Portfolio Manager Rebecca Felton. Good to have you here.
Thank you all so much.
Let's turn our attention overseas now. Coronavirus took European stocks on a rocky ride this week as reported cases in Italy grew to over 320. Let's go to London now. Yahoo Finance's Oscar Williams-Groot has the details for us. Oscar, effect on the markets there, and there too you're hearing from more companies talking about the effect.
Well, that's right. It's been a very volatile session here in Europe today, really a tale of 2 sessions, the morning and the afternoon. The Stoxx 600, which tracks the 600 biggest stocks across the European continent, was down as much as 3% this morning. Now it's trading flat. That's been mirrored across most major stock indices in Europe. What's changed? Well, it's all to do with you guys over there. The US opening higher has spurred some brave investors to go out and try and catch some knives, looking for bargains after the steep sell-off that we saw on Monday and Tuesday. Remember, even though the sell-off has stopped today, the FTSE 100, for example, has still shed £100 billion in value since last Friday. So there could be some bargains out there. As you said, we've also had companies updating on the effects of coronavirus on their business. The chief among them today was Diageo, the spirit group that owns the likes of Johnnie Walker Whiskey and Gordon's Gin. They said today that the impact in China alone means that sales from the region will be between 225 million and 325 million lower than previously forecast this year. Elsewhere, Chevron, the oil giant, they've actually sent staff in London home. 300 staff have been sent home after one employee came down with flu-like symptoms. They're concerned that could be the coronavirus as they've been travelling abroad. And finally, SSP, another UK-listed company, they run franchises for things like Burger King and Starbucks in airports and railway stations. They said today that the slowdown in Asia due to coronavirus has led to revenues that are lower 10 to 12 million pounds in just 1 month, February. So that could get a whole lot worse for them. But a lot of companies here are starting to feel the effect in a very big way.
Oscar, thank you very much. And we want to thank also Maddie Doppler and Randy Frederick for being here with us. Coming up, it's The Economy Stupid, how President Trump's economy compares to the 90s boom under President Clinton. Plus, ready for takeoff, we will speak to Virgin Galactic CEO George Whitesides about soaring demand and the future of space travel. All right, coming up just after 11:30 here in New York City, 2 hours into the trading day, stocks are trading higher. The 10-year Treasury yield has also started to climb. Take a look at that. It is now at 1.34% after hitting a record low yesterday. Taking a bite out of the apple, why the coronavirus could hurt the company's revenue in the next quarter. Presidential Fight Club. Trump claims the economy has never been better, but does his math add up when we compare him to Obama and Clinton? We're going to break it down. And Virgin Galactic missed earnings estimates in the latest quarter. We're going to talk to the CEO about the company's plans straight ahead to get back into space. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. I also want to introduce our panel for the next 90 minutes. Rutgers University professor Bill Rogers is with us, as well as Direction Managing Director Dave Mazza. Good to see both of you guys today.
Thanks.
Well, the 2020 presidential election fast approaching, of course, and voters are becoming increasingly concerned over tech companies' ability to prevent interference. A new study from Pew Research Center shows that 74% of Americans do not believe top tech platforms will be able to prevent misuse. FortiGuard Labs Chief of Security Insights and Global Threat Alliances, Derek Manky, joins us now to discuss. He's at a cybersecurity conference right now. Derek, thanks for being with us. So we have two separate issues here. We have, first of all, the various social media networks sort of managing malfeasance on their networks, which doesn't necessarily fall into the category of cybersecurity as much as sort of monitoring trolling in some cases. And then we have the real threat of cybersecurity, whether it's people pretending to be other people or it's hacking of the election itself. At that conference, how much of this is a topic of discussion? What's the concern level there?
Yeah, it's a pleasure to be here. So I've been coming to this conference for over 10 years. This conference attracts up to anywhere from 30 to 50,000 people. Security is obviously front and center here. If you look 10 years ago, things were just about laptops and PCs to smartphones. Today, the biggest theme that we're looking at is the expanding attack surface. So what we mean by this is that today, everything, your phone, your tablet, your Alexa dot, everything to connected medical devices and even polling and election platforms, all of these are part of a connected attack surface, and they're all vulnerable to attack. So security is essential, and this is the theme, And another big theme that we're looking at today is how AI, machine learning, so artificial intelligence, can actually be very effective to stop these attacks.
So that's a good point that you just made. What is in the pipeline that a large company could purchase now to protect themselves that you might be, that a vendor might be offering at RSA, at the conference?
Yeah, absolutely. So another theme that we're seeing here is demystifying artificial intelligence. It doesn't have to be incredibly complex to stop these attacks. There's broad integrated security platforms that are offered that can plug into enterprise networks, that can plug in to actually do things that humans are typically slow to respond to. Threats are moving. I monitor threats on a daily basis. We're seeing north of 10 million attacks happening globally in just 1 minute. So how do you stop that? We can't just win this war alone with humans. So that's a big theme here. There are platforms that are offered, so broad, integrated, and automated security platforms that can make decisions on their own. Actionable threat intelligence, we call this. This is key today.
Yeah, Derek, Bill Rogers here. This is such a profound and important issue. I was at the Labor Department, worked for Secretary Hyman a number of years ago, and then served on a technical advisory committee. And was shocked, and just even at the Labor Department, at the Bureau of Labor Statistics, the amount of attempts to get inside the system of a statistical agency. But my question is, we only have a fixed amount of dollars. Where does a company, where does a household begin to kind of prioritize and where they want to place their dollars to protect themselves?
Yeah, so this is all about collaboration. It's an ecosystem, depending on the play of security, right? Everything from consumer to small and medium businesses. We're looking at plays with MSSPs, so working with internet service providers, managed security platforms. These are all easy ways that, from the endpoint, that can protect against attacks. Then you have things up to large enterprise, right? So integrated solutions that don't have to cost a fortune. You're really looking at trying to block different avenues of attack that are coming in through this growing attack surface, right? So typically 10 years ago, this started with protecting against attacks, what we call from the edge. So just trying to keep those hacks that are coming out. Nowadays, we're also dealing with other threats like potential insider threats, attacks that can spread through these integrated, what we call IoT, the Internet of Thing devices. And this is all part of that growing attack surface.
I love
so
that
really,
phrase, attack surface.
yeah, I mean, it's a real thing. It's a real thing, and it continues to grow. Anytime there's a new service, a new technology, that's connected to the internet, and that's part of that attack surface. So really, it becomes trying to tackle this from the ground up. And when I say that again, it's an ecosystem. There's various, various wheels in motion there. When it comes to the endpoint again, SMB consumer, you're looking at simple things, working with services that are available for protection. A lot of internet service providers or security providers offer this. When it comes to protecting large enterprise, distributed enterprise, there's centralized solutions, cloud solutions, and that's really starting to push out nowadays too.
Yeah, thank you.
So do these threats actually at some point get under control, or do they only just grow?
So we're starting to get a hold of this. So traditionally, cyber criminals have always had the distinct advantage. Why? Cybercrime has no borders. They're able to move without jurisdiction. They're able to. There's a lot of safe havens out there on the internet. So this has been a traditional challenge. But the good news is now that there's a collaboration theme happening from threat intelligence partnerships. Personally, I've helped to form alliances, partnerships, working with Fortinet as an example. There's a Cyber Threat Alliance. We're working even with law enforcement like Interpol to really do attribution. The hardest challenge in the past has been trying to find out who these people are, how they're operating. And this is a big focus that we've done over the last 2 to 3 years. Now that we have this technology in place, we've created ecosystems where we can actually share that intelligence, work with law enforcement to track these people down and bring justice where justice is due.
Derek, thank you so much. Derek Manke is FortiGuard Labs Chief of Security Insights and Global Threat Alliances. Appreciate it.
Turning to big tech, Dan Howley is in California for Apple's annual shareholder meeting, and he's joining us from Cupertino with what investors expect to hear today. Dan?
Yeah, essentially what we're looking for is more guidance on what the impact of the coronavirus will be on Apple sales as well as production going forward throughout the year. We already had that shareholders letter come February 17th in which Apple said that they will not meet their guidance, revenue guidance for Q2 2020, saying that they were impacted by the factory shutdowns caused by coronavirus, as well as the fact that the Chinese Apple stores were closed either partially or completely, so consumers there couldn't get access to any of the goods that they would want. Apple is the third largest sales region, China is the third largest sales region for Apple, so it's a big deal that that was cut off for them for so long. And the factories are still getting up to speed, not quite at 100% yet, so that could impact Q3. We don't know if Q4 will also be impacted, but what we're looking at is whether or not we'll see some kind of push for the iPhone 12 or whatever Apple calls the next iPhone, as the supply for iPhone 11 remains tight. So that could end up pushing consumers to hold off buy the iPhone 12, which is supposed to be the first 5G capable iPhone, and then that could add to the expected super cycle or large sales cycle that we're supposed to see for that device.
Dan Howley, thank you so much. We'll keep on checking in with you to find out what comes out of that meeting. Appreciate it. Coming up, we'll talk to the CEO of Virgin Galactic about that company's revenue miss in the latest quarter and what comes next. Plus, as we go to break, take a look at some of the winners on the Dow right now as we see this big recovery today. Apple is leading the pack.
Let's take a look at how stocks are doing. Some of the winners today include TJ Maxx, the 52-week range on the share price here, anywhere between $49 and $64.95. It is trading to the high end of that range. Why? They had a great fourth quarter. Their earnings came in at 81 cents per share. The street was expecting 77 cents per share. This is the company you know as TJ Maxx and Marshalls. They had $12.21 billion in revenue, year-over-year increase from $11.13 billion. So off to the races, TJ Maxx. Not so much Toll Brothers. The largest luxury home builder in the United States missed on earnings, 41 cents a share, where it was expected they'd come in at 45 cents, and it's down year-over-year from 76 cents. Revenue $1.33 billion. They were expected to come in at $1.42 billion, and year-over-year it was a drop of about 2.3%. Julie?
Well, America Saves Week has been an annual celebration since 2007. It is a call to action for everyday Americans to commit to saving successfully. George Barani is director of America Saves, and he's joining us now with more. Not everyone always celebrates savings, but obviously it is a prudent thing to do. What do people need to do in order to save successfully? Because it seems like we hear a lot of at least anecdotal and sometimes actual data about Americans who don't feel like they have the excess to save.
Well, I think you're absolutely right. I mean, while we may be in a robust economy, 4 out of 10 Americans can't come up with $400 to meet an unexpected expense without going into debt. And the average debt in collection is $357. So while that may not be a lot of money to some of us, to many Americans it is. So we need to teach people how to save effectively. Something that used to be taught at home is not really being taught anymore because we've lost that old-fashioned savings habit.
So we've had guests on who talk about the kinds of things that need to be taught. For instance, I was a guest, it was a while back, who said, instead of having your paycheck deposited simply into your checking account, the minute it hits, because what is it, 80% of Americans get direct deposit, then have the majority of that paycheck transferred to your savings account, and then move the money back. Is there any evidence that that actually helps people save?
It does, but so many Americans are afraid to make that kind of leap, that kind of commitment. So we encourage small amounts. Direct deposit has to be used to save automatically. And you're right, 84% of Americans have access to it, but only 24% of them actually split their pay into a non-retirement savings account, but they're saving very successfully. Those 30 million people are saving successfully for emergencies and short-term needs, but 90 million Americans aren't and could be. So we recommend $10, $20, $30 out of each pay automatically deposited into your savings account using direct deposit, splitting your pay. If you don't have access to direct deposit, or you don't necessarily trust the system, you could set up an automatic transfer from checking to savings on a regular basis. That old adage, set it, forget it, holds true, and pay yourself first.
So in New Jersey, United Way there has created this concept called ALICE, where ALICE stands for Asset Limited Income Constrained and Employed. And it's basically the households that don't have enough income and receive also support from the government or other sources to help them meet their needs. How do you get at helping those kind of families save?
It is difficult to encourage low-income families to save. They're living on the edge, living paycheck to paycheck. To make a commitment of setting aside a certain amount of money each month feels very, very difficult. So that's why we do encourage very small amounts, even $10, $15, $20 out of pay, and into a savings account where you do have immediate access. And that's the whole idea, is creating an emergency fund so you don't get put behind the 8 ball, have to take on further debt that creates financial disaster for years to come.
Yeah. Do you use or work with those who get their earned income tax credit refund? Because that can be, that could be in some cases several $1,000s.
It certainly can, and so at these volunteer income tax sites, VITA sites throughout the country, people use our resources to encourage those that are getting a refund to save a portion, even a small portion, automatically.
George Barani, Director of America Saves, good to have you here
Thank
on
you
The
so
Move.
much.
Waited all day for this one. Virgin Galactic. They missed their analyst expectations on revenue in the fourth quarter. They missed, but shares still trading down slightly right now. Joining us to talk about the future of space tourism and much more than that is Virgin Galactic CEO George Whitesides. It's good to have you here, George, and thank you for joining us. Got to ask you,
Adam.
There is so much to talk about here. Your company has no debt. You have several hundreds of millions of dollars ready to blast into orbit, and you are on target for Sir Richard Branson to take that first commercial space tourist flight, hopefully before the end of the year. Can you give us, I think you mentioned in the earnings call, you've hit 20 of the 29 necessary licensing requirements from the FAA. How long till we get Mr. Branson up in suborbit?
Well, we are working hard to make that happen. You know, as you said, we were really pleased to announce yesterday that we have achieved 20 of our 29 FAA verification and validation milestones. As you know, Adam, we already have our commercial launch license, so we were the first company with a real vehicle to get that license. That's the license that we will be using to provide trips up. We've already been flying powered flights to space under that license. And so that was a big milestone for the company, but obviously we announced some other key milestones yesterday, which you may want to talk about.
Yeah, well, a small step. Let's talk about that, because you have almost 8,000 people who want to take these trips into space once you start doing this. And you started today the small step program. I think if I were one of the people who had $1,000, I could pay that. It's refundable. And then when new seats open up, I go to the front of the line for those new seats. Can you tell me more about this?
Sure, yeah. So, I mean, I think you just mentioned the two big pieces of commercial news that we released yesterday. Number one is that we have about 8,000 folks who have signed up with the intention, they've said that they would like to get a ticket at some point. So that's really exciting. It's particularly exciting because when we last announced the number, it was around 3,500 at the end of September. And so the demand has really seemed to go up a lot in that time. The other thing that we announced was the small step program, one small step for you Apollo aficionados, which is a chance for people to put down $1,000 and essentially distinguish themselves as somebody who really does want to go into space in the near term. So this is a way for us to start to narrow down our sales funnel. You know, we have about 2 million prospects, people who have about $10 million or more around the world. We've got these 8,000 folks who've said that they want to fly to space. And then down at the bottom of the funnel, we have about 600 people who have already put down substantial deposits and who have said that they want to fly, basically who've bought tickets. So what we've done is we've established one tranche down, and those are the people, these one small step people, they're going to sign up, and then they'll be first in line to be able to buy a ticket when we open up sales at some point later on this year. So they haven't actually bought a registration, but what they've done is they've put down a marker that they are really interested in going to space.
And you bring up the $10 million, the total addressable market that might be out there, but it's even bigger. What 1.5 trillion is what space will be in just 20 years from today. I want to throw a quote at you from the earnings report and call in which you said, "We have in front of us an initial market opportunity that we believe is strong and highly profitable." Space tourism is only a small portion of the much larger plan that your company has. And there was a figure that jumped out at me, $900 billion, the commercial aviation market. And you're already a part of this with the technology you're developing. Explain to the investors, because your stock shot up over 200% since you started trading publicly. Explain to investors why that is such a key component, that $900 billion commercial aviation market for you.
Yeah, so I mean, I think one of the really interesting things about where we find ourselves today is that we've been going the same speed in jet travel for almost 50 years, since the beginning of the jet age. You know, there was the blip of the Concorde, but other than that, we've basically been going the same speed. What we are doing is essentially the only company that's going to be taking people, admittedly up to space, but taking people inside a winged vehicle at faster than supersonic speed. So we're the only company going to be doing that with a winged vehicle. And that's a really exciting thing for us because it can translate into going from point to point on the Earth's surface. And this is something that I think everybody wants. Who wouldn't want to get to go, across the ocean or something significantly faster? So what we're working on now is to try to take some of the technologies that we've developed for our Spaceship Two vehicle and to apply that to a future vehicle that could go from point to point. And as you say, the $900 billion TAM, that's the number, that's the amount that of the global aviation services market. We think that we can access the the premium side of that, which is depending on how you slice it, order of magnitude 300 billion. So even if we were to capture a relatively small portion of that, we're still talking about a huge TAM. So this is what's I think got people excited. It's what makes us excited. The opportunity to bring people together and to really change the way how the world connects.
Yeah, on that earnings call, you talked about transforming the global transportation market, but there's also defense contracts. I mean, Space Force. You had one of the slides. You talked about the potential to help Space Force here in the United States ramp up to what it needs to do. Do you have any negotiations you can share with us with the Pentagon about that?
Well, nothing that I can share in specifics. We do have one small contract on the defense side, and I think that broadly speaking, there's a lot of interest right now in high speed. There's a saying now that speed is the new stealth. And there are some good technical reasons for that. But I think, a large platform with a super cruise capability is something that's going to have a lot of different applications, both in the commercial and the national security space. So, we've got some conversations going on in that area. And as those mature and broaden, we'll be able to talk more about them.
We have the video of the situation that happened just 2 weeks ago where VSS Unity transferred out to Spaceport in the Mojave Desert. You've called that a crucial step to get Sir Richard into orbit. Why was that crucial, moving that plane to Spaceport?
Well, in many ways, Adam, it was the final step of our relocation to New Mexico, right? So like last May, we announced we're going to take the big leap and take a big chunk of our team and move them down to New Mexico. Obviously, our main operation or our main manufacturing base is in Mojave, California. We're going to move a bunch of these people down. We're going to move down all the ground support equipment. We moved down the carrier aircraft sort of roughly over the summer. And then this was the last piece, to move the spaceship down to New Mexico. Spaceport America is an unparalleled site for commercial spaceflight. It's inside the sort of restricted airspace of the White Sands Missile Range, so it's going to give us the ability to conduct operations at a frequency that is really unparalleled, I think, in the continental United States or even the United States. And it was a big deal for our team. These are people who have been waiting, for months for this vehicle to move down. It was a great day to have the spaceship come down, and we're excited to move to the next step, which is going to be to restart our test flight program.
And as you were talking, we were showing pictures of the second vehicle, not yet named, but it has already passed the milestone of weight on wheels. And there's also the third vehicle, which is already in production. We wish you the best. We look forward to that very first launch. George Whiteside, CEO of Virgin Galactic. We will hopefully be there when Sir Richard heads into orbit later this year.
Thanks, Adam.
Coming up, the Bob Iger era is over at Disney. The CEO is stepping down effective immediately. We're going to talk about what this means for the company and his replacement.
Obviously, it has been a crazy few days for the market. So let's look at what's going on right now. We've got the Dow that is now trading up at 0.75%, but it's been kind of bouncing around today, right? Yes, it's maintained its gains, but not at the top of the session. And let's take a look at the 5-day chart to put things in a little more perspective. So yes, we've had a comeback here today, but it looks pretty small in the context of what we have been seeing over the past several days. Another couple of matters of context here. I've been taking a look at the VIX, watching the VIX here, which yes, is coming down today, but it's still above 25. So this still reflects that there's not an all clear being expressed by investors in this market. One other sign of that is the fact that the movement in the 10-year is on a relative basis smaller than what we're seeing in stocks. In other words, just a basis point gain, still at 1.34%. So still very close to that record low. Let's take a look at the sectors that are moving in today's session as well. It's a pretty broad-based rally, which might give some heart to the bulls as well. We've got tech, materials, healthcare leading the gains. The one group that is in the red here, energy, still trading off, along with oil prices, which haven't really recovered again in the same magnitude that we are seeing in the equity market today. So pays to look under the hood at what's going on in today's session, Adam.
As we count down to election 2020, there has been a debate about former President Obama's economy versus President Trump's economy. But Bill, you argue that the comparison should actually be between President Clinton and President Trump's economy. Some of us are old enough to remember the Clinton economy. Why? Why is that the comparison?
Well, from the kind of nerdy economics or nerdy economist perspective, what you're doing is you're comparing Trump's economy, this amazing economy, to Obama's economy, which came out of the Great Recession. But ideally, what you really should be doing is you should be comparing peak to peak. And the Clinton-Gore, particularly Clinton-Gore 2, that was the peak of that 1990s boom. And the punchline is what happens is when you compare those two to each other, Clinton 2, which would be ending in 2001, does a much better job, or did a better job of providing opportunity for Americans. Number one, yes, Trump's unemployment rate is a historical low. But if you look at other markers of the number of unemployed people, it was lower in Clinton 2. 3 years into Clinton 2's period, and 3 years into Trump. The number of people who are working part-time but want to work full-time was lower in Clinton 2. The number of people who want a job, if it was offered, was also lower. And then the other big point too that I make is income inequality. In this current expansion, or this current time of this presidency, it's at a historical high. It's at a historical high. What does this all mean? It is consistent with what George was saying earlier, our earlier guest, that you have 4 in 10 Americans who cannot pay an unexpected bill. There is a major problem with there's economic insecurity, and that's what's fueling Bernie Sanders' appeal. That's what's fueling the president's appeal.
So, no president wants to hear this, whether it's President Trump or President Clinton or President Obama. But how much does it really matter who the president is? Because you have the Senate, right? You have the Congress, and it all goes back to, can you really enact the policies that someone maybe is running on? Which, to your point, now we're getting kind of even extreme polarization with Sanders on one side and, of course, Trump on the other.
Yeah. Now, the bully pulpit, or that ability to provide the message, was really important. I spent the last year of the administration in Clinton too. No correlation as to why things are much better. But we spent a lot of time about, for my job, the first Friday, the jobs report, Numbers come out. How we spoke about it was very important. It was a great number. We let the president take the lead on the conversation. If it was a good number, the secretary and myself, we would talk about it. And it drills down to consumer confidence. That if you're talking positively about the economy, and if you're able to then show that your policies are making a difference, that helps your consumer confidence numbers, which then helps consumption, which is 60 to 70% of GDP.
For the record, we are both veterans of that old Labor Department jobs lockup. So they don't do it anymore, though. So anyway.
Right. Well, for now.
Yep. Right. Coming up, racing to 2020, the Democratic candidates piled up attacks on Bernie Sanders in last night's heated debate. Plus, stocks are rebounding from yesterday's sell-off as the coronavirus death toll rises to more than 2,700. We're going to continue the coverage right after this.
It's about noon here in New York City, 2.5 hours into the trading day. Stocks are rebounding, although we are seeing them come off their highs to some extent. Traders pointing to a headline from the federal health minister in Germany, quoted as saying Germany is at the beginning of a corona epidemic, that according to Bloomberg. So that could be responsible from a little bit of selling off the highs here. We'll monitor that situation, the latest on coronavirus. Let's look at oil as well, because while stocks are recovering today, oil is not. It's down by nearly 1%, 49.48 the barrel. President Trump is set to hold a news conference from the White House later today, as the administration looks to calm fears following a warning from the CDC, which told Americans the virus will inevitably spread in the U.S. The end of an era. Bob Iger steps down as CEO of Disney, and his replacement surprises Wall Street. Find out more about his successor ahead. And we meet again. Chaos on stage as Democrats square off in yet another debate. Welcome to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Let's introduce the panel for the next hour. We have Rutgers University Professor Bill Rogers and Direction Managing Director Dave Mazza. Our top story is coronavirus and the turmoil it's creating as stocks rebound from yesterday's sell-off, which was the second of the week. The total death toll now stands at more than 2,700, with over 80,000 confirmed cases worldwide. The news has further increased worry that the economic disruption from the outbreak may have a wider impact than initially expected. With us to help explain this is Leon Levy, Eurasia Global Macro Analyst. It's good to have you here. And now we've got this news, this headline, apparently out of Germany, that seems to build upon investor fears, who then react, as we saw us take a leg down. We were up 400 plus points. Now we're up 150 on the Dow.
Yeah, so it seems that we are currently watching investors sort of try to game out just how bad the coronavirus is, how extended its reach will actually be. The hope was originally that China, with its incredible political control of its country, would be able to tamp down on the coronavirus and limit it to Asia. But apparently, over the course of the last 3 days or so, we're starting to see that that's not the case. And we're starting to see not just, cases popping up, but significant numbers, and we're seeing different governments trying to deal with this issue and struggling to do so.
It doesn't seem either that we are seeing sort of a global coordinated response, right? Different governments handling it different ways. We've seen, the situation with the cruise ship in Japan that was, by outside observers, was not seen to have been managed adequately. And that seems inevitable then, that we're going to get these sort of different pockets of mistakes that can further spread the virus.
Even in the best of times, having coordinated global responses are very difficult across different countries, across different political systems, right? That has been exacerbated by our current era of America first, my country first, this idea that multilateralism isn't playing the role that it once could and should. And a lot of the political responses that we're seeing are entirely dependent on the political context in the countries themselves. So we are seeing, for example, in Iran is struggling to contain the outbreak. But Iran has other issues as well. So because of US sanctions, their economy was already under the screws. But following the killing of Soleimani and then the downed jet that followed, which was accompanied by protestations by the Iranian government, that we had nothing to do with it until they actually did cop to it. That fuels sort of the social discord there. And people don't know necessarily how much they should trust their government, which as recently as a month ago was telling them lies only to walk it back. So Iran is also dealing with some serious credibility issues, which is very different than other countries as well.
Yeah, I guess one observation I find interesting is, right, that the outbreak has very little correlated with being a developed country or developing country, right? But my question is, Adam mentioned that it's going to be the press conference or the conversation tonight at 6. How do you think the president's going to thread that needle? Because he was, and his Larry Kudlow was also very, sanguine about it. It's good or it's fine. But then you have the scientists who are talking about pandemic. Yeah. Where is this going to meet tonight, you think?
I think it's clear that the reason the White House and the president had to call this press conference was there was just an incredible amount of mixed messaging coming out of the U.S. yesterday, right? You had the president saying everything is okay, everything is under control. People should actually be investing in the stock market, right? Whereas the CDC gets up and says everybody should prepare for an actual spread of what's going on. We don't know what Donald Trump is going to stand up and say at 6 p.m. tonight. It's always been difficult to sort of predict what the U.S. president is going to stand up and say. But he's weighing a lot of different issues in his mind. So on the one hand, he is concerned about the spread in the U.S. He's also worried about the economy, and he sees the U.S. economic performance tied directly to his ability to be reelected. At the same time, he's also dealing with U.S.-China trade tensions. And so he's going actually out of his way to praise Xi and try to keep tamp down on the panic. At a certain point, though, the reality hits the road, and he, regardless of political considerations, he's going to have to stand up and say to the U.S. people, one way or the other.
He's going to have to address this. The Dow has just dropped almost 100 points. We're up 39, 40 points.
Okay.
The FDA has just said that we are now officially on the cusp in the United States of an epidemic. That's from the FDA, on top of what we had, of a pandemic, rather. That's what we had following yesterday from the CDC. Investors are going to be worried, and volatility, on this, Dave, it's not going to stop, not for a while.
Yeah, no, I think we're going to be in an environment where we have to embrace volatility in some ways. We've been kind of accustomed to extremely low volatility, but we are trying to make judgments about something which we might have some past precedents, whether it's SARS or MERS. In this case, we just don't have all the information yet. As more of it comes out, as maybe some more realist expectations of where supply chain disruptions will look like and where the demand side looks like, that may be when we get into a place where we can actually assess what the rest of the year looks like from an economic perspective and from a market performance perspective.
We also have the FDA, and this should not surprise anybody, saying that the first vaccine to help prevent this virus won't arrive until there is an outbreak in the United States. All right, Leon Levy, thank you very much for being here. You're Rosa Global analyst.
Thank you.
Well, separately, a surprise announcement from Disney putting shares in the spotlight today. Longtime CEO Bob Iger is stepping aside. He will be executive chairman, so he'll still be working there. His hand-picked successor is the parks chief, Bob Chapek. With us now to discuss is Tuna Amobi, CFRA analyst. Tuna, it's good to see you and to get your perspective on this. The market didn't like this news. We saw the stock fall. Because Iger has been such a successful leader of the company, do you think it's inevitable that Chapek's going to have a hard, it's going to be difficult for him to live up to the legacy?
Well, there's no question that Chapek has some really big shoes to fill. That being said, there's also something to be said about almost a 3-decade veteran of the company who has been around several of the company's divisions, and having Bob Iger, for that matter, for the next almost 2 years, show him the ropes. Listen, I think the positive takeaway here is that this news does resolve the succession question, which investors have been clamoring to know. As you know, Bob Iger having delayed his retirement many times in the past, at least there's some semblance of a closure here. I think the most important thing is to reinforce the fact that there's not going to be any major change in the strategy. As we heard on the call yesterday, Bob Chapek is a foot soldier who has demonstrated his ability to rally the troops, and I do believe that he is going to be a very good replacement for Bob Iger, much as people did not see this coming, including us.
Tuna, I have a question for you, because in the excitement about Disney Plus and the movies, it can be easy to forget that parks and the things related to the theme parks are the largest single revenue generator for Disney. So this move to Chapek seems to make sense, but how much longer are the parks going to dominate?
Well, I think you made a great point there, Adam, because I think investors tend to forget that much as the direct-to-consumer gets a lot of attention, there is still pretty much in a loss-making situation here. So in terms of the core businesses, the theme parks, the television, the film studio, et cetera, I think there's, obviously Bob Chapek has had exposure to a variety of those, perhaps excluding, television. But that being said, to your question on the theme parks, We've seen nothing, absolutely nothing that indicates to us that there is any kind of major slowdown around the corner, except for the issue of coronavirus, which you guys have talked about quite a lot. But this isn't something that's specific to Disney. This is something that they're navigating as best as they can. And we do believe that ultimately the impact on the company is going to be relatively small compared to some of the other companies that have much larger exposure out there.
So you note some of the questions about secession actually being answered, of course, with this news, but should investors read anything into the fact that it actually came as a bit of a surprise, even though, of course, Bob Iger is still being employed by the company and, in fact, actually still being in charge of things like the entertainment and creative side?
Well, it's funny because we asked Bob Iger that very question on a call last night, and we didn't really come away with any good answer as to the why now? Why is this the right timing for this? Other than the fact that things seem to have been taking shape. But I would argue this is as good a time as any other for any CEO transition. The company is in great shape. They've just going through the integration of the Fox assets. They've articulated a very compelling direct-to-consumer strategy with the launch of Disney Plus, which is really off to the races here. So to that question, timing, I don't know that there's necessarily any better time to do this. It does resolve the succession question. And remember that Bob Iger himself transitioned into executive chairman role, focusing much more on the creative aspects of the company while Chapek learns the ropes in some of the other business. I think that should give some comfort level to investors having Bob Iger still involved in the day-to-day for the next couple of years or so.
Time will tell. Tuna Moby, thank you so much. Appreciate it.
Thanks for having me.
Democratic presidential hopefuls are back on the campaign trail in South Carolina today. That's after the blistering debate last night, and it was big on attacks. Mike Bloomberg took a lot of heat from the competition and continues to face criticism for trying to, quote, buy the election. He didn't put that issue to rest yesterday, coming within a hair's breadth of saying he bought the Democratic majority in the House.
Let's just go on the record. They talked about 40 Democrats. 21 of those were people that I spent $100 million to help elect. All of the new Democrats that came in and put Nancy Pelosi in charge and gave the Congress the ability to control this president, I got them.
That was not backed. That was, yeah.
Well, but listen, he's making the case that there were 41, was it, moderate Democrats elected to the House in 2018, and it took billionaires, he was being attacked for being a billionaire, and their money to get those 41 people in power to then push forward the Democratic Party agenda. So it wasn't as if he was spending the money to control those 41. He was spending the money to get them there.
Yeah, but in this world right now, as you know, right, perception is reality. And I'd like to think he backed them, supporting them. I think he did a better job, than his first debate appearance. Yeah, he had nowhere but to go up. Yeah. The other Bs, I thought Bernie, he also did a decent job of defending himself. And I think his big thing is he's got to articulate this piece, that I'm not a socialist. And I liked how he asked the question and said, what other countries have increased the minimum wage or done other types of policies, or even ourselves, have done policies that are, they're consistent with being in a capitalistic, economy.
Dave, I want to ask about the market reaction, because we had a guest on in the first half of the show who said typically during an election year, you don't really see market reaction until you get to September. Yeah. That said, this big sell-off that we saw on Monday, while being attributed primarily to coronavirus, there were some murmurs that Bernie Sanders' win in Nevada was also a factor. Mm-hmm. What do you say to that?
I would give a bit of credence to that. Now, let's be clear. The vast majority of it, probably 85-90%, is definitely related to the questions around the impact that coronavirus will have. With that being said, just like we saw Warren's resurgence in the polls, now we're seeing Bernie really begin to potentially be the true front runner, especially we'll see after South Carolina, how he does relative to Vice President Biden. markets are going to react earlier than that because now, again, we have two very complete objectives from a presidential candidate that they've never priced in before. We're not talking a moderate Democrat versus a moderate Republican. We're talking about President Trump and what we know he's done, and in many ways being pro-markets, pro-business, with someone who, in fact, is trying to attack much of that. So if markets don't react to that earlier than later, then actually we'd put ourselves maybe in a worse position come November.
Well, maybe it's the presentation that he offers, but I can't. My feeling on when I hear him, and I know that, and I've studied and work on these policies, he's trying to attack the issue that what George talked about earlier. He's trying to attack the issue of income inequalities at its highest level, right, on record, and so he's refining his message in terms of talking about these policies in a way that, again, are not going to destroy capitalism. They're going to you raise the minimum wage, you make the value of work rise.
But he's talking about giving that. I mean, that doesn't come from nowhere. He's talking about income redistribution, which is a primary
Michael
tenet of socialism.
Michael Bloomberg would make the case the value of work. He turned himself into a billionaire, and he's being attacked for it.
Yeah, but I think the issue for me is one of, and a lot of my colleagues are shifting away from talking about income inequality because it's divisive, and talking about economic security, right, or insecurity, and that is, and if you put it in that lens, then I think you can take yourself down the path of, yes, we need to ultimately do some shifting, but also if we grow the economy, right, then the pie can then be divvied up in more equitable ways. Now, what is equitable? Well, clearly, if someone can't pay a bill, unexpected bill, clearly if someone can't, sort of recover from a job loss or from a natural disaster, right, we as a society, we have problems.
Okay, so just want to let you know, we've had a roughly 450-point swing in the Dow. At one point, we were up about 450 points. We went negative briefly just about a minute ago. I think at this point, the Dow is up slightly, maybe just a few points, up 30 points. Coming up, markets are bumping up the odds of a rate cut, but Fed officials are saying it's too soon to draw any conclusions.
Welcome back to On the Move. I'm Jared Blickery. We got the Dow pairing some of its gains. It went negative briefly. Let's take a look at that. And it's surrounding all the headlines that we've been seeing, one from Germany, one from the FDA, at the cusp of an epidemic here. So we can see just basically giving back all these gains we made today. Similar story in the S&P 500. We do have support close to yesterday's lows, right around that unchanged level and a few points lower, but probably don't want to break it. Yesterday I was looking at 31.35 as a make or break level, closed underneath it. So not the best development here. And now we see the VIX heading higher here on the news, and we're also going to take a look at bonds because the 10-year T-note yield now just about break even. It had been up 3 or 4 basis points, and so we had seen the yield curve expanding, especially in the 2s, 10s, but now coming off of those highs. So we're going to take a look at some heat maps here, and still not bad. If we look at the NASDAQ 100, the big cap stocks to the left keeping a lot of their gains. Microsoft up 1.3%, Apple up similarly, Facebook 0.5%, etc. And if we sort by performance, we can still see some outperformance by Netflix, up 3.7% on no particular news, but analysts have been saying recently that the coronavirus, should it spread, is good for the streaming wars. And then to the downside, we have United Airlines, Booking, Expedia. You would expect those kind of stocks to be down in an environment like this. And now the sector look, we have tech still outperforming along with materials and healthcare and industrials, breaking that 8-day losing streak. Have to see what happens in the close. To the downside, energy once again, the big loser. We're going to be right back.
Welcome back. Stocks are losing steam to some extent. At one point, we were up as much as 461 points on the Dow, now up 110. We briefly dipped into the negative as well. So obviously a lot of volatility here tied to various headlines about coronavirus. We will keep you posted on those headlines as they do come out. Meantime, the Fed's monitoring this as well. Top Fed officials are saying it is too soon, though, to determine the full economic impact of COVID-19. Joining us from our newsroom with more is Yahoo Finance's Brian Chung. Brian, you sat down with Fed Vice Chairman Richard Clarida. He spoke yesterday at the NABE conference. What did he have to say?
Yeah, well, Vice Chairman Clarida is saying for right now it's too soon to say if the Federal Reserve needs to act in response to the coronavirus, saying there's no need to insure the U.S. economy with rate cuts of its own. Keep in mind that markets are currently pricing in heightened expectations for the Fed to ease rates, looking at Fed funds futures contracts for their April meeting, which is 2 meetings from now. It's actually a 50% chance that we'll see at least one 25 basis point cut by that time. But when you listen to the Fed speakers that have spoken so far this week, it seems like everyone's saying they would like to be on hold for right now. Vice Chairman Richard Clarida, speaking at a conference yesterday, said, I want to read this quote, "The disruption there," referring to the coronavirus, "could spill over to the rest of the global economy, but it is still too soon to even speculate about either the size or the persistence of these effects or whether they will lead to a material change in the outlook." And material change is really the key word in that speech. Basically, the material change is something that the Fed has referred to since they cut interest rates by 75 basis points last year. Since then, they've been on pause, but they've said the only reason why they would move and change where they are right now, which is between 1.5 and 1.75%, is if there were to be some material change in the outlook. But he's saying, with reference to the coronavirus, that he doesn't see that as being the case so far. So a little bit of a divergence between what markets are expecting and what Fed speakers are saying. There are no Fed scheduled speakers today, but Charles Evans from the Chicago Fed is scheduled to speak tomorrow morning. Julie?
Thank you very much, Brian. New home sales for January are out today. They grew 7.9% to an annual rate of 764,000. That's nearly 19% above the rate in January 2019. We're going to dive into those numbers with our next guest. David Edelman is the co-founder of FS Investments. And we keep hearing all of the right things in play. Low interest rates and millennials finally buying because household formation is once again important. Do you see anything that could throw a wrench into this?
You know, I don't. I think actually kind of the flight to safety, you see the 10-year hitting an all-time low. People are saying, let me hoard my cash. Well, what else is safer besides bonds, hard assets, a home? And so I actually think that you will continue to see, I think this current month will actually outpace January, is my prediction, because I think people are going to say low interest rates, maybe I don't want to go on a vacation or do something else with the money. And the flight to quality of just having your home as a hard asset, real estate is performing very well. The REIT stocks are actually holding up really well right now as a place for safe money.
So your firm manages alternative investment funds. So you invest in things like real estate and other sort of non-equity investments, non-traditional equity investments. If you're looking at an environment like we're in right now, as opposed to the last few years, which have had this sort of melt-up rally almost across the board. I mean, last year, I think we saw a coordinated asset return that was, if not unprecedented, it's certainly unusual. How do you perform in that environment versus how you perform in an environment like we're starting to see right now, which is a much more volatile one?
I think in general, alternative assets, will never hit the highs during, when things are going like this. There's kind of a hedge to what they do. But when you get into a market like we are right now, when you look at real estate or certain alternatives, I think that safety is what is going to make people feel very comfortable about not kind of swinging for the fences. You're going to have people pull money out of equities, they're going to bonds, but they need another place to go. And I think kind of these pullbacks wake people up to say, you know what, the market's not always going to the moon. There are going to be these hiccups.
You've got $24 billion under management, and I want to make sure I read this correctly. You've just had a mortgage, you locked in an $80 million mortgage at 3.3%. I imagine that was for a purchase of multifamily residential investments. And there's a follow-up to what I'm asking you.
Sure, yeah. So one of our other businesses, Campus Apartments, we're closing today on a $125 million purchase of a multifamily building. Our 10-year fixed rate on that asset is 3.3%. And so, all related to the 10-year Treasury.
What advice? Now, you're coming to the table with billions of dollars behind you when you're talking to a lender. What about those of us who don't have the billions when we go to talk to a mortgage lender, whether it's JP Morgan Chase or someone else? What advice in negotiating that rate down? From the point of, it might be 3.4 right now for the 30-year fixed rate.
Well, I think you're going to see, one is, so you just said something. Should it be a 30-year fixed? Maybe it should be a different instrument. Maybe it should be a,
10-year, 15.
Yeah, and so I think sometimes people get lulled into these 30-year fixed rate mortgages for their homes, and not everyone I know is going to live in that house for 30 years. So sometimes they're more competitive. I suspect that the shorter 10-year, 15-year loans will probably price better.
So everybody is very concerned about the coronavirus, and so we're monitoring, trying to assess what its impact going to be. Are there other headwinds or side winds for this market that we need to also be cognizant of, and given where we are in the cycle?
So I've been thinking about what are the safest places to be, and in our Campus Apartments business where we house about 25,000 students, I said, what are they going to spend money on? Well, you think about Netflix, Amazon, Verizon, data usage if they're not going anywhere. So I'm trying to think about the defensive areas where consumers, millennials, a lot of people we deal with are going to kind of feel comfortable with. And so look, who knows if this thing passes by summer and summer travel's back on, and I hope it is. But I think in the meantime you might see this kind of motion over to kind of safe, be at home, maybe not go out as much.
You are an investor though in something called Wheels Up. So that's private air travel. Are you nervous right now because of coronavirus? Your note to us says you're not, that there's actually sort of a counterplay, you think, in that.
Well, here's what I would say. One, the commercial airlines have done a great job keeping their employees and passengers safe, and we should commend them on that. And two, Wheels Up is focused on the U.S., not overseas, and so we feel that kind of on that U.S. travel. And I think the difference of Wheels Up, which is kind of the democratization of private aviation, where you're seeing business travelers kind of say, okay, we have 8 people in our King Airs, which are very kind of fuel efficient, flying SUV is how we kind of describe it. Everyone on the plane, right? So you might kind of feel a little better there. But I think for us, we continue to see that business continues to do well. But we need a strong commercial aviation component, in society in order to support what we do as well.
Do you think that it'll take a hit, though, as a result of people not traveling at all because of coronavirus? Or will it actually see an uptick because people don't want to travel in as large numbers?
Yeah, I think it's going to be the latter. I think that, the people who currently fly private will continue to do so. I think there are probably people who are on the fence, and certainly for business travel, if you're putting 6 or 8 people somewhere, the efficiency of, amortizing that cost of 6 or 8 passengers on a plane is not as bad as you price it compared to commercial.
David Edelman, FS Investments co-founder, thank you for being here.
Thank you.
Coming up, better pizza, better earnings. Papa John's beat on earnings in the latest quarter. Our food guru Heidi Chung will break down the numbers right after this. Plus, sticking with pizza, how one company is looking to disrupt the pizza industry. Straight ahead. It's about 12:30 here in New York City, 3 hours into the trading day. Stocks are hanging on to gains once again, even amid coronavirus concerns that have caused quite a bit of volatility, not just over the past few days, but in today's session as well. We are still seeing not really that actually we're now seeing a little bit of buying in the Treasury market. So in other words, we have not seen the same magnitude of the move here that we have seen in stocks. The yield on the 10-year, 1.33%. The volatile week for stocks comes amid questions over the White House's response to the crisis. The latest as President Trump prepares to hold a news conference at 6 p.m. Eastern. The state of retail as the Real falls on earnings. L Brands prepares for its first report since announcing it will sell Victoria's Secret. And Tesla trouble. The NTSB calls on the company to improve the safety of its automated driving technology. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Papa John's is reporting a better than expected fourth quarter. Yahoo Finance's Heidi Chung joins us from our newsroom to break down the details. Heidi?
Hi, Adam. Yeah, so Papa John's, just judging by the fourth quarter, looks like its turnaround plan is finally finding its footing. But I do have to mention that the stock is getting crushed here. It's down almost 11% and on pace to have its worst day in more than 4 years. But let's take a quick look at these numbers here. Revenue during the fourth quarter totaling $417.5 million. Consensus expectations were for $403.8 million. Adjusted earnings per share also better than than expectations at 37 cents per share. Now, those comp sales, which is that key metric that we pay attention to for restaurants in the U.S., grew 4.1%. Consensus expectations were for 2.3% growth. But the stock action that we are seeing here midday might have a little something to do with the softer than expected guidance, as well as some commentary regarding the coronavirus. So looking at that guidance, the pizza chain's 2020 adjusted earnings guidance coming in between $1.35 per share to $1.55 per share. So the midpoint of that guidance range did miss analyst expectations of $1.52 per share. Management saying on the earnings conference call that it does not expect a material impact from earnings from the coronavirus. But looking at the comp sales guidance in North America, comp sales are expected between 2.5% and 5%. International comp sales, though, are forecast to be between 1.5% and 4%. And that reflects an anticipated 50 to 100 basis point impact from the 110 restaurants in China that have been impacted by the coronavirus. The company also revealed in some filings that Papa John's closed roughly 50 stores in China due to that outbreak. And I do want to refresh your memory a bit here that the CEO, Rob Lynch, took the helm back in August, and in November they announced a management shakeup, and it looks like this accelerated turnaround plan is starting to take shape here.
Heidi, thank you. And we want to stick with pizza. From one pizza company to another, Mod Pizza is looking to disrupt the industry as a fast casual dining option that believes profit and social impact can and should coexist. Joining us from Seattle, Washington is Mod Pizza's co-founder and CEO, Scott Svensson. Scott, you created this business with your wife 13 years ago. You guys have about 475 locations, I believe, at this point. And you announced that your sales were up 24% to $493 million by the end of 2019. We just heard about what's going on with Papa John's. Do you see companies like Papa John's as your competition? Do you see other sort of pizza upstarts as your main competition, or is it just the whole fast casual landscape?
Yeah.
Unfortunately, we're having some audio troubles with Scott, so hopefully we can work on that and get it fixed and come back to him. So coming up, Retail Roundup, how the sector is faring this earnings season is next. Plus, trouble for another fast food chain, Jimmy John's, why the FDA is linking that chain to outbreaks of E. coli.
The National Transportation Safety Board says the driver of a Tesla SUV who was killed in a car crash 2 years ago was playing a video game on his smartphone at the time of the crash. The NTSB chairman warned future drivers and Tesla, saying partially automated driving systems cannot drive themselves, and called for Tesla to take action. The FDA, along with the CDC, has issued warnings to sandwich chain Jimmy John's for, quote, adulterated food linked to E. coli and salmonella outbreaks. In a warning letter, the FDA said the chain sold vegetables linked to 5 different outbreaks without taking any of the proper safety precautions to address the issue. Supermodel Tyra Banks will open a model-based theme park called Model Land. This spring, the 21,000 square foot theme park will open May 1st in Santa Monica, California, and it will emulate a fantasy version of the modeling world with state-of-the-art interactive exhibits that feature beauty, fashion, retail, and tech. Ready for this? Tickets are on sale now. Blue Steel.
All right, let's get to earnings. Online luxury consignment site The RealReal posted a fourth quarter earnings loss of over $21 million. For the year, the company reported a loss of nearly $97 million. Those shares are down about 21% since the beginning of the year. Joining us via phone with more on this is Simeon Siegel, BMO Managing Director. After this, he's going to get off the phone and get his tickets for Model Land. But in the meantime, he's talking to us. Simeon, it's good to talk to you. So The RealReal has obviously struggled since that IPO, and it doesn't seem like these numbers are doing anything to reassure investors. What's your take?
Yeah, and this Model Land sounds like something we would have spoken about in a different era. I don't know, just thinking about the other conversations we had. Anyway, interesting. So The RealReal. Listen, I think that the reality is there's a world of losses and a world of less bad losses. But what was so fascinating about this is you have this brand new world of technology teaching us, essentially scratching itches we didn't know we had. The RealReal checks a lot of boxes. So you're selling a product, there's sustainability, you're helping people clean out, and at the same time, you're creating an accessible luxury element there. So industry-leading growth, margins getting a lot less bad pretty quickly.
What about the different story for TJ Maxx, the parent company of TJ Maxx and Marshalls? They reported fourth quarter earnings, and it was a sales beat. Same-store sales grew 6%, blowing past analysts' expectations. What are they doing right? I thought these stores only did well during economic downturns, but this one's doing well during an upturn.
So it's a shockingly good segue because The RealReal and TJ will share a lot of interesting components here. And essentially what TJ does that I don't know if people fully appreciate, they don't sell cheap clothing. They sell expensive clothing cheap. And what they do is they serve a very important role for both the brands and the consumers. They allow brands to very quietly get rid of product that they may have a little excess of and they don't want people to see that they're discounting. And they let the consumers who are willing and able to walk into a store to go and find these treasures. And I think ultimately that's what that did. But I think to your point, it's a great question. What TJ did in the last, call it 5 years, was eliminate the stigma of shopping for a deal. It's now a badge of honor to say you went to TJ, not a negative.
Simeon, to your point, TJ relies on getting stuff that other retailers can't sell. What does something like a trade war or a coronavirus, which is hurting other retailers' supply chains, do to TJX if there's not going to be that excess supply it can rely on?
Sure, absolutely. Listen, there's the first thing I think that bears noting is on the conference call, the CEO, Ernie, was very clear that their primary focus is the health, and rather than talking to the business impact, which I think is a credit to them, because unlike most, the reality is off-price seems to win in any environment. And inevitably what happens with these disruptions, so people will be without supply. First off, the off-pricers, I think, have been building up a lot of supply over the last few years. So they essentially have their, whatever it was, 7 years of fat that's kind of baked into the balance sheet. So they have a lot of goods that they can unload now. But I think ultimately the more interesting question comes as other brands and retailers watch their supplies locked up and whatever they do order come late, then these disruptions end up playing into off-price's favor because they're just in this model where you don't have to be immediate. You don't have to sell now. You get to buy other people's mistakes. And essentially what supply chain disruptions guarantee is mistakes.
So now that off-price is cool again, to your earlier point, and the quarter that they just had is absolutely unbelievable in many ways, where can the company go next for future growth?
Listen, I think 5 years ago, everyone would have asked where can they have to be a function of the full price channel. And that was always the conversation. If you're essentially an outlet for other people's mistakes, you have to be a fraction of that. I think what we've found now, this is the destination. And I think what's interesting is you think about the sheer volume, forget about the market caps that the department stores have, but look at the sheer volume of sales that they still have. There's a lot of volume that brands can say, let me take out of a department store in a mall and let me put into a TJ, and they can be very happy about it. So they just hit, as a company, they just eclipsed 40 billion for the first time, which is an astronomical number, but showing no signs of slowing. I mean, you're seeing that accelerate.
I remember shopping at Marshall's at one of my first jobs. I never thought I was cool, and now I am. Simeon Siegel, BMO.
Make sure you pick something up for that the Model Land.
Yeah, absolutely. I'll get, what is it, Blue Steel from Zoolander. Simeon Siegel, BMO Managing Director. Thank you very much.
Have a good day, guys.
All right, I think we're getting back to Mod Pizza now. I think we've ironed out some more kinks here, and we're going to talk to Scott Svensson, the co-founder and CEO. Scott, we got you back?
We do. Thanks for having me, and I'm sorry about the challenge.
Clear as a bell. Thank you. So let's pick up again with that question I was asking you, which is what you see as your primary competition.
Yeah, so you were reporting on Papa John's, and they obviously had some good numbers. We primarily provide a service for people on premise. Papa John's is obviously primarily a delivery provider. We think of our customers, anybody who has $10, 30 minutes, and is looking for a fabulous experience that's customized, fast, great value, and aspirational. And it's been a great model for us, and customers have loved us, which is why we're growing so much.
Yeah, I mean, I noted earlier that your year-over-year sales were up 24%. Is that on a same-store basis? Because I know you opened quite a few new stores in 2019 also.
Yeah, so that's the total growth in our sales last year as we were opening a bunch of stores and expanding our platform across the country.
Your cost basis must be interesting here, because I know one of your missions is also to promote workplace diversity and inclusivity. Yep. You work with a number of sort of underserved and underemployed groups, including previously incarcerated, low-income youth, et cetera. What does that do sort of to your cost base and also to the culture of the company?
Yeah, so we talk about the fact that we make pizza to serve people. And it's the primary focus of the organization is to provide opportunities to people who would otherwise have barriers to employment. It is magic for our culture. Giving people opportunities who are otherwise at risk creates an incredible amount of loyalty and energy and gratitude. It does imply a little bit more cost in the organization. We invest heavily. We're a very progressive employer in terms of compensation and benefits and training. But over the long term, when we think about both our business impact and our social impact, it's a model that works. We've been able to attract a lot of capital for growth. More importantly, though, we've been able to inspire and motivate our team to deliver an experience which keeps customers coming back.
What is your attrition level like among employees?
It's better than the industry, but not where we wanted to see it yet. It's our number one priority for this year is to do a better job delivering an experience to our employees that keeps them with us for longer periods. We've always done a good job in that regard, but we think we have an opportunity to go to the next level.
So the pizza chain was founded and has really had its success at a time of economic growth, right? So what happens if there starts to be some contraction, both when you're talking about this employee base and finding good people, but also, you know, selling these pizzas to folks?
Yeah, it's a great question. We actually opened our first store in November of 2008, about 6 weeks after Lehman Brothers failed. So we have a little bit of experience operating in challenging economic environments. As a matter of fact, we think Mod will be at its best. We started the business at a time when people needed jobs and they needed a fair deal for a meal. And obviously now we're at the lowest unemployment. When we started our business, we were at the highest unemployment in a generation. And we've thrived in both environments. We are anticipating that the environment will probably get tougher before it gets easier. And to be honest, we're looking at that as an opportunity for Mod to really shine.
All right, well, we'll check back in with you. Hopefully that won't happen too soon, but we'll check back in with you as it does. Scott Svensson, Mod Pizza co-founder and CEO, thank you.
Thanks for having me.
Well, coming up, President Donald Trump defends his handling of the coronavirus. We'll break down what he said and perhaps preview what he's going to say tonight. Plus, the CDC has thoughts about your facial hair. We will break down which styles they recommend to prevent the coronavirus. We'll explain right after this.
It is time for the Buzz Debate Around. 3 stories, 1 minute each. Let us start with this. After playing down the concern of coronavirus, President Trump tweeted last night that Democrats are criticizing his approach to close U.S. borders and prevent the spread of the coronavirus. Apples and oranges here, don't you think?
Yeah, honestly, anything the president does is going to get probably a negative reaction from Democrats in this environment, right? But it's a difficult situation. We'll see what he says tonight of exactly sort of what the plans are. But up until recently, it was hard to say that we should shut our borders and not allow flights from various reasons. But maybe that begins to change if we do get a real pandemic.
Well, and at the same time, too, when you have CDC officials coming out and raising alarms, I mean, at the very least, it feels like the administration needs to have a more consistent
Not
message.
coordinated by any way, shape, or form.
Right. I mean, tonight, the 6 o'clock conversation, he's got to get on the same page with his scientist. And will he do that? You know,
Closing borders, though, I mean, an American citizen traveling abroad can bring this back. It has nothing to do with the real reason, which might be legitimate or not, that the president took a stance on the border control earlier in its administration.
Yeah, let's be clear about that.
Yeah.
All right. Well, speaking of mixed messages, the 2020 Summer Olympics in Tokyo could be postponed or even moved to a different location if the number of coronavirus cases around the world continue to rise. Now, there's a senior member of the International Olympic Committee who said it could change, though a member of the local Tokyo committee said, no, it's not going to change. Should they consider doing this with the Olympics?
Oh, I think you definitely have to, right? I mean, we talked about this a month ago, when we were just starting out, and we're still, I think, in the sort of infancy. I mean, quietly, you got to have.
If it's a pandemic, though, where are you going to move it?
You're not going to move it. You're going to cancel.
Well, I'm sorry. That's what I meant. Either you're going to cancel or move, but more importantly,
move it in time, delay it.
Or more importantly, you got to establish some kind of go no go scenario, right, as to whether it's going to be there or you're going to move it.
For the time being, if you're an athlete, you got to keep training, right? You don't just stop.
True. Yeah.
You know, but if they do cancel it, that means the potential host city is going to have to bribe all those IOC officials again And I mean, it's like, someone got that bad joke. I apologize.
And if you think about the economic impact from that we're talking about today, that's going to absolutely be really bad when it comes.
Okay, now listen.
Because if we get to that point, right, of where we're considering canceling and moving.
Buzz. As the coronavirus continues to spread worldwide, Centers for Disease Control and Prevention, they've got some concern about facial hair. Now, look, coronavirus is deadly serious, but we need a few things to bring a smile to our faces. So, CDC actually put this thing out. They recommend shaving the stubble and beard in your mutton chops, as hair on your face can interfere with a respirator if, God forbid, you should wind up in the hospital and need some help.
And
there it is.
It's those facial masks as well, even the ones that you wear, because I guess the seal around it needs to be pretty.
Well, it looks like I gotta go get a shave. That's pretty clear. But yeah, I mean, if the math doesn't fit, right, it doesn't fit. But I'm not at the point yet where I'm gonna go get that razor. But again, we'll see if time will tell.
I think you could keep a mustache, is what the chart.
Would that be a good look for me? I don't know. For me, it's beard or nothing.
This chart was also a great education for me, as the different names to all of the different facial hair permutations.
Because apparently a villain mustache, which is something I'd never heard of,
villain mustache
is allowed. Check it out.
As long as you tuck the sides.
Exactly. That's the official.
Wow, you must pay the rent.
Well, Rogers, Dave Mazza, a little levity on what has been a pretty serious week here for markets and for news. And we are seeing stocks hold on to gains for the moment.
All right, YFI PM is going to guide you through the next hour of trading, so you don't want to miss this, because these markets have swung wildly just within the last hour, so stick around.
All right, welcome to YFI PM. It's 1 p.m. in New York City, and stocks are paring their gains over a new coronavirus warning from the FDA. We saw that stocks were up higher than they are now losing some of that energy. On tap for today on the show, a host of C-suite shakeups. We're breaking down the CEO changes at Disney and Salesforce. Up next. Plus, we will speak with the CEO of Modell's Sporting Goods as retailers are coping with the coronavirus impact on supply chains. We'll also track the fallout of another Democratic debate as we gear up for the South Carolina primary. This is Yahoo Finance's YFI PM. I'm Dan Roberts in today for Zack Guzman, and joining me for YFI PM for the full hour, Yahoo Finance's Sabeel Marcellus is here, along with the CEO of retirement planning firm Kinder, Rian Horgan. Thanks for joining us.
It's great to be here.
All right, we're going to talk about
the markets.
We're going to talk about markets. Yeah, we're seeing green for the first time in 3 days. Let's talk about stocks because they are paring their gains as Bloomberg is reporting that an FDA official is warning the coronavirus is, quote, on the cusp of a pandemic. That is the key word that we've been talking about since Monday that no one wants to see become a reality. Now, total cases are nearing 81,000, with Brazil confirming it is a coronavirus infection. That is the first in Latin America. So we have to talk about the impact here. It's interesting because for a moment, about an hour ago, the Dow turned negative after it had been up by as much as 400 points. Right now, as you can see on your screen, up a little more than 100 points. So it's just hard to predict what's going to happen here because coronavirus, not new. We've been dealing with it for over a month. And yet, for the most part, stocks were kind of shrugging it off until this week when the reports started to get very bad.
Yeah, we want markets to rally. We want to kind of turn the page here, but it's really difficult for investors. So after 2 days of seeing red across the board, this morning was nice to see some green, to see the Dow actually go up to 400 points. But now there's new reports of another case in Brazil, and there's really no way to contain the coronavirus. And investors are waking up to that, and that's why we're seeing that the Dow still in the green, but coming down slowly.
Well, I think kind of the key question is consumer sentiment, right? And like, what's the other good news that's going to come up that actually is going to combat this? I was on Amazon myself last night, buying masks for the family.
Really?
Remarkably, I did it.
That's a good anecdotal indicator.
I mean, but remarkably difficult to actually get them delivered in a week. And I think that, like, as you think about like the little steps that the consumer is taking, I think lays kind of the foundation for some of the weakness that we're seeing right now.
You know, it's interesting, the anecdata, which I love, of, okay, we're at the point where some people are actually buying masks. And I also think, and I've been saying this since Monday, but the average person, I feel like, was shrugging off all the news about coronavirus. Obviously, it was alarming, it was concerning. But if you were here in the States, for a while, there had been something like 15 cases. And then this week is when it really took a turn. And I had people, just regular people who only watch the market a little bit, casually, texting me saying, oh no, coronavirus, and now stocks crashing. I mean, it really took a turn Monday morning.
I think also if you travel at all for work, you're feeling it when you go to the airport. And that actually, for me, last week, it was that moment at the airports that it became really real.
Yeah, and also with those travel advisories, so it's like, okay, maybe you shouldn't be going to China right now because you're dealing with the situation, but then it becomes also Italy, then you're looking at the Middle East, and it's like, well, where can I travel to at this point? So that's definitely weighing on investors, on consumers, on people who are just trying to figure out, what's what, and also a lot of misinformation about the coronavirus, people trying to get masks, fearing that it's going to run out of stock. So there's a lot of that going on. But the CDC coming out and saying that Americans should prepare themselves for the spread of the coronavirus, I think was really a big turning point when we saw that happen yesterday.
Absolutely.
It's like federal officials are actually saying this. Now it's a problem. But at the same time, maybe it was premature because it has not spread yet. So why tell us to prepare for something that we can't because it hasn't happened yet?
Trying to temper the expectations. Let's talk about what's happening in D.C. regarding coronavirus. The White House now reportedly weighing whether or not to appoint a special coronavirus czar to coordinate the response to the outbreak. That is according to Politico. Now, of course, yesterday we also got the numbers on what the White House is asking Congress for, a little over $2 billion to try to prepare for coronavirus in the U.S. And President Trump will be holding a press conference tonight at 6 p.m. to discuss the outbreak. It's interesting, I think, even more so than the debates, because you had a 10th debate. I think that's something you would see a lot of people watch tonight, because now that the awareness is so heightened among the average American person.
Yeah, and we should definitely be hearing from our president. In a situation like this, I mean, Americans want to hear from the White House. What is their strategy? How much should we be worried about this? Are there enough masks to go around? I know that you're going to be set in about a week once that's delivered.
I have a few extras. So.
Right. But for people who haven't, like me, are we going to be okay? Yeah. So, yeah, it's really important for President Trump to weigh in here and kind of calm the markets.
Yeah, I mentioned the ask for funding from the White House. Now, according to Reuters, Senate Democratic leader Chuck Schumer is preparing to send a proposal that would seek $8.5 billion to bolster the nation's coronavirus response. And as I mentioned, yesterday we saw a report that the number was more close to $3 billion. $8.5 billion would be a lot higher. Now, all these numbers out of context, it's hard to really judge. Well, is that enough? Is that too much? But you would hope that we would err on the side of asking for Congress too much, more than we need, rather than not enough for the response.
Exactly. We definitely want the health officials to have as many resources as they need to quarantine the right people who are infected to make sure that it doesn't spread. Also, there's going to be the impact on businesses. So restaurants.
Already has been, too.
There already has been. But if it spreads within the U.S., the impact will be domestically. So like local economies, cities, states. So yeah, we want as much resources to go to it as possible. If it's an emergency, I think that Congress will give the president and the White House health officials the resources that they need.
Yeah, I think probably what's scaring a lot of consumers today is really the story out of Italy. So the pace at which from one or two individuals that has grown, particularly when you hear questions around how are we going to deal with this in schools. It just really, you think about like the petri dishes that our children are around, and I think the Italian situation kind of probably gives a lot of fear to that.
Yeah, Italy, South Korea, Iran. There were a number, Switzerland yesterday, Austria yesterday, a number of countries that just hadn't even really been in the mix, hadn't been named before this week in terms of the outbreak.
And it's also the way they deal with it. So when you see quarantines, schools, kids, okay, school's canceled. So what does that mean for the parent? Like, how do you have to stay home? Like, can they not go to work? And also for offices, like you can't have half your staff be at home. I mean, yes, some people can work from home, but it depends on what job you have.
Right, and actually I've seen shares of Zoom have been way up over the last week, and I feel like not unrelated to coronavirus, because we're talking about telecommuting, maybe at a time when in many of these countries, people aren't gonna wanna go into the office. Let's talk about one of the big movers today. It's Disney. Disney shares have been under a little bit of pressure after a CEO shakeup announced at 4 o'clock yesterday that really took the market by surprise. Right now, you can see on your screen, Disney is down 2.6%. Yesterday, the company announced at 4 o'clock that Bob Iger, the CEO since 2005, is stepping down immediately as CEO. He will stay on as executive chairman through 2021. Disney Parks chief Bob Chapek is the new CEO. That is effective immediately, and the pair discussed their leadership change on CNBC last night.
Bob's legacy in the company is just profound. I think my role is now to take the strategic pillars that he's so well established over the last 15 years and continue to work on those and implement those in the marketplace.
Now, Chapek also said he has huge shoes to fill in taking up the mantle from Bob Iger. I should mention that Yahoo Finance named Disney our company of the decade at the end of 2019 because of all it had accomplished during Iger's leadership. Disney's market cap during that time gained about $175 billion. And of course, Iger steered 5 huge acquisitions, including Pixar, Lucasfilm, Marvel, 21st Century Fox, and I would add in there the acquisition of MLBAM Tech, which is that back-end video streaming company that now powers ESPN Plus and Disney Plus. What do you make of it? Iger, no longer CEO, especially after he had extended his contract and was supposed to remain CEO through the end of 2021.
Right, so there's always going to be some intrigue into the backstory. Like, why is he stepping down now? Like, why didn't he stay for the rest of the 2 years left in his contract? But at least they're telling a good story to investors and reporters. So it's a good narrative that they're working together now, and Bob Iger is still going to be in charge of like the big headline creative types of decisions, but that Bob is in charge, well, they're both Bobs, but Chapek is going to be in charge of basically running the company. It will be in his hands. And he will also be able to learn from a mentor, from Bob Iger. So hopefully for investors in Disney, it's like, okay, there's confidence. You look at the stock of Disney, it was down by 1% before. So it's like investors are okay with this succession plan.
I think one of the questions to think about going forward, though, is like where's the earning power for Disney and kind of the parts of experience. So interesting that the new CEO comes from the kind of the parks experience. When you think a lot of the success more recently, you think about the Disney Plus, the media, and really kind of understanding where they're going to lay their bets and what that means actually from a leadership team perspective.
Rian, do you have kids?
I do. They love Disney Plus. Like,
it's funny because we were sort of talking so much about Disney Plus before it launched. Then it had a mega successful launch, got big numbers very quickly. But the knock against Disney has been, I find it a little bit of a weak argument, but Disney Plus, very kiddie content. Clearly, Disney is using Hulu as the more adult outlet. Disney now is the majority owner of Hulu, and they're putting all FX shows on that. And the other knock being that even all the big money-making things at Disney right now, Star Wars, Marvel, all of that, Pixar, they've been mostly sequels and remakes. It's not completely original from scratch, fresh. It's building on existing franchises. Yeah. What do you make of that?
I think at least for the younger generation, it's reigniting this younger generation with this whole series of content that they actually haven't been exposed to a lot of. And so you have, my 7-year-old son spending his pocket money to buy Frozen 2 like the day it comes out, calling me like an emergency at the office. But when I think about about actually the quality of the content they're actually getting to see. Like as a parent, actually, that's really good.
You've seen it before.
Yeah,
so
I've
you know
seen it,
okay.
and so, but it was some things that I saw, 20, 30 years ago, which is so much better than a lot of the things that's out there today. But I take your point, which is like, what's the content actually for me? Like I personally, I'm not checking in on Disney Plus, and so just kind of thinking about like the
Not
dynamics.
a Mandalorian.
Yeah, my husband is, so it's just thinking about just the different members of the family. But I do think for the younger generation, like there is purchasing power through the parents there that I think is exciting.
But also, I feel like Bob Chapek has his hands full because he was in charge of theme parks. And remember, in Disney, their theme park in Shanghai has been closed because of the coronavirus.
Yep.
So he definitely has a lot of concerns, a lot of things to worry about. The streaming side is doing really well, but when it comes to revenue from those parks, that's probably going to take a hit this quarter.
Yep, it will. Although, of course, a good reminder, Chapek being the parks guy, that parks are still the profit engine of Disney. That has been the case for a while. Now, we mentioned Iger stepping down as CEO yesterday. We also had news yesterday that Salesforce co-CEO Keith Block is stepping down after just 18 months on the job. That is with the title of co-CEO, and that leaves Mark Benioff as the sole CEO. Guys, we have seen a real CEO exodus over the last year or so. Yesterday when we got the news about Salesforce, the news about Disney, and also yesterday MasterCard CEO Ajay Banga stepping aside, it reminded me of the day in October when both Nike CEO Mark Parker and Under Armour CEO Kevin Plank announced that they would step down. Maybe all unrelated, maybe just coincidental, but all at once we are seeing a changing of the guard in terms of longtime iconic CEOs ready to hand over the reins.
I think that's a great thing. If they're iconic and they've been really successful with the company, hopefully they can also mentor the next generation to be able to take the reins. It's all about legacy for these CEOs. So it's like, did they leave because they were fired? Was there a scandal? Or is it because they found a better opportunity? Or naturally they wanted to retire and move on to other things?
Sometimes there's no big secret there.
Well, I also think about when you think about like the long-term value of a company, if it's related to one founder, that becomes really challenging.
Right.
And so there is this natural for companies that have been around 8 or 10 years, like there is this natural, like who is that next level of leadership?
Succession.
Prove it out, exactly.
All right, coming up here on Wi-Fi PM, we will dive deep on the Dem debate last night in South Carolina, where wealth inequality was a big focus. Stay with us.
I mean,
Well, the 2020 election is heating up with Democrats taking jabs at President Trump over coronavirus during the debate last night. Let's watch.
You read about the virus, what's really happening here is the president fired the pandemic specialists in this country 2 years ago. So there's nobody here to figure out what the hell we should be doing. And he's defunded Centers for Disease Control, CDC, so we don't have the organization we need.
This great genius has told us that this coronavirus is going to end in 2 months. April is the magical day that this great scientist we have in the White House has determined.
If you look at the biggest threats to the United States, we're talking right now about coronavirus that cannot be solved within the borders of the United States.
As president, what would I do? I would better coordinate throughout my presidency to be ready for the next pandemic and to prepare for this one.
Now, it's interesting because I was watching the debate, and it took quite a while for coronavirus to actually get mentioned.
Yeah. They went after Bernie Sanders' socialism platform before they got to the coronavirus. But I think the shots they took were pretty easy because there's so much uncertainty right now happening in terms of fears of the spread of the coronavirus. Where would it happen? Do we have enough resources? And that's why I think it's critical that President Trump, put politics aside, we really do need to hear from President Trump this evening to kind of calm Americans and at least tell us what the plan is going forward and also how many confirmed cases. We'll see what he says.
Yeah, I think the sequencing, though, of last night's conversation was obviously this realization by the Democrats that they have got to figure out as a party how they're going to come up against Trump, because the turning on Sanders was this recognition of he's winning. Will he actually win the big game?
Yeah, and the problem when the Democrats
I'm not a political analyst.
Yeah, no, but that's
don't think so.
Yeah, the problem when they turn on each other is we get it. It's a competition. Yeah. I don't like the word contestants, which is what Bloomberg used. It's not a game show, but this is our democracy.
Yeah, and that got its own mocking because people said, he can't bear to say my fellow Democrats.
Right.
One of the knocks is, only running as a Democrat in order to get in there, not really.
Right, he got a lot of knocks for being a Republican and supporting Republicans and all that.
Sure. Let's keep talking about the debate here. Now, the 2020 hopefuls also sparred a lot with frontrunner Bernie Sanders, as we mentioned, attacking Senator Sanders' electability as president.
Bernie and I agree on a lot of things, but I think I would make a better president than Bernie. I dug in, I did the work, and then Bernie's team trashed me for it. We need a president who is going to dig in, do the hard work, and actually get it done.
If you think the last 4 years has been chaotic, divisive, toxic, exhausting, imagine spending the better part of 2020 with Bernie Sanders versus Donald Trump. Think about what that will be like for this country.
Bernie Sanders' analysis is right. The difference is I don't like his solutions.
Easy shots at Sanders because time to go after the frontrunner. And it's funny, we're showing sort of all them talking about Bernie. I actually thought Elizabeth Warren still spent too much time going after Bloomberg. It was okay, you did that. That was a week ago. It went great. If you want to get a leg back up, you need to go after the frontrunner right now.
Yeah, and she did a little bit. So she was basically saying that Bernie Sanders is right, but she would be the better person to be president and actually implement what he's proposing. In terms of Bernie Sanders, I think he was strongest when he just stuck to his message. When he talks about socialism, communism comes up, and I think that's where he starts to kind of starts to not shine as bright. And then also they were asking him, they were trying to pull him into a trap, asking him do you support dictators and autocrats? Bernie Sanders does best when he just focuses on the U.S. economy, basically saying that it's not working for all Americans, that the top 1% is getting richer. Most average Americans, their wages are pretty much staying flat. When he speaks about that, I think it resonates more with voters, and I think that's really what's helping him win the primaries up until this point.
Definitely a topic in your wheelhouse, Rhian, focusing on retirement and all that as we talk about potentially Medicare for all and what Bernie's trying to push.
Look, what's interesting is when you look at the retirement topics, they actually didn't get a lot of airtime last night, and I think that's because there's actually pretty fair consensus. The Democrats aren't going to reduce Social Security. We know that the cost of healthcare is a problem. Now, there's implementation differences. In particular, you see the more moderates of the party trying to find ways for savings to be part of the solution rather than just spending. I think what's interesting when you look at particularly the healthcare platforms is you're starting to see some real recognition of the cost of long-term care.
Yep.
And you're seeing that through Bloomberg, you're seeing that through Buttigieg, and I think that's going to become a bigger and bigger conversation as we move forward, rather than it just being a kind of a Medicare for all conversation.
Well, another huge topic at the debate last night was climate change. That came up a few times. Billionaire Tom Steyer slammed the Trump administration's strategy to combat climate change. Watch.
We're talking about climate change, which is a global problem where we need U.S. leadership for countries around the world. In fact, Mr. Trump's policy of us going it alone, of America first, of having no values, no allies, and no strategy is disastrous for us.
Tom Steyer pushing climate change there. And joining us to discuss more is South Carolina Attorney General Alan Wilson. AG Wilson, thanks for joining us.
Yeah, thank you for having me. It's great to be with you today.
Now, you are suing the Trump administration over offshore drilling along the coast of South Carolina. Obviously, that is going to be very interesting to watch as that moves forward. What are your thoughts on the debate last night, and how does that inform what you're up to right now?
Well, first off, I was down in Charleston yesterday evening. I was talking with a lot of supporters of various Democratic candidates, and I love going to these type of events when I don't have a team on the field. It's kind of going to a football game where you can enjoy the tailgate without having to worry about winning or losing. But it was interesting. I thought last night was an incredibly important debate for some of these candidates. In fact, it was probably the most important debate for this reason. Last night was the last time they were all going to be on stage together, all get a chance to take on Bernie Sanders, to blunt his momentum, and for Joe Biden to shore up his firewall, because in 3 days we have the South Carolina primary, and then literally 3 days after the South Carolina's primary, you have Super Tuesday. And I think South Carolina is important for a number of reasons. Under the first 3 states that went ahead of us, 2 of them were caucus states. Caucus states, as you know, are a little bit more cumbersome because the caucus process, you have to, there's a larger time commitment to going into a caucus, and usually you get a more committed voter, someone who's more passionate about the issues and the candidates, as opposed to a primary state where people can come and go on their way to and from work. And New Hampshire was a primary state, but the difference between here and New Hampshire is you're going to have a much more diverse, a larger black turnout in the Democratic primary. So I think it's going to be a microcosm of what's to come on Super Tuesday. Not totally dispositive, but it'll be indicative of what's going to happen. So I think this is an incredibly important debate. I don't think really anything really happened last night that is going to change the Super Tuesday results. But I do think last night nothing really changed the momentum of Bernie Sanders. But I do think Joe Biden showed a little bit of life despite the gaffes. But a Clemson University poll today shows that Biden has opened up his lead in South Carolina, and I think his firewall might hold and keep him alive to fight another day.
Yeah, and Alan, as you mentioned, Biden expected to take South Carolina, but obviously Bernie has been surging. Let me ask you to zoom out a little bit and tell us a little bit what you're hearing from businesses, companies in your state. Yesterday, we were joined by the head of the South Carolina GOP. We were talking about the same issue. Business leaders there watching with interest, regardless of their political affiliation, for who it might be in the end from the Democratic side.
You know, the business leaders I talk to are absolutely terrified generally of Bernie Sanders, but of kind of some of the themes that they're hearing come out of the candidates running for president. But what's interesting is in South Carolina, a lot of the Democrats, they come off as fairly moderate. I have a lot of friends in the Democratic Party. They're good people. They're well-intentioned people. And they really try to appeal to the business community. The problem is when you have candidates like Bernie Sanders and Elizabeth Warren and some of these extreme socialistic views that are being put forth on the national stage, it is very hard for local Democrats, either local congressional candidates or local state house and state senate candidates, to come to the business community at the same time distancing themselves from the national ticket. So it's going to be a balancing test for the Democratic Party going forward, at least here in South Carolina.
All right, Alan Wilson is AG there in South Carolina, the Attorney General. Thanks for joining Yahoo Finance.
Thank you very much.
Well, as we mentioned, wealth inequality was a hot topic of the night last night at the debate, with Senator Sanders calling out billionaires like Mike Bloomberg.
The economy is doing really great for people like Mr. Bloomberg and other billionaires. In the last 3 years, billionaires in this country saw an $850 billion increase in their wealth. But you know what? For the ordinary American, things are not so good.
All right, joining us to talk more is the chair of the Patriotic Millionaires, Morris Pearl, here in studio, along with Yahoo Finance's Max Zahn. Thanks for being here, both of you guys.
Great to be in your show.
Thank you. Good to be here.
So, Morris, let me go to you first. Mentioned wealth inequality, obviously a stumping ground for Bernie. That's nothing new. But bringing it up in the debate last night, a couple interesting moments. What did you make of it?
Look, wealth inequality is a big problem for our nation. That's why people voted to reject the status quo in 2016. That's why they voted for change again in 2018. And it's not sustainable. The current progress of going to a few rich people and lots of poor people doesn't work for anyone. We can't make money and become rich in a country with a lot of poor people and a very few rich people at the top. It doesn't work.
Now, what's interesting about that, your point is well taken, because ironically, there's a similarity there between Trump and Sanders, at least in terms of as political candidates, because Trump and Sanders in some ways have appealed to the same Americans, which is ironic considering that Trump is himself a rich person.
Same populism.
Yeah, the same populism, as he said. So many people want a change. The same people who voted for Trump said Sanders is their second choice and vice versa. We need a change in direction in our country, and we did not get it. We got a billionaire who made changes to tax laws to make billionaires even richer, to make real estate developers even richer, and we did not get anything that actually helped the regular working Americans.
And does one of the presidential primary candidates in the Democratic Party best embody what your organization is trying to do?
Well, frankly, now all of them are. They are all talking about tax the rich. They are all talking about more taxes for billionaires and wealthy people.
But we have, for instance, Bloomberg, and he's somebody who has spoken about taxing the rich. He's a billionaire who wants to tax the rich. You're a millionaire who wants to tax the rich. But at the same time, he's spending hundreds of millions of dollars on ads to get near to the top of the polls in this race. Is that an abuse of power by the wealthy in the same way that you speak of abuse of power by the wealthy on our political system by having low taxes?
Well, no. I mean, we think that everyone should be able to run for office, including billionaires if they want to. We do think we should have a campaign finance system that allows regular people to run also, not just billionaires. We've seen huge success here in New York City with our campaign finance system that has changed the face of city council, or the faces in the city council. And we believe that everyone needs to be able to run for president like Michael Bloomberg is.
Well, Bernie Sanders has been accused of inciting class warfare. And we know that billionaires have gone on TV and complained about so-called wealth taxes, like what Warren's proposing, what Bernie Sanders is proposing. Do you think billionaires have the right to complain about being taxed more with all the resources that they already have?
No, I don't think they should complain about being taxed more. We already have class warfare. We've had class warfare for the last several years, and the rich class has won. The rich is becoming richer and richer and richer at the expense of the rest of the country. So they've already had the tax warfare, and the regular people have been losing.
And you have said in the past, I believe you said last year, you described members of the organization as capitalists. You said it's great to be rich. Does Bernie Sanders go too far identifying as democratic socialist?
No, I think he can identify as whatever he wants. And yes, I think we'd all agree that it's great to be rich. I recommend everybody become rich. That's fine. We're not against rich people. We're in favor of everybody having the opportunities to become rich. I want my granddaughter to have the same opportunities, grow up in the same country where I did. And the last couple of years, our country's been changing. And we're not giving our next generation the same opportunities that my generation had to grow up.
Morris, does your organization, or will it, endorse a candidate in the end?
In the end, sure. I expect that we will endorse one of them. We've endorsed a number of House candidates. We've not endorsed any candidate for the United States presidency yet.
We'll talk again when you do.
All right. Great.
Morris Pearl, thanks so much for joining us.
Thank you.
Max Zahn, thank you.
Great to be in your show, guys.
Coming up here, before we go to break, we want to give you an update on Nokia. The company is reportedly exploring strategic options amid the fierce competition we've seen in telecoms. And that stock right now is spiking on that report, up more than 8%. Of course, strategic options often includes a sale. It means an acquisition. So we'll be watching Nokia, and we'll give you an update soon. Next on the show, after a quick break, we'll discuss how coronavirus is messing with retail, specifically with sporting goods. We will have the CEO of Modell's. Stay with us. Now, as you can see, stocks for the moment are still in the green. The Dow right now is up almost 100 points, but we've really seen all three major indices pair the gains that we saw about 3 hours ago. And briefly, the Dow did turn negative, but right now we're seeing green for the first time this week. Now let's talk coronavirus and sports apparel. Nike, Adidas, Under Armour, Puma, all warned in the last 2 weeks about the impact of the virus on their sales this quarter. And joining us now to discuss more is the CEO of Modell's Sporting Goods, Mitch Modell. Mitch, thanks for joining us.
Thank you. Thanks
so
for
let's
having me.
start with coronavirus, because the impact is obviously on supply chains. A lot of these companies source their goods from China. Nike sources like 25% of its goods from China. What are you hearing from these companies? Because obviously, for Modell's, you guys are talking to them constantly.
Thank God footwear is probably the least amount of hit we're going to have regarding China. Everyone with all the tariffs moved it out of China. It's more of an apparel and sporting goods issue.
Wait, so that is so interesting. Because of the tariffs, ironically, a lot of these companies moved their supply chains away from China.
Correct.
That was pre-coronavirus. Now you have coronavirus, so ironically, it has benefited them.
Correct.
Wow.
Had the tariffs not happened, I think the state of the economy would have been a disaster.
Well, let's look at the retail sector overall. Are we in a retail apocalypse, and how has that impacted you?
Well, I mean, look, retail is definitely tough out there. You know, customers, they're holding on to their dollar. You know, you look at the players that are winning are all the value players. We're doubling down on value. I mean, that seems to be the winning formula when you look at the Walmart, the Targets, the Costco's, the TJ Maxx, the Marshalls, the Five Below. Those are the guys that are winning. And, the guys that are caught in between are the guys that are struggling.
Let's talk about store closures, because I'm glad Sevilla used the phrase retail apocalypse. I mean, it has been the case that the death of brick and mortar has been a little bit exaggerated. A lot of these chains, as you mentioned, still doing well, but we also have seen a lot of chains just completely die. I mean, the disappearance of Sports Authority was really damaging to a lot of these companies. Now, you guys had announced a certain number of closures, but in the end, didn't have to close as many stores. In terms of the strategy there, I mean, what have you learned, or what are you seeing in terms of companies, either in some cases they overbuilt and they simply opened too many stores to begin with, and that's why they've closed some. How do you determine which stores to keep open, which to close?
Okay, so you asked a couple of questions, so we'll tackle one by one. So the first thing is, we announced on Thursday we were closing 24 stores. We were able to work with a couple of landlords to reopen some of those stores that were on the closed list, and we were able to save 98 jobs. We're still working the phones as we speak before I came on air, calling the landlords and seeing how they could work with us. In terms of size, with the internet, and, we call it the endless aisle. Most retailers call it the endless aisle. You don't need as big as stores. You put in the distribution center and you can fulfill from there, but still give the consumer a great selection.
So you guys lost $50 million in sales last year. In 2018, you considered possibly bankruptcy. So where are you positioned right now with the coronavirus? Are you concerned about production in China, or you're just doubling down on just discounts?
Coronavirus is like something we'll think about like in 2 weeks.
Okay.
Right now, we are working the phones with our landlords and our vendors to support us. If I get 90% collectively support, we got a path to success. Without that, we're trying to do everything outside of restructuring. And, the last thing a landlord wants to see is another empty store. But when the landlords look at empty stores, then the next tenant they have to come in, they got to give them construction allowance. Then the retailer's going to want free rent. Then they got to pay broker's commission. When you model it all out, what I'm asking for this 90-day grace period with our landlords is some type of relief to increase our liquidity, as opposed to having to file the first week in March.
Are you seeing receptivity different based on which market, or is this kind of like a retail real estate kind of?
You know what? I'm making the calls myself to the CEOs and the owner of their properties. Last year when the Wall Street Journal article came out, we asked for the help, right? Life was turned upside down, and some worked with us, some didn't. Now we're up against the clock. Yep. This is no longer, can you help us? If I don't get complete support, I'm going to see them in court. I'm trying to do everything possible to save 3,300 union jobs and to preserve the integrity of our relationships with our vendors and our landlords.
So if this does not work out, you're saying that Modell Sporting Goods could go bankrupt?
Yeah.
Well, and tell me about the pressure you're facing, because this isn't just business, this is personal. You're the fourth generation CEO of this company, was started by your great-grandfather.
Right. Unbelievable.
How are you managing all this, the emotion of it?
How am I managing? A lot of Valium. No. Listen, you know what? We're trying to preserve 3,300 jobs. At the end of the day, our name is on the door. And that's enough incentive for us to do whatever it takes. But you know what? At the end of the day, we're being totally transparent. We're open to the whole world and letting them know, here's what we're doing. People that are working with us on the plan, I'm going to be showing them our borrowing-based bank certificate on a weekly basis. I'm going to be showing them a 30-day cash flow report, outreach. So and this is only things that you give to your vendors, to your lenders, to the banks. I'm saying to our vendors, to our landlords, I'm prepared to show you everything so we hold hands together so that we don't have to have a situation where we'll be forced to see them in the bankruptcy courts.
And Mitch, let's end on this. Most recently, news that coronavirus could not only have an impact on supply chains for the sporting goods companies, of course we know that, but even maybe affect contact sports as well as people going to stadiums for pro sports events. Obviously the connection there to apparel is if fewer people are going to sports events, maybe they're not buying jerseys and shirts and hats to wear to those sports events. Are you watching that? Are you concerned about that?
We're not concerned about that. Listen, we know it's going to be a blip. We know eventually they're going to be able to solve the problem. And listen, a lot of people, as we speak, are moving sourcing outside of China. There's a lot of places, Dominican Republic, Mexico, places all over the world where they can make manufactured goods.
You're doing it too?
No, our manufacturers are doing, but we're in contact with them on a daily basis to see which goods we have to replace. Again, the biggest item is like fleece, sweatshirts, sweatpants that comes out of China. So they're moving to relocate, and we're calling different suppliers to make sure that we're able to keep up with the demand.
All right, really interesting. Mitch Modell, thanks for joining us.
Thank you.
Good luck with handling everything. Coming up here on YFI PM, we will talk coronavirus and tech, how the virus is mucking up Apple's iPhone production, as well as what Twitter and Facebook are trying to do to combat misinformation about the virus. Stay with us. Welcome back. We're closely watching Apple as the tech giant deals with supply chain concerns over coronavirus. Good time to check in with Yahoo Finance's Dan Howley, who is live at Apple's Investor Day in Cupertino. Dan?
Yeah, we're here at the shareholders meeting, just wrapped up. There was little talk really about coronavirus and its impact on Apple's supply chain. In fact, none of the shareholder questions about the company had anything to do with that, though they did for some reason ask why Apple didn't purchase the rights to Friends for Apple TV Plus. What we did hear, though, was Apple reject 3 shareholder proposals, one that would link executive compensation to environmentalism, another that would have added a second shareholder seat to the board, bringing that from 1 to 2 seats, and a third that would have had Apple declare its stance behind the freedom of expression and kind of how that relates to China. Now, Apple's board rejected all 3 proposals, saying that it has to abide by laws, for instance, in China, where it has to take down VPN apps, as well as the fact that it does a lot of work in the environmental area, and says that if it added a second seat for shareholders to the board, it could make it too confusing and kind of mess with the flow that they have already there. But Tim Cook took the stage, took several questions, some about when they're going to invest more fully in India and have their own shop set up there. He said later this year they'll start to have online sales, and then next year they'll have their first physical presence there in India. He said that they're very much looking forward to growing there and expanding, and that it's a very vibrant market. So that could be the next big place for Apple to truly expand. They have tried to get in there previously, but they weren't allowed to based on government regulations that would have prevented them from running their own stores and had to have them work with third parties. And Tim Cook said that that's not really how Apple does things, and they're glad that they can run it on their own now. But really no talk of coronavirus outside of Cook saying that it's been impactful on Q2 and that they're working to deal with the fallout, but no shareholder concerns from that. It seems like mostly people are looking to the future of what Apple has to do, and that this will be a blip on the radar for now.
Yep, and Apple stock has been very resilient over the last year. Dan Howley, live in Cupertino, thanks so much. Well, Facebook is taking a stand when it comes to disinformation surrounding the coronavirus. The social media giant is planning to ban misleading ads about the outbreak. A spokesperson told Business Insider, "We recently implemented a policy to prohibit ads that refer to the coronavirus and create a sense of urgency, like implying a limited supply or guaranteeing a cure or prevention. We also have policies for surfaces like Marketplace that prohibit similar behavior." Now, what's interesting is this announcement from Facebook comes just 1 month after the company said it would remove coronavirus content that included false claims or conspiracy theories. And guys, this is very important, obviously. Facebook needs to cut down on misinformation about coronavirus. It also, to me, if I'm wearing my skeptic's hat, is a little bit of trying to use this opportunity to do a little bit of damage control from past times when the company was criticized for not adequately combating misinformation.
Yes, absolutely. Facebook is trying to get ahead of this, saying, look, everybody, we're actually banning ads, we're banning misinformation. But let's remember that they were also banning ads for anti-vaccine type ads and that kind of bad information. And BuzzFeed did a report in January and found that there were still anti-vaccination ads on the Facebook platform. So the problem with Facebook is that oftentimes they like to tell the media we're doing this, but then when you go on the platform, you find that it's not being policed as well. So it's good that Facebook is doing this. This is very important. They're working with the World Health Organization, and we'll see. But you can't just take their word for it.
Yeah, look, I agree with that. I think if I compare it to kind of the anti-vax analogy, the good news here for Facebook is like the consumer should be supportive of what they're doing, right? There is kind of no middle ground. If they're doing it, like you're coming out on the side of the consumer, which from a PR perspective has to be a strong play in this moment in time.
Right. And I want to mention also, while we're on the topic, Twitter is alerting users when it comes to the spread of coronavirus disinformation. I noticed just yesterday that when you search something in the search bar on Twitter now, if it is a phrase that includes the word coronavirus, you get this alert that we are showing right now on the screen. Before you actually see the search results, it talks about knowing the facts, and it gives you a link to the CDC website, and Twitter actually started doing that at the beginning of this month, back at the beginning of February. Now, coming up here on the show, amid market turmoil from coronavirus, how should you be thinking about your retirement plan? We will discuss. It's part of our America Saves Week. Welcome back. This week here at Yahoo Finance is America Saves Week, and we're focusing on the topic of emergency savings. Now, concerns are growing over the coronavirus outbreak and its potential to spread here in the U.S., and that has prompted experts to call on Americans to build up their emergency savings to cover unexpected events. Joining us now to discuss is Timothy Flocka. He's the executive director and co-founder of Commonwealth. Commonwealth is a partner of the Funding Our Future campaign. So, Tim, thanks for joining us. Now, you guys have a new study out showing 78% of Americans live paycheck to paycheck. So this is hard for them to be able to prepare for an emergency situation.
Yeah, that's absolutely right. If you think about what keeps us up at night, it's not just whether we're ready for the long term, for retirement. It's the fact that increasingly half or more of us are wondering if we're going to have the money we need to make rent and to cover day-to-day expenses. And so when you think about what you can do about that, building up that reserve of emergency savings is in some ways really the best tool to handle that kind of daily financial stress.
All right, so help us do the math. I know it's different for everybody, but the coronavirus, the possible spread of it, how much should we have in emergency savings to get through this?
That is such a natural question, and we tend to think about it a little bit differently. If you think of emergency savings as building up a reserve and then drawing on it when you need it and then replenishing it so that those moments when you're worried about making the rent, you can turn to yourself first to solve that problem, then you get focused less on trying to reach a certain amount, and you really focus on simply doing it, making sure you're regularly, consistently putting a little bit aside and you're ready when those unexpected or expected expenses come along.
Timothy, at the end of last year, we saw the Secure Act pass, which really focused on a more strategic long-term savings for retirement. What would you like to see Washington focused on this year when it comes to this more short-term saving needs for the consumer?
Yeah, that's a great question. And I think the way we look at this is that it's just natural to think that this is an individual issue. Are we ready to handle the day-to-day of our own finances? But when you think about what happens to that person who's freaking out about being able to make rent, that person is no longer the best employee. They're not providing the best customer service. They're not the parent they want to be. They're not the neighbor they want to be. And so the time is kind of arrived for us to see this as not just an individual issue, but an issue of national importance. So to your question, we would like to see action by institutions, our employers, our financial service providers, perhaps our retirement plan providers, to give us the tools to build up these reserves of cash and draw on them to manage our financial lives.
Yeah, so one idea on that front might be around 401k. So today, as a consumer, you are able to borrow from your 401k to make your first home purchase. I wonder whether an analogy there might be a certain amount of borrowing. Obviously, you want to keep people investing for the long term, but how can you borrow short term, when you have these crisis situations out of your 401k with the real focus that you're not depleting the long-term savings?
And maybe we could go a step further and have those plans actually offer a savings option for folks so that they can build up cash in the plan or next to the plan, if you will, so that you don't have to dip into the long-term savings when the unexpected arrives. We think that holds a lot of promise. We're hearing a lot from employers who are interested in their retirement plan providers, making that a realistic choice that they can offer their workers.
All right, Timothy Flocka, thank you so much for joining us. Really important topic as we watch the news about coronavirus. Thanks. Now, before we go to break, we want to remind you what is happening with markets, where the Dow just flipped into the negative. Stocks just hit their session lows for the day as Nassau County health officials are monitoring over 80 people for possible exposure to coronavirus. You can see right there the Dow and S&P in the red now, the Nasdaq hanging on to gains. And coming up on the show, it's one of the industries most directly affected by coronavirus, airlines. We will talk about how you can mitigate your stress while traveling during this time with the folks from the site The Points Guy. Stay with us.
At WCS, our conservation impact is unrivaled. We work in 60 countries with more staff in the field than any other conservation organization in the world. With our zoos and aquarium, we inspire 4 million people every year to care for nature. We stand for wildlife and wild places. Stand with us.
The Angry Birds Movie 2. Pig and bird will fight together.
Time for Plan X.
Plan X? I thought you said spandex. When enemies team up.
We gotta stop that super weapon.
Does anyone smell bacon? The battle is on.
We're gonna need a disguise.
Uh-oh. I think he's challenging us to a breakdance battle.
Whoa! Didn't expect that.
The Angry Birds Movie 2, rated PG.
Rent or own this movie today with Fios On Demand.
What country has another country's monarch on its money? Canada, you're better than this.
If you could design a new $1 bill, who would you put on it? Oh my gosh. Who taught you more about money, your mom or your dad?
My husband.
Hamilton taught me fiscal responsibility.
On my way here, I just bought a stock.
I don't buy anything I don't need.
I was broke once. I don't need to do that again.
This summer,
I'm in a car!
us too! Why go out when you can stay in and watch Pets 2 with your whole family?
Yeah, I'm gonna be the first bunny with washboard ass.
Do something crazy!
Loved by audiences everywhere.
What's going on?
My owner got a new puppy.
My name's Tiny.
Nobody cares.
The Secret Life of Pets 2.
Rent or own this movie today with Fios On Demand.
Welcome back to Wi-Fi PM. Now, the coronavirus has had a big impact on the travel industry. Reuters reports that the U.S. is now posting travel advisories for Iran, Italy, and Magnolia in an effort to contain the virus from spreading. Now, this comes as a recent report from the International Air Transport Association says the outbreak could leave global airline revenue nearly $29 billion short this year. That's after so many years of record profits for the airlines. Joining us now for more on this is senior travel editor at The Points Guy, Melanie Lieberman. Melanie, thanks for joining us.
Thanks for having me.
So what does this mean for the average person? What's the impact? Because we were discussing this earlier in the show, but for weeks we've seen the headlines about coronavirus, but the average American could sort of not worry that much about it. And stocks also were not really responding, shrugging it off. Now this week we're seeing a number of new countries mentioned, and it's becoming obviously much more concerning. So should people traveling and flying in the next few weeks be concerned, and what should they do?
Yeah, it's a really tough situation, obviously, and still very much developing, but we are urging travelers to keep their peace of mind at the forefront. And if you're not comfortable traveling, it doesn't matter where you're going, you're not going to have fun, you're not going to enjoy your trip. So if you don't have any urgent travel plans coming up, we do advise travelers to take a step back, think really carefully about where they're going. Now might be a great time to travel around the United States, stay closer to home. That's what we're recommending right now, but it is obviously a developing situation and we're still watching.
Go see some of our national parks.
Absolutely. I think it's a great time to go to the Glacier, maybe Yellowstone, get far out there.
But if you have to be on a plane right now, what is your recommendation? I mean, should you wipe down the tray? I mean, what else do you have to do to protect yourself?
Yeah, again, I mean, there are only so many things people can do to avoid travel right now. If you do have plans, I think wiping down your seat, especially your tray table, those super high touch, hard surfaces, that's a great recommendation. Even if it makes you feel better, it can't hurt. Use, wipes with alcohol in them. A lot of them do kill very common viruses, so definitely wipe down your seat. Make sure to wash your hands a lot. It's really, really basic stuff, but you should be washing your hands every time you think about it, and then keep your hands away from your face as much as possible.
So let's talk about cruises. It's like the Great American Vacation, or perhaps it was the Great American Vacation. Do you think the cruise industry is going to be able to recover from the stories that we've been hearing over the last couple of weeks?
Yeah, I think down the road the cruise industry will certainly recover, but I do think it could take some time for it to bounce back. Frankly, we've seen cancellations through the end of the year in Asia. So there are significant cuts in terms of service. It's going to take a while for that to change. It's going to take a while for travelers to feel comfortable cruising.
And getting back to airplanes, so are there any flights to China happening right now? Have they all cut back? You just can't go there?
All of the U.S. carriers have cut service to China at this time. You can still get to China, but it is really, it's a level 4 advisory from the U.S. State Department right now. So travelers really should not be traveling to China unless there is no way around it right now.
Something on everyone's mind. All right, Melanie Lieberman, thanks so much for joining us.
Thanks for having me.
We want to thank our panel for the day too, Sabeel and Rian Horgan. Thanks, guys.
Thank you.
Good stuff. And we want to remind you what stocks are doing. For more insight on that, we're going to bring in Inez Frey live on the floor of the New York Stock Exchange. Inez?
Yeah, Dan, I'm here with Alan Valdez. And Alan, we erased our gains from earlier today with a Dow that had been up more than 460 points. It started with Germany saying that they were at the beginning of the coronavirus epidemic. Then you had the FDA warning. Then you had this headline that everyone here is talking about now, that Nassau County, 83 people being tested for coronavirus. What do you make of all this?
I mean, it just moves the market. Anything with coronavirus moves this market instantly, and we saw that, like you just mentioned. Nobody has it. They've tested people, but there's no positive testing going on, and it's down instantly. 85 people. No one knows what's going on over there. They've all been tested okay, but the minute they start saying, "Hey, it's in New York State," investors see that and sell.
So is this all about just, do we need headlines that are going to be more, we've got this contained, this is, I mean, President Trump is going to be, said a 6 p.m. presser to talk about the coronavirus. What do you think that may do?
Well, you know, he's going to try to reassure the public, I'm sure, but the basic thing, you can't. No one knows, and it's the unknown that moves this market. One of these headlines might be real, and it's going to be a disaster, and it's going to sell off, or it's going to be positive, it's going to go up. But it's all this unknown. It swings it instantly. You know, when I was a kid down here, these things would never have these violent swings. First of all, there'd be one newscast like at 7 o'clock. Now they just spit out these stories instantly, and these fast momentum traders are in and out real quick.
All right, thanks so much, Alan. Dan?
All right, thank you, Inez. Now, obviously, stocks are erasing their gains over the new concerns about coronavirus spreading. Two experts will weigh in next. That's on our show, The Ticker, and it starts in 2 minutes.
Kamlani. And Anjali, we have President Trump. He is expected to hold a press conference on the virus later on tonight. What are you expecting, and just what is the latest in regards to the numbers that we are receiving?
Yeah, so as we've been saying all day, the numbers continue to increase. We know that there have been more than 81,000 cases, with more than 2,700, nearing 2,800 deaths worldwide. Still a large portion of them in Asia, but we have seen, isolated cases emerging around the world, in Europe especially, and in the first case recorded in Latin America. So we are seeing this spread into what health officials had feared was going to be global, which is where there have been some reports of comments about this potentially becoming a pandemic as feared. But for the most part, we're still just watching and waiting. The number of cases in the U.S. has not increased at all. Looking tonight for what President Trump is going to say, we're waiting to hear what the official word is, because with the strong showing of health officials yesterday, we did hear some concerning words about what the potential impact to the U.S. is going to be. And if you take a look sort of side by side, what Trump has said versus what his officials have said, he's been tweeting that the virus is contained, that it's going to be okay. Meanwhile, we heard just today that we could be on the cusp of a pandemic from an FDA official. He's tweeted that it could go away by April, while officials are saying we don't know when this is going to go away. It's a very communicable disease. There is no end in sight just yet. And on the point that you made earlier of appointing a czar, while Trump has said that, we heard Health Secretary Alex Azar say earlier that a czar is likely not going to be appointed. So we really do need some reconciliation of messaging here at this point, and that is what we're going to wait to see after markets close. That'll be when the announcement will be made.
And Anjali, we just have this crossing the wires now. It looks like 1010 Wins is reporting that 83 people in Nassau County are being monitored for possible coronavirus exposure. So we just talk about the fact that the U.S. has been on edge just in terms of the number of cases that could quickly escalate. So, of course, reports like this is something that the street is closely watching as well.
Absolutely, yes. Important to note, no increase in cases in the U.S., but yes, the advisory is obviously coming on the heels of, federal health officials as well.
All right, Anjali, thank you so much. Well, joining us now for really just reaction to today's market discussion and also the latest on the coronavirus, we have Chris Campbell, Chief Strategist at Duff & Phelps. We're also joined by Tony Rodriguez, Head of Fixed Income Strategy at Nuveen. Thank you both for being here today. Tony, let me get your reaction to the markets today. So we started off, it looked like we were going to rebound slightly. I don't know really if we can use the word rebound, but at least edge a little bit higher. We have erased those gains this afternoon. What do you make of the action?
Well, I think it just highlights the uncertainty around coronavirus, and that really very few people can claim to have any kind of either information advantage or fundamental analytical advantage. So you end up getting a lot of more emotional moves as you see new pieces of information, such as the fact that maybe it's hitting Nassau County. So heightened uncertainty increases volatility, and I think that's the kind of reactions you're seeing in both the equity and the fixed income markets.
Chris, do you think we've seen a peak yet, or could the worst, I guess, be yet to come?
Oh, absolutely. We've not seen the bottom of this, and we're advising clients on that challenge. Supply chains are going to continue to be disrupted, and it'd be telling to see what the president says at 6 p.m. today. As I used to work for the president, and so I think that it'd be interesting to see what he says. My guess is he'll take a more active role in the process. Some of my sources suggest that he may actually appoint a czar, someone to lead up the government effort on this. And so I think that but it's necessary. I think it's important. I think it's also important to know that we in the United States have a very robust healthcare system of providers of rural and urban around. And we have military, we have non-military, we have just an enormous amount of doctors, and so while we've not seen a growth in the numbers of cases here in the United States, I think we're well ready for should it come to the United States, and should be a challenge. I know there's one person that stewardess, I guess, out of LAX that just tested positive. So, there's no question that we could be on the verge of a pandemic. It's certainly going to have a significant drag on the economy, both here and abroad, and it's certainly something that's alarming our clients.
Tony, when we take a look at the market reaction this week, so we had 1,900 point drop, or almost a 1,900 point drop over the last 2 days. earnings, S&P wiping out $1.7 trillion. When you take a look at that reaction, do you think investors were too complacent leading up to this week?
I do think that the markets were priced for very good news. If you think back towards the end of the fourth quarter, you started to see better news on Brexit, better news on trade. You actually started to see better economic data. So maybe the global manufacturing recession was starting to abate. Now you wake up, here you are since mid-January, the global manufacturing recession is now clearly going to continue given the coronavirus impacts. So markets that were priced for either perfection or very good news suddenly had to reset to kind of, again, a more uncertain and probably a more negative, for sure, outcome economically.
Tony, there's been talk about whether or not this could prompt or maybe force the Fed to act just in terms of policy. How do you read that scenario?
Well, I think the Fed's going to be reluctant to act. I mean, they would like to still see what the impact is of the, easings they had last year. It's only been a couple of months there. And I also think they have some doubts as to the effectiveness of an interest rate cut to deal with what the implications here from coronavirus are around supply chain, around quarantines and the lack of activity as a result of those things. I think they doubt the effectiveness of the cut. So they don't want to be, I don't think, too quick on that, but they also don't want to be seen as, blind to the risks around the macro economy.
Chris, what do you think?
So I used to work closely with Chairman Powell. I think that there's the Fed does not like to come in and intervene in the markets, certainly on rates on election years, but unless there's some significant threat. This virus poses a significant threat worldwide to the economy. So I believe the markets is certainly baking in and certainly we're going to put a lot of pressure on the chairman to do a rate cut. I would not be entirely surprised to see a rate cut when they next meet.
All right, Chris Campbell and Tony Rodriguez, thanks so much for joining me today.
Thank you.
Let's get to a big mover in today's market, and that is Disney. Now, shares today are under pressure, off nearly 4% following its executive shakeup news last night. Now, longtime CEO Bob Iger, he is stepping down from the position effective immediately and will stay with the company through the end of 2021 as executive chairman. Now, Disney's Parks chief Bob Chapek has been named the new CEO. The pair discussed the leadership change on CNBC last night.
Bob's legacy in the company is just profound. I think my role is now to take the strategic pillars that he's so well established over the last 15 years and continue to work on those and implement those in the marketplace.
Joining us now for more on this, we have David Miller, Managing Director of Equity and Industry Research at Imperial Capital. And David, when we take a look at this news, Bob Iger stepping down from a CEO position, what do you think? Let's start big picture and just talk about his legacy that he's leaving behind.
Well, he was an acquirer of many businesses. He was a brilliant M&A strategist. If you look at his tenure versus Michael Eisner's tenure, who was the CEO previous to him, I mean, there were just a boatload of acquisitions. And I'm not just talking about Fox. There was Pixar. There was Marvel. There was Lucasfilm. There was Playdom. All in all, I believe the company spent, I want to say, $98 billion making acquisitions in the content space. And because of that, they are now a content machine and largely a free cash flow machine because of it.
There's a lot of questions just in terms of the timing of all this, the way that it came out. Do you read into that at all?
No, I just think that's fodder really for either the press or just, sort of worrisome investors that like to kind of that are just sort of nervous Nellies. I think Bob was very clear about his intentions, even dating back to 4 years ago. I believe he said at first he wanted to retire at the end of fiscal 18, which would have been September 30th of 18. Then it got pushed to fiscal 19. Then he signed a new contract through fiscal 22. But he did say in that verbiage and that phraseology that he wanted to stay through the launch of Disney Plus. Well, Disney Plus has now been launched. It's done. It's been successful. It's built into the stock. In our opinion, we've already downgraded the stock. We did so last June. But he's done exactly what he said he was going to do. He said that he would stay through the launch of Disney Plus, and that has happened. So we're not surprised that he stepped down.
So right now you have an inline rating on the stock. Like you said, you downgraded it from outperform this past summer. What will it take for you to get back to that outperform rating? What do you want to see from Disney?
Well, we can't telegraph what we're going to do before we do it. Our downgrade in June came at 141.65 a share after a massive run up in the stock. Yielded from April of 19, whereupon the company gave an absolutely brilliant presentation behind its streaming strategy. Almost too good of a presentation because it tacked on $30 billion worth of market cap onto the equity just on a presentation, simply on a presentation. And, based on our experience, I've covered Disney for a long time. Stock just ran up way too far, too fast. In my experience, Disney usually trades peak multiple as 18 times earnings on the out year. And I think around that date, it got up to 25 times out year earnings. And that's just too expensive in our book.
David, under Iger's leadership, Disney's market cap gained about $175 billion. Obviously, part of that run-up that you were just talking about. When we talk about Disney under Bob Chapek now, do you think we could expect at all a sort of a shift in strategy?
Not at all. Bob is very well respected. We've met him many times. He's an extremely likable man. He's, I believe, a 33-year company veteran. He's run a variety of different businesses within Disney, the latest of which, of course, is the theme parks, which is now their largest division, by the way, because consumer products got folded in. Extremely well-respected gentleman, very well-liked here in the Los Angeles sort of creative community. And, we're certainly not surprised he was named the CEO. It was just simply a matter of time.
All right, David Miller, Imperial Capital, thanks so much for joining me today.
Thanks for having me.
Well, another major executive shakeup on our radar today. We have Salesforce announcing its co-CEO, Keith Block, is stepping down. Just 18 months after taking the job, Mark Benioff will now be the sole CEO. The company also reporting fourth quarter results, and you can see the stock off just around 2.6%. Brian Chung is following the story. And Brian, we talk about the fact that so many companies, it seems like these past couple weeks, past couple months, have been announcing some executive shakeups. What do you think this means for Salesforce going forward?
Well, what it means is that Mark Benioff is the single CEO now of a company that used to have a co-CEO structure. So we had Keith Block, who used to share the position with Mark Benioff. That was the case since Keith Block was appointed to that position in August 2018. So he was only in that role for over a year, about a year and a half or so. But regardless, it's been a pretty noisy day for Salesforce at large, just aside from the fact that it was a noisy day yesterday for CEO changes at the top when we talk about Disney, for example. But they did report earnings on the top line. They had revenue of $4.85 billion on bottom line earnings per share adjusted of 66 cents, both beating the estimates that the street had on the top and bottom lines. That, in addition to the CEO change, in addition to an acquisition that they also announced, they had a $1.33 billion purchase of Velocity. That's a cloud and mobile software provider that's actually already built on the Salesforce platform. So there's a lot of stuff going on. And when you talk about the price movement today, with the stock being down almost 3% in an already volatile stock market, it's difficult to parse exactly which of those three narratives are really moving the stock at the moment. What we do know is that Salesforce did provide guidance going forward in their earnings call. This was after the bell yesterday. They said they do expect full fiscal year of $21 to $21.1 billion in revenue on the top line for the first quarter. They did guide on 70 to 71 cents. That may have factored into what analysts had been doing with the price movements today. All those forecasts, by the way, do bake in the potential acquisition of Velocity. So there's a lot of information to parse through here. But again, at the top, when we're talking about who's just going to be running this massive cloud company, it's going to be
Mark Benioff.
Exactly.
All right, Brian Chung, thank you. Well, coming up on the ticker, we're heading live to Apple's shareholder meeting in Cupertino, California. The latest details after the tech giant warned attendees to take extra safety precautions due to the coronavirus. More on that next. Welcome back. We are watching Apple as the tech giant deals with supply chain concerns over the coronavirus. Joining us live from Apple's Investor Day in California is Yahoo Finance's Dan Halley. And Dan, what's interesting here is lots of the focus of this shareholder meeting is on the coronavirus, just in terms of Apple's warning to attendees, also talking about its potential impact on its business. What did you learn today?
Yeah, surprisingly little came out of Apple's shareholder meeting with regard to the coronavirus. Shareholders didn't focus on it in their questions to Tim Cook. They basically talked about other issues ranging from when they were going to start operating within India. Tim Cook said they'll start selling online this year and then open a first brick and mortar store next year, and why they didn't do things like go out and get the reunion for Friends. And to that, he said that Apple looks to try to be more of its own creativity than those of others. And, again, the coronavirus, big issue for Apple. Factories from Foxconn, its main supplier, have been shut down. Its stores were shut down. They're back open. And, it's interesting to see that shareholders didn't have much to say in that regard.
All right, Dan Halley with the latest from the shareholder meeting. Thanks so much. Joining us now for more on Apple, we have New Construct's CEO David Traynor. And David, when we take into account what Dan was just saying, just in terms of the focus not being the coronavirus out at the shareholders meeting, what did you want to hear? Or do you think it should have been a bigger topic during the meeting today?
I don't think so. Look, unless we're dealing with like a World War Z pandemic type of thing, I believe this is going to be out of sight, out of mind, and probably in the next several months. And there will be supply chain disruption. There'll be some demand chain disruption, but most of that will be made up for later in the year when people who wanted the iPhone and couldn't get it will go and get it later. I think the marginal impact on businesses is ultimately going to be, when it's all said and done, fairly low. I think the bigger picture risk in this whole virus issue is how it potentially is a liquidity squeeze that pops the overall equity market bubble. But I think on an individual company basis, the underlying cash flows are not going to be that meaningfully affected.
David, when you take a look at Apple's business, its results at the end of last month, also just talking about the revisions, I know you're saying that coronavirus, it's something that the company will be able to work out in the short term. But Apple overall, do you like the stock right now? Do you think it's a buy?
It's a neutral rating in our system. So we feel like the overall valuation is fairly well balanced with the underlying economics. We do, however, have a strong miss rating on the next earnings report. So we do a measure of earnings distortion scoring that's based on a new paper from Harvard Business School and MIT Sloan that shows our proprietary footnote adjustments actually matter. And when you put them together to look at how companies' earnings are trending relative to their adjusted core earnings for these footnote items, Apple's earnings are looking meaningfully overstated here in the near term. So they've been, and Apple's not alone, there are a lot of companies, and this is typical of market bubbles or market rises, bull markets, they tend to try to beef up the numbers to make them look as good as they can when times are good. And so earnings are a bit overstated, not just for Apple, but for the market in general. And that just means there's more likelihood of a miss.
David, we talk about Apple shifting its focus more towards services. Obviously, that's an area of its business that has significantly grown over the last several months. When you take a look at what Apple's doing just in terms of diversifying away from the iPhone, do you think they are doing enough there?
I think so. Look, I think what they've built is a great ecosystem. There's been a lot of products. And even though they've really not innovated so much on the hardware side, they've done enough to keep people interested in their products by just keeping up with what the other firms offer. And then around that, you layer in all kinds of services, and it really makes the switching costs high for what is a really large customer base. And high switching costs means more customer loyalty, and that means more revenue and more profits over time. I think Apple's done a really amazing job on that. In the past, we've been more negative on Apple as a business because of a lack of innovation post the Steve Jobs era, but I don't think the innovation matters. They had enough people and enough customers and a good enough product to continue to attract people and then lock them in with services. I think it's one of the better businesses in the world for sure.
All right, David Traynor, New Construct's CEO. Thanks for joining me.
Thank you.
Well, Papa John's is getting hit hard today. Taking a look at the chart, shares are off pretty significantly, down just around 11% despite its fourth quarter earnings topping estimates, driven by strong same-store sales. We have Heidi Chung here with me. And Heidi, when we take a look at these earnings, I mean, the headline numbers, there were actually beats here from what the street was expecting, yet we're seeing the severe reaction in the market today. What do you attribute that to?
Hey, Seana, yeah, so just looking at the fourth quarter numbers, they were pretty strong. But like you mentioned, the stock is selling off today, off more than 11%. If the stock stays at these levels, it would be on pace to have its worst day in over 4 years here. It beat on the top and bottom lines during the fourth quarter, with revenue totaling $417.5 million and adjusted earnings per share coming in at 37 cents. And the U.S. comp sales during the fourth quarter, of course, that's that metric that we closely monitor when we talk about restaurants and retail, that topped 4.1% growth. Analysts were expecting about 2.3% growth during the quarter. And I think a lot of this stock action that we are seeing here is attributable to the softer than expected guidance and also some of the commentary that we got regarding coronavirus. Looking at the guidance here, the pizza chain's 2020 adjusted earnings guidance a bit soft. The company expects between $1.35 per share to $1.55 per share. So the midpoint of that guidance missing analysts' expectations for $1.52 per share. Management saying on the earnings conference call that it does not expect a material impact to earnings from the coronavirus. However, if we take a look at the comp sales guidance that we got, in North America, comp sales are expected between 2.5% to 5%, and international comp sales are forecast between 1.5% and 4%. Now, that guidance factors in the anticipated 50 to 100 basis point impact from the 110 restaurants in China that have been, in fact, impacted by the coronavirus. According to some filings as well, Papa John's closed roughly 50 franchise stores in China due to that outbreak. I do also want to remind you that CEO Rob Lynch took the helm back in August, and this company has been in the midst of a multi-year turnaround plan, and this had been year one. So far, it looks like the turnaround plan is working, but this company still has a lot of work to do, Shauna.
All right, Heidi, thank you. Let's talk about Smile Direct. Shares today are nosediving after the company reported a wider than expected loss, and analysts slashed their price target. You can see the stock down 30% today alone. Jared Blickery is at the Wi-Fi Interactive board. And Jared, when you take a look at this stock chart, it's almost amazing. We know that Smile Direct has been under pressure ever since the NBC News report. And then today, on the heels of their quarterly results, obviously investors are taking issue with what they saw.
Yeah, they've actually been under pressure. At least the stock has since it IPO'd. And we can take a look at that in a minute. But yeah, 30% down. That's the worst day by far since their IPO last year. And we're going to take a look. This is the intraday price action and really hasn't moved much since the open. We'll look at a max chart here. And here it is. So this was their debut over here, and it's been to the left and to down ever since. We did have a rally here, and it looked like they might have been building some strength, but just too much disappointment. They missed on revenue. Their forecast for the full year is only 20 to 30% revenue growth. The street is looking for 35. And anytime you're a high growth company and you're missing on these numbers, especially on the outlook, you're just going to get hit really hard. And plus, you have the overhang of that NBC report that you were talking about. They've been investigated by states attorneys general, and it looks like that might be behind them, but they've got a lot of work to do to get profitable and also to accelerate their growth.
All right, Jared Blickery, thank you. Well, coming up, the travel industry is facing renewed pressure from the coronavirus after 2 consecutive days of sharp sell-offs in the markets. A Cowen analyst explains why that sector could take longer to recover than many expect. All that next. Welcome back to the ticker. Checking in on the markets, the Dow is still in negative territory, off just 23 points off its lows of the day. S&P and NASDAQ have turned positive this afternoon. Ines Ferre is standing by on the floor of the New York Stock Exchange. Ines?
Yeah, and Seana, just taking a look at the movements of the markets today, we had been this morning up more than 460 points on the Dow, and then we just started seeing the markets losing steam once the headline from Germany came out saying that Germany is in the beginning of the coronavirus epidemic. Then the FDA warning came out, and then that latest headline, the one about the local report about Nassau County, New York, about 83 people being monitored for the coronavirus. That's what really turned these markets around. Taking a look at gold, gold is declining today just like it did yesterday. And I just want to show you what's happening with Zoom, because unlike some of the other stocks that have really gotten beat because of the coronavirus, Zoom was in the green earlier today, near all-time highs. Bernstein put out a note saying that the company has added more users because of the coronavirus, because people are just staying in their homes or not doing the face-to-face contact and using their service instead. Now, Zoom will be reporting its earnings next week, but right now it's on pace for February to be its best month since its IPO last April, Shauna.
All right, Ines, thank you. Well, amid all of this market volatility, Cowen is out with a warning saying that U.S. stocks may not be able to, quote, power through the coronavirus like they did with the SARS outbreak. Joining me now is Kevin Kopelman, a senior hotels and online travel analyst at Cowen. And Kevin, thanks so much for joining me today. When we take a look at the fact that you're saying that markets won't be able to power through it like they did with SARS, why are we seeing a difference here?
Well, I think that it's important to understand that the trajectory of the outbreak is still increasing. Mm-hmm. So yesterday there were 464 new cases outside of China that were confirmed, and that was a new high. And if you look at what the CDC in the U.S. said, they said it was a question of when, not if, it comes to the U.S. And how are they so sure? Well, if you look at the numbers, there have been a couple million of inbound visitors, international visitors from affected areas into the U.S. year to date. And the CDC has only tested about 450 people for coronavirus. So we are going to see, we believe, based on this information, future outbreaks probably in North America and Europe.
So you closely travel the travel industry at large. When you take a look at what a lot of these companies have to do just in order to try and protect their business, try and make sure profits don't dip or revenues don't dip as much as maybe they could because of this outbreak, what do they do in this situation?
Yeah, so I mean, I think it depends on the kind of company, but as we're looking at that other side of it, some of our companies under our coverage are very financially sound. So if you look at a Booking or a Marriott or Hilton, they have very high margins, and we think they'll be able to weather that storm. And in the case of the online travel companies like Booking Holdings and Expedia, they have a lot of advertising expenditures, for example. They can cut those back significantly to try to, basically try to maintain their financial situation as the storm passes.
When we take a look at some of these numbers that have also been put out, the International Air Transport Association estimating that the outbreak could cost the airlines $30 billion in revenue in 2020. The organization revised its forecast from 4.8% growth in the industry to an 8.2% contraction. Are those numbers that we have seen before?
Well, when you look at that number, they already said that would be significantly worse than the impact from the SARS virus, but that was before the spread to Korea and Italy and to the Middle East. So, I mean, going back to just one of these key points here, travel in affected areas declines severely. Hotels in China or the hotel industry is down over 90% year over year. So what we're going to see is very deep cuts where the outbreaks happen. Mm-hmm. However, looking past that, we do expect there to be a strong rebound eventually after it passes. You're going to have pent-up demand. People will be traveling, and so we're increasingly trying to look past that, especially as the valuations get cheaper and the stocks have been coming down.
Kevin, how long do you expect this to weigh on these companies? Are we talking the current quarter, second quarter? Is it into the second half of the year, possibly into 2021? How do you read that?
So the first question is, when is it absolutely worst? Right now, it's still getting worse for most of the world. So where's the bottom? We're assuming right now that that's either in Q1 or an early Q2. And then you're looking at probably kind of a 6 to 9 month recovery period where I think initially you have a strong initial recovery, but to get fully back up to previous travel levels is going to take a few quarters.
Right, Kevin Kopelman of Cowen, thanks so much for joining me today.
Thanks.
Well, coming up, WTI crude dipping below $50 a barrel as concerns grow over the coronavirus. An energy expert joins us to weigh in next. Welcome back to the ticker. Jared Blickery is at our Wi-Fi interactive board. And Jared, when we take a look at the market action this afternoon, Dow and S&P are now negative, but NASDAQ slightly holding on to gains.
Yeah, and we can see that's in large part because it's all these big cap names. Look at Microsoft up over 1%, Apple up over 1%, Facebook still in the green along with Alphabet, but they have paired a lot of their gains with this general market sell-off that we've had. If we look by performance here, we can see some healthcare names at the top, Gilead, Regeneron, Amgen, and also Netflix on no particular news, but it might have a tie-in to the coronavirus. We also have to the downside United Airlines, Expedia, and Booking, American, all down 3 to 5%. That travel exposure really getting hit right now. And I just want to bring up one other stock, and Ness was just talking about Zoom Video. This is our IPO heat map, and although it's down today, it has had a really nice 2019 here. So over the last year, up 71%. If we look over the last 3 months, we can see this is really where all the gains came from in February, and that's because of its exposure to the coronavirus actually adding more users this year than it did in last year. So that's a pretty compelling story. And now let's take a look at the action in the major indices. As you said, the Dow is now negative, down almost 100 points. Here is the intraday price action, and we can see that we gapped up. We made some session highs here, but just sold off on all this negative news coming out from the coronavirus. And if we look at the VIX, that is elevated as well. We hit about 30 yesterday, and now we're heading back up towards that number. And finally, the 10-year T-note yield, that is under pressure now. We started the day up about 3 basis points, and now we're down 2 basis points. This is a record low, and this is very meaningful because the yield curve had been expanding, showing some growth potential, but that is all erased right now. Finally, we're going to hit crude oil because that is negative. That has dipped below $50. This is threatening to go all the way to 46. That is the next support level. And you got to imagine what OPEC Plus is going to do next, maybe with or without Russia.
All right, Jared Blickery, thank you. Well, speaking of OPEC, let's check in on the closing price of oil. We have crude currently trading to the downside, still well below $50 a barrel at $48.68. Now, the EIA reporting a smaller than expected rise in crude supplies, edging up by 500,000 barrels for the week ending February 21st. Now, this, of course, comes as the coronavirus outbreak triggers some demand concerns. We have Tamara Essner, Senior Director of Energy and Utilities at NASDAQ. And Tamara, when we take a look at the reaction that we have seen, not only in really commodities overall, but specifically in crude, the downward pressure that we are seeing because of the coronavirus, what's the downside risk from here, do you think?
Well, we need to see how the virus plays out. I mean, we have been arguing over the last 2 weeks that oil prices had been trading higher than where they really should be. We know that oil demand is down and down substantially. We just don't know by quite how much and for how long that duration will be. That certainly is contingent upon how long the virus situation remains in place. But oil is unlike any other commodity. It's really difficult to tell just how much demand is down because China in particular has been stockpiling. So they've been buying oil on the cheap. That oil has been sitting in storage. It's been obfuscating what the demand story is. And the estimates are truly all over the map, but we think that oil demand could be down in the range of 3 to 4 million barrels a day. So it's quite substantial.
If we take a look at the fact that oil will be below $50 a barrel now for quite some time, what does that mean just in terms of the impact that it could have specifically on the U.S. in terms of drilling and also just production overall?
Well, if you see oil prices stay in a sustained $40 handle, you're definitely going to see curtailments in drilling, and that will result in oil production in the U.S. coming down in a way that would be a good thing, right? The cure for low prices is low prices. Unfortunately, a big part of what underpins this industry is debt. So to the extent that some of these companies are able to service their debt, even though they're not showing any returns to shareholders, they will be forced to continue pumping just to pay the debt, essentially being zombie companies. And that perpetuates our oversupply problem because they have so much debt that they have to repay. Therefore, they have to continue drilling. Therefore, the surplus remains in place.
Tamara, what companies do you think are best positioned just in order to weather some of the volatility that will be coming or that has come the energy sector's way because of the coronavirus?
The companies that have been able to take down their debt over the past couple of years and really clean up their act in terms of focusing more on spending less, as a result producing less, but therefore being able to return some of that cash to shareholders. Those companies are getting stronger. We saw over the last week or so that several of the Permian players actually increased their dividends, which is very wonderful in this environment in particular. They've made themselves more impervious to the oil price environment, but those that have high leverage, those that have acreage that are in not as prolific basins, those are going to really struggle. And the one saving grace for them is if there is M&A and the possibility for them to consolidate with stronger players, which might happen. We just have to see how that plays out.
Tamara, right now, there's just been this ongoing debate whether or not it's a supply chain driven or a supply driven market or a demand driven market, just in terms of the action that we have seen in oil recently. What do you think is the bigger, I guess, driver of oil right now?
Well, at the current moment, it's a demand story as it pertains to the coronavirus. It's the single biggest demand destructive event that we've had really since the financial crisis. Up until the coronavirus, we've really been in a supply-created problem. So we've been saying that supply is what's got us into this mess. Therefore, supply is going to be what gets us out of this mess. And so we're going to have to see companies cut back on their supply growth, which we are really starting to see. I mean, many companies in the U.S. shale industry really have started to clean up their act quite successfully. So it's unfortunate that they've made these inroads and now they're getting hit by an exogenous black swan event.
Tamara, there's a news crossing right now. This is from Bloomberg saying that Aramco is set to start early preparations for overseas listing. They went on to say that the oil giant is in early talks with Wall Street investment banks. The company focusing on Asian exchanges for a potential transaction. What are your thoughts on that?
Well, I think the interesting thing about the IPO and other Middle Eastern countries that are also looking at potentially IPOing their assets is that they really don't see the future in oil. So they're looking to monetize their assets now because they think that oil could be a stranded asset in the future. So I think in the short term, it potentially is bullish because it suggests that these countries will try to do whatever they can to get a higher oil price. But in the long term, it's definitely bearish because we think that they're going to pump more today because they might not have those assets in the future.
All right, Tamara Essner, thanks so much for joining me.
Thanks for having me.
We are also watching Toll Brothers this afternoon. Now, shares are nosediving after the home builder reported earnings that missed on the top and bottom lines. You can see shares off well over 12%. Now, adjusted earnings per share coming in at 41 cents on revenue of $1.3 billion. But net contracts signed were up 31% year over year, which obviously would be a positive here, you would think, for the company. Brian Chung is back with me. And Brian, when we take a look at the results that we got from Toll Brothers, it was a little bit interesting given the fact that that the housing market overall seems to be pretty strong at this point.
Yeah, I think the problem with Toll Brothers, they appeared to say, at least on the call, was some idiosyncratic issues regarding its Northern California business. So as you mentioned, the shares of Toll Brothers are really getting a hit today, down over 12% after it whiffed on the top and bottom lines. And they said that they had delayed closings in Northern California where it missed 60 closings. And they said that was worth about $67 million. Keep in mind, Toll Brothers kind of focused on these luxury types of properties, so very expensive, large, probably elaborate houses in that area. They do project also lower volume and margins out of the Pacific region from Washington down to California. So maybe in the future, it's not just going to be Northern California that's going to be the issue. For what it's worth, though, management on the call was saying, look, we need to make sure we're very clear on this. This is not related to labor costs. This is not related to the Chinese tariffs. This is not related to any other international issues. They actually said in many cases, it's permitting why they weren't able to get these houses closed. But they said, look, we are going to get them closed. It's just they didn't make it for this quarter, which is why we missed on the top and bottom line.
So something that investors might be able to shrug off here in the short term, but we'll see. All right, Brian Chung, thank you. Coming up, we're breaking down the best ETFs to hedge against recent market volatility. That's next. It's now time for our ETF report brought to you by Invesco. Markets have had a rocky start this week with concerns escalating amid a surge in coronavirus cases worldwide. Joining us now, we have Ben Johnson, Director of Global ETF Research at Morningstar. And Ben, when we talk about all of the recent market volatility that we've had, the major sell-off on Monday and Tuesday, today we're trading just around the flat line, slightly lower in the Dow. How do we best hedge against the recent volatility?
Well, I think first and foremost, it's important to understand that volatility is the norm. If anything, the past 10 years or so have been somewhat abnormal in the markets, and that it's largely been sort of sunshine, rainbows, and lollipops. So I think investors right now need to do a gut check. They need to reassess their level of comfort with risk, their ability to assume risk, and then take a look at their asset allocation first and foremost and understand whether or not they've got a suitable mix of cash, stocks, and bonds within their portfolio. Or if maybe, for example, 10 years into a bull market, they're a bit heavy on the stock side and need to reallocate towards bonds or liquidate and head towards cash to increase their comfort, to match their actual willingness and ability to assume these risks with the makeup of their portfolio.
Ben, with this recent volatility that you've been talking about over the last decade, really, has that increased demand for ETFs?
Well, I think ETFs and the growth in ETFs is really evident of a number of different factors that transcend what's going on in the broader market environment. And I think first and foremost among them is investors' ever sharper focus on fees and a growing understanding that when it comes to investment products, you get what you do not pay for, that lower fee funds have better odds of succeeding, and that ETFs as a category tend to be amongst the most low-cost, most dynamic, most tax-efficient vehicles that investors of all stripes, from individuals to institutions, can allocate to in their portfolios.
Ben, what ETFs would you suggest or do you follow that you think would offer the best hedge against this volatility, whether it be in equities or in fixed income?
Well, if you look on the fixed income side of the ledger, if people decide that they need to allocate more of their portfolio to the bond sleeve, one ETF that I would recommend is the PIMCO Enhanced Short Maturity ETF. MINT, or MINT is the ticker there. Now, this is a great place to seek safe harbor in choppy market environments. It's a fund that's helmed by a proven manager that's been at it for a long time in Jerome Schneider. It's got a very low fee, and it's backed by a fixed income powerhouse in PIMCO. This fund earns a Morningstar analyst rating of gold and is one of our top choices in the short-term bond category.
All right, Ben Johnson of Morningstar, thanks so much for joining me. Well, the coronavirus is also disrupting businesses as supply chains take a hit from the outbreak. But some companies are faring better than others. Joining us now to explain is Yahoo Finance's Ethan Wolfman. And Ethan, when we take a look, this is based off a recent note from Wells Fargo, and they were basically saying that the U.S.-China trade war has prepared some companies, at least to a certain extent, for the coronavirus. What are they talking about?
Well, essentially, the past few years has really been kind of shaped, kind of narrative-wise, by the China-U.S. trade tensions and then kind of escalating trade wars with tariffs. And so companies have already reacted in a big way to problems with China. So this is sort of kind of auspicious in a way. The timing, obviously, this is going to be very bad for everybody involved, obviously sick people and the market itself and companies involved. But what we're seeing is some companies already having mechanisms in place to deal with disruptive things in the short-term supply chain. Whether that will be something where they're long-term ready to deal with it, that is kind of a much larger question. We've seen more diversity in the supply chain as this thing that a lot of companies want. Apple, for instance, has been trying to see whether they can add things, in Taiwan and Vietnam and other places like that. And so that's something I think we'll see more. Vietnam actually has been a huge winner in this. A lot of the big gains in trade relationships, I think $20 billion almost, a swing towards Vietnam, as a lot of other regions, including China, have seen a lot of that come off. Just for context, Taiwan and Netherlands, the next two, are combined are still less than that Vietnam increase.
And it's interesting to see what companies decide to do, because when we just talk about the opportunity, really just the sheer size of China compared to, say, Vietnam, obviously Vietnam dwarfs in comparison. So companies must be forced at least somewhere at some point to look elsewhere and not only diversify really throughout the Southeast Asia, but really even beyond there, I would think.
I think what you're saying is especially true because it's really hard. China is enormous. It has all of these things already in place. Vietnam is not that small, but compared to China, it certainly is. And I think what we're seeing is a lot of, the other thing which I think we should also just mention is a lot of companies with the trade war, tariffs and things like that, knowing those dates were coming or assuming that stuff before kind of a more conclusion of phase one, obviously, was reached, they sent all these shipments ahead of time. And so that means that they kind of beat all of these issues now. So inventory is high compared with sales. So that's a bit of a buffer that we've seen as well.
It's going to be interesting, I guess, how long they'll be able to fend it off. And so we'll see some material impact. All right, Ethan Wolfman, thank you. Well, coming up, Diageo is warning its 2020 profits may take a hit due to the coronavirus. Details on the new concerns for the beverage giant next. Welcome back. It's time for our last tick of the day. Diageo, the maker of names like Smirnoff and Johnny Walker, say that the coronavirus will have reduced sales by as much as $421 million this year as bars and restaurants in China close their doors. We have Brian Chung, Jared Blickery, and Heidi Chung all back to weigh in. Jared, let me start with you just in terms of the potential impact that Diageo is warning about. How significant do you think this is to their business?
Well, I think it's pretty significant. All these luxury companies, and well, maybe cognac is not a luxury, but it is definitely in the expendable category. They're going to see hits to their business, and so this could be an actual conservative estimate. It could be much worse. It depends on the fallout, especially if the CDC is right and things accelerate here in the U.S.
Heidi, do you think this is just the first of, I mean, we have had other companies within the food and beverage space also warn that their profits could be hit because of the coronavirus, but could this be just another one of these companies? I guess, do you expect to hear from more of them?
Well, Seana, I think where we at right now, it's hard to argue that a lot of these companies, these multinational companies that have exposure to China and rely on the Chinese consumer, it's hard to argue that they wouldn't be negatively impacted given where we are in terms of this virus. I think we are seeing half of these sort of consumer-facing companies come out and give an actual amount when it comes to that negative impact. But on the flip side, we're having companies actually say it's a little too soon to start putting a number on the kind of impact that they would see. So whether or not these companies will actually see damage to this extent, I think that remains to be seen. And it'll be interesting to see whether or not they're able to rebound following everything that's going on right now.
Brian, it makes sense that a lot of these consumer names, ones that people could potentially just forego buying, could potentially be the hardest hit.
Yeah, absolutely. But for what it's worth, this is a company that's exporting to China. You have to wonder about all the countries that have supply chains in China trying to export to the rest of the world. So even though, yes, it is true, I can attest to the fact that Chinese people do like to drink, it is definitely the case that there are definitely other types of industries worth watching as well.
All right, Brian, Heidi, and Jared, thanks so much for joining today. Well, let's go beyond the ticker. The Milken Institute is out with its annual Best Performing Cities Index. And guess what? San Francisco taking the top spot. We have Yahoo Finance's Reggie Wade joining me. And Reggie, when Milken ranked a few cities, it was 25 cities, San Francisco the top spot. How did everything else shake out?
Yes, well, California looks like a big winner. 4 California cities are in the top 25. We also have Provo, Utah, which was number 1 in 2018's list. They dropped to number 2. We have San Jose at number 5, and Reno, Nevada's really had a lot of things going on with the Tesla Gigafactory. When that opened up, that really opened up the economy for that city, and that was something that was an initiative of the outgoing governor, and it's really paid dividends. But Milken's told Yahoo Finance that one thing that all these cities do well is that they create future-facing jobs, jobs that will not fall prey to automation, and jobs that have a startup culture where a lot of young professionals want to flock to. So that's what these cities are doing right.
Reggie, what metrics does the Milken Institute use just in order to rank these cities?
They use wage growth, job growth, and they also use another metric where it shows how they're expanding in the area. We know in San Francisco that feeds into places like Sunnyvale, California, Oakland, California, so also the reach of these areas. We also have Texas cities doing very well. One thing that we see is the East Coast not doing so well as far as top performing cities. You have to go to North Carolina before you see your first East Coast city, so it's lagging behind. This list is very Sun Belt focused.
All right, Reggie Wade, thank you. Let's take one more look at the markets. We have the Dow off 130 points, so extending the declines this afternoon. The S&P is also back in negative territory, off just around 0.3%. We're seeing the biggest weakness here within the Dow. It's a slew of names here moving to the downside. The NASDAQ, the tech-heavy sector, is the only major index trying to hold on to gains. Well, we have an hour left in the trading day, and coming up, HSBC downgrades Nike, citing a, quote, somewhat stretched valuation. The final round is breaking down the details, and they have that next.
Hello, everyone. I'm Jen Rogers in New York, and this is the final round. Stocks on edge here, trying to recover from the market's worst two-day drop in nearly 5 years.
And I'm Myles. Other than this, as the coronavirus pushes across Europe into Germany, the U.S. officials preparing for an outbreak stateside. We'll have more on that in the market action coming up in just a bit.
Plus, is everything okay in the Magic Kingdom? JP Morgan analyst Alexis Quadrani weighs in. It's our call of the day. And we get the very latest on the coronavirus and its possible effect here in the United States with expert Dr. Brian Garibaldi of Johns Hopkins and market strategist Peter Cheer on the wild moves in the stock market, why he's more concerned about changes in correlations as opposed to rising volatility. With us now, Yahoo Finance's editor-in-chief Andy Serwer, as well as editor-at-large Dan Roberts, to talk about all of today's market action and quite a different picture from what we saw this morning. NASDAQ barely holding on to a green arrow there. In fact, I've seen all three of these red. NASDAQ, the only major index, again, holding on right here above the flat line. We are way off the highs that we saw earlier in the session. This has been a volatile day for sure. Earlier today, the Dow was up as much as 461 points before falling to a session low of 100 points, which, if you add that to Monday and Tuesday, bring us down about 2,000 points from where we had started the week.
A lot of points, Jen.
We keep a lot of points, and for people that make fun of us talking about points, it's still a lot of percentage losses as well. 3% down 2 days in a row. We haven't had 3 days down more than 3% since the Great Depression, I believe. So this would have to be a pretty big hour here.
What about the V-shaped recovery?
We're
Where's the
waiting.
V?
The V-shaped recovery is out later. Right now, we're just waiting for any sort of bounce. There are just where are the buyers here?
I mean, I know that the informal internal rule is that we don't go with the red look of the breaking news, market sell off, until there's 350 down, but we should do it because we're off 500 points. And I think that unless something really changes in this last hour, today has already been as discouraging as it could have possibly been for the bulls, because you had an opening bid, you had overnight markets seem like they were going to repair this thing, and all it took were a few headlines about some cases being monitored here in the U.S., and all of a sudden, you know, you've got markets down basically unchanged on the session. The Dow and the S&P are actually in red figures right now. There it is.
Yes.
Red colors here in the studio. Ask and ye shall receive.
This is what happens when you lose 500 points on the Dow.
I think this is a kind of day that you had a lot of people coming in saying, all right, maybe we can steady the ship. And in many ways, it's just as destabilized as what we saw Monday, Tuesday.
Now, perhaps you should be happy, though, if you really believe this is so headline-driven, then it is the headlines that are causing switches. Like in the middle of the day today, it wasn't nothing. It wasn't no new news. There was some news, which was CDC saying, now it is close to be, prepare for it to be a pandemic. Not a pandemic yet, the keyword we don't want to hear, but prepare for that possibility. And then we took a leg lower again. Suddenly we switched into the red. And maybe that's a good thing because the reasoning is we just don't know how short-term this will be. It seems to me like overall, if you just zoom out, the reason this week has been so damaging more than anything else has been the number of different countries that have now seen cases that weren't previously in the mix, right? There was South Korea, Italy is a big one, Austria,
Spain.
Switzerland, countries that weren't previously being named as places for coronavirus concerns. So the bullish take would be, well, let's see. Give it a week. If the headlines kind of slow down and if things start to get contained, we could bounce back.
Yeah, trader's delight. I'm surprised you're surprised. And, you know, the president's going to be talking tonight, so that's going to be another data point. You're surprised.
Sure.
You're surprised. So I'm surprised. Anyway, there's gets to be too much of an echo chamber there. You're leaving out another big country, by the way, Brazil.
Today.
Yes, today.
Yep.
1 out of 210 people in Brazil has the coronavirus. So, but it's a new, continent. So that is a big deal.
Yep.
But, I don't blame Bernie Sanders the way Jeff Gundlach does for today.
That's what I was going to just bring up. So,
Right.
does this market just want to go down? And it's not coronavirus related. It's Bernie.
No, it's coronavirus.
Yes, all coronavirus.
It's all coronavirus. The rest is all noise. I mean, we knew Bernie this and that, and I mean, I don't think there's anything. But this is, it is potentially really serious because of the fear. And, there's one thing that's going to cure the coronavirus, COVID-19. Just one thing and one thing alone. Ready? Springtime. In spring, It will go away. And we're not there yet, but this will happen. So I'm thinking like 2 or 3 months, but it could get really scary and really hairy, and it's going to come to the United States probably. And President Trump, this could be the first real crisis of President Trump's presidency. This could do to Donald Trump what the Democrats have heretofore been unable to do, a la Katrina, right? I mean, how the president responds. There's a lot of stuff at play here.
That was a second term, so.
Well,
do you think,
true.
One
but
more
it's,
thought,
but it killed McCain maybe, or it didn't help. It didn't help.
He had the housing crisis.
Yeah, he had everything.
One more thought on this. You're talking about fears, too, and I think it's worth saying some fun anecdata. I mean, not fun, but some anecdata, which is this was the week, that people who previously were not maybe watching stocks so closely, people who don't follow all this, suddenly snapped to attention, oh my God, and together at once they were concerned about coronavirus, and they were noticing that stocks were crashing. You know, friends were texting me who don't usually ask about this stuff. What do I do? Well, I'm not a financial planner. I'm not going to advise you on that. But part two, I was just at a doctor's appointment today, happened to casually ask the doctor, what do you think about coronavirus? This was just one doctor, just repeating what this doctor said. Doctor said, well, they should shut the ports and they should stop allowing flights in and out of the U.S. And he said they're afraid to do it, but that's what they need to do. I thought,
you know,
and that seemed a bridge too far, but I think you're starting to see some real pain. I mean, soon enough, there could be some real pain.
Well, also, I was on a flight just this afternoon, this morning, from Raleigh-Durham to New York, and there were, I'm telling you, there were a lot of empty seats. I mean, to me, I'll have to look at you can call JetBlue for a comment, but it was more than typical. I mean, there were rows and rows and rows of empty seats on that flight.
Any masks?
Yeah, there's always masks, but not so much in North Carolina. I mean, I saw 1 or 2 people. In New York City, there's a lot of people with masks.
Yeah, a lot of people on the subways.
Right. Yep.
All that stuff.
There are.
We're going to be talking with a doctor later to get
a Blue Jay
to get some more information on the medical front. But we've talked to a number of doctors already. Really, there have not been that much alarm. Nobody saying we should close all the ports. They've been very measured. But the issue here is even if it doesn't have a terrible death rate, it could have a huge impact on people getting really scared and changing their plans. And that's when it sort of gets out of the gate and becomes something else. And is that what's happening right now? Not the virus becoming something else, but the fear itself becomes the problem.
What's FUD?
Fear, uncertainty, distrust. And Facebook and Twitter both today taking new measures to try to block misleading news and headlines and posts about
this. May sound incredibly cavalier, but if twice as many people died of the coronavirus as have died right now, and they just died within a 2-week period of a disease, like that wouldn't hurt the global economy. But it's all the machinations and the fear and the supply chain and where are we going and the uncertain, the FUD.
And it wouldn't be as much as the regular flu is every year.
Oh, yeah, right.
I thought that comparison was no longer correct about how it's not as bad as the flu is.
Well, we can ask a doctor.
Globally, more people die of the flu than several.
Isn't it getting close? Yeah.
I don't think so. Well, I don't know what the global number
I think this speaks to the core innumeracy of our time, which is the aggregate is fine, but the specific is bad. But everyone cites the aggregate as, Steven Pinker. Don't worry about everything because then the aggregate's good, even though your local experience is actually terrible.
Yeah, I mean, ask someone, here in New York City again, in Chinatown, the people running restaurants, not a good place to be right now. Yeah. You don't want to be owning a restaurant in Chinatown right now. It's not good.
Also, as we're looking here, challenging for gold.
Flat. Gold. And look at the 10-year right now. Another record. So second day in a row here on the 10-year, hitting a new low. Jared Blickery, of course, has been talking about that 1.25 as an area that
5 basis points away.
We're going to have to.
We're getting there.
Well, that's what the president may announce tonight. We need negative rates to combat the coronavirus.
Wouldn't that be something?
Do you think he'll talk about the Fed, or it's going to keep it all just to coronavirus?
Help us, JPL.
No, I don't know. Yeah. Are you going to predict? No.
It's impossible.
We'll speculate on that one later. For more of today's market action, though, let's go to Ines Ferre. She's live on the floor of the New York Stock Exchange. Ines.
And Myles, most of the sectors right now being in the red with energy leading to the downside. You had this morning these sectors that were in the green. Even energy this morning, those stocks were in the green when we saw that rebound, and then the ship turned around when those headlines about the coronavirus came out. Also, taking a look at gold, as you guys were just mentioning right now, gold it was in the red earlier, then went back in the green. It's around $16.49 an ounce. And just just taking a look at Zoom, so many stocks have gotten hit because of the coronavirus, but Zoom is one that has really performed under these headlines. This is because it was in the green earlier today, by the way, but now it's relatively flat. This is because Bernstein put out a note also about the fact that Zoom has added more active users in 2020 because of the coronavirus. So while airlines, cruise liners, those have gotten hit, Zoom actually has performed very well. Their earnings come out next week, and they're on track right now for February being their best month since their IPO back in April. Myles?
All right, Nez Frey, live on the floor of the New York Stock Exchange.
Coming up, we're going to be talking about Disney. Is everything okay in the Magic Kingdom? JP Morgan analyst Alexis Quadrani weighs in. It's our call of the day. Right now, take a look at where European markets closed earlier. It's time now for our call of the day. And today, it's all about Disney. Less than 24 hours ago, most investors didn't even know how to say Bob Chapek's name. Now he's the 7th CEO in Walt Disney's 100-year history. Joining us to discuss is JP Morgan's Alexis Quadrani. So, Alexis, your note this morning, headline, Disney CEO change came early, but transition is expected to be smooth. We were super surprised when the news hit. What can we read into the timing about this announcement?
Well, there's a couple of things. I mean, I think one from the outside, we were surprised and it seemed abrupt, especially since the announcement came the same day of the change. But I do believe the management team has been working on this for quite some time. And I think Bob Iger has said that, talks started in Thanksgiving to start making this transition. And don't forget, I mean, Iger has postponed his retirement a couple of times, resignation a couple of times. And I think he wants to spend more time doing creative. So I think what looks like it's an abrupt change from the outside is not so abrupt internally. And then the fact that Iger is not leaving, he's going to be there for another 22 months, also suggests, maybe a smoother transition than we are hearing.
Alexia, Dan Roberts here. Let me just ask you specifically about the choice of Chapek. We had heard for a while that it might be Kevin Mayer. I think that was sort of the odds-on favorite before because that was the streaming guy, the Disney Plus guy, and that has been so much of the buzz at Disney. Of course, we also remember years ago when it was going to be Tom Staggs, and that didn't happen, a former COO. But what do you make of it being someone who, at least for the last 5 years, was at Parks, not someone from the media side?
I think you have to look at the fact that this is a man who's been at the company for 27 years. He's worked in 3 of the major 4 divisions, right? He's worked in studio, he's worked in consumer products, he's worked in parks. He has been running for the last several years, the division that is responsible for 45% of the company's profits and then one of the biggest growth drivers of the company. So I think if you take a step back and look at it from that perspective versus somebody who, was in and out of Disney, worked at Playboy, worked in strategy, and only recently had an operational role, even though it's supposed to be one of the growthier and sort of newer drivers of the company, if you take a step back and compare their tenures at their, of their career, I think Chapek really does stand out.
And Alexia, in your note, you highlight that Chapek's been a staple at investor events. The street certainly knows him better than the public does. Do you think he'll have the kind of public presence that Bob Iger certainly has developed in the last few years of his tenure? And maybe I'm just too caught up in the business media, and I think that Bob Iger is someone who's a little bit bigger than just being a CEO of a big company. But it does seem like he is a man about town representing Disney. Do you expect Chapek will take on that role, or might Bob Iger still kind of be the public face of Disney?
Well, I think Iger will be somewhat the public face for a while, and I completely agree with you. I think he's very charismatic. I think they're extremely huge shoes to fill, and I'm not sure that Chapek's going to fill them 1,000%. I think I think he'll be a very good CEO, and I'm very hopeful for his tenure. But Iger was iconic. He was an amazing CEO. Now, hopefully, an amazing executive chairman. But I do think Chapek is very qualified, and I think he really embeds the Disney culture, and I think he'll be an upside surprise. Don't forget, when Iger took over years ago, people were skeptical that he could do the job, and look how that turned out.
Yeah, not to pick at the bone here too much, Alexia, but is it possible? Well, 2 questions. One, do you think he was Disney's first choice? Because as we've said here, there's been a lot of machinations here. Number 1. And number 2, is it possible that he's kind of a transition CEO, that they're, because he's 60 years old, right? Are they looking for a younger generation? So is this guy like a 3-year bridge kind of person?
I don't think I would say a 3-year bridge kind of person. Is he going to stay 15 years like Iger? Probably not, just given his age and when he's coming into this. But I would say 3-year bridge transition sounds a little short to me. Could it be 5 to 7 years, something like that, and then maybe the next person takes over? Don't forget, the company's going to look very different 5 to 7 years from now if everything goes on track. So it could be. It probably won't be as long as the tenure as Bob Iger.
What do you think his biggest challenge is?
I think his biggest challenge is to learn the business that he hasn't been running, right? Learn the media side of the business, learn the direct-to-consumer side of the business, because that is where we're seeing the most change in the industry right now, and that's probably where he has the least amount of experience. But again, Bob Iger being there for the next 22 months, I don't think he's thrown into the fire right away. I think he'll learn as he goes.
Alexia, I want to pick up on that point. You said that the company will look very different in 5 years or so. Well, how do you think it'll look different? The obvious to me is the direct-to-consumer push. Iger has said that that's the #1 priority. But are you thinking of something else other than just emphasizing streaming?
No, I'm thinking mostly that. I think the parks business will continue to grow and be a big growth, a big percentage of profits of the company, but the media business will be transformed completely, and that's still about almost, that's a little bit bigger than parks in terms of its profit contribution. And if that goes through a major transition, then we see the linear business really shift a lot to the digital business. It will, the face of the company will look a little bit different.
Alexia Quadrani, U.S. Media Equity Research Senior Analyst at J.P. Morgan. Thanks so much for your time.
Thanks for having me.
Still wonder what the NFL looks like,
Oh, sure. Yeah. Jimmy Pitaro.
There you go.
If they're playing, they're going to get a contract.
Wait, watch out, XFL.
Coronavirus threatening NFL season?
Oh,
no.
And the XFL too.
There you go. All right, coming up, market strategist Peter Cheer is going to join us to talk about the wild moves we're seeing over the last couple of days, why he's more concerned about changes in correlations as opposed to volatility. We'll have more on that coming up after this break, but first take a look at the trending tickers here on Yahoo Finance.
Now, here are some stocks that we're watching. Mattel on news at the SEC, and federal prosecutors want a closer look at the toy maker's accounting practices. Beyond Meat on news that the plant-based meat producer will collaborate with Starbucks on a new sandwich, which will debut in Canada, where all new sandwiches go on March 3rd.
Earnings tomorrow.
I know the
guys.
guys.
Losses tomorrow.
The bread. They have this big bread maker in Toronto. I bet they're working with him.
I feel like they get to
Starbucks
test
does.
everything there. I
Canada,
know there's
the fake meat
fewer,
market
and then you
testing.
try
They could
it.
put Beyond Meat on a Montreal bagel, perhaps.
And put some cannabis on top.
That would be insulting to the bagel.
Canada,
They
the
have
fake
some
meat
good
capital of
yeah,
the world.
in Montreal, as we know. Right?
No one's laughing about this one, unless you're short. Smiles Rec Club
But it is a
shares
smile.
plunging after the company reported a steep quarterly loss of 25 cents per share, compared to the consensus estimate of a 9-cent per share gain. So revenue also fell below Wall Street forecast. It's pretty ugly.
More like Frown Direct Club.
That's good. You get paid for that?
Yeah,
he
well,
does.
you know, I'm
For a
surprised-
living, as a matter of fact.
I'm surprised that they didn't write that one.
I know. That's
Script.
right down the middle of the.
Well, we got it coming up later in the show. All right, another volatile day here in the markets. Joining us now to discuss is Peter Cheer. He's the head of macro strategy at Academy Securities. So, Peter, I want to start with your note where you write that changes in correlation, in your view, are more dangerous than just an increase in volatility. And along those lines, are you seeing, like, what kinds of changes are you seeing right now? Or is everything moving in one direction at the same time? What concerns you?
I think for the last few weeks, while we've had this volatility, we've definitely had stocks zig while bonds zag. So every time stocks went up, bonds sold off, and vice versa. And all of a sudden, that behavior changed a little bit into the close yesterday. And making it even more dangerous to me, you saw gold sell off into the close, commodities were selling off, even Bitcoin was selling off into the close. And to me, I think people run their portfolios, especially these risk parity type strategies, where they're comfortable. If your stocks are moving one direction, your bonds are the other, your portfolio is performing as it should. If you start getting these correlations to break down, I think you just see selling across the board, and that's what we're not prepared for at all.
Can we talk about treasuries right now? 10-year hitting a record. We had a record low yesterday. How is this playing into your thinking as hedges on the market here?
So I think the 10-year and 30-year bond have been great hedges. One of the ETFs that has been very popular is TLT. And again, over yesterday, you just saw that the Treasury didn't seem to be as strong as it should have been. It seems to be bouncing a little bit more or behaving a little bit better today. But even TLT, I would have expected significant inflows into these ETFs the past few days. We're not really seeing that. So I think people are starting to get nervous just how low the Treasury can go. So if that's not your choice of hedge anymore, or it's not an effective hedge, then I think you're forced to sell your other assets. And that's, again, what we haven't seen in the past.
Yeah, but we certainly haven't seen it yet either, Peter.
No,
I mean,
definitely not
that's
yet.
what's so amazing to me. I mean, we were talking about this rampant fear, everything, there's blood in the streets. Not really, if you look at the numbers. And so it sort of leads me to ask, what could happen? Because if you think this is bad, this is not bad.
For me, I think a lot of people talk about the supply chain, and I think we've talked about it before. I'm really focused on the tourism angle. China has become a huge consumer of tourism. The Chinese spend more money outside of China than any other country spends on foreign travel. I think that's part of the reason we had very weak service data last week. And that service data, to me, has been really important, right? For the past few years, every time we get a hiccup, we can argue, well, we're not a manufacturing economy, we're now a service economy. If service is slow, that is very problematic. I think that's going to get hit very quickly by this slowdown in foreign travel from other countries. So that's what I'm really keeping an eye on. I saw a bunch of reports that the ports are starting to really slow down and have to lay people off. So that, to me, is where this gets really bad.
But speaking of ports, I got to ask you just quickly, what's that ship over your shoulder there, Peter?
Just a generic ship. I think one is a Canadian ship, actually. It's on the dime.
Got it. Well, I hope it's not. I hope everyone's okay on that little ship. Okay, go ahead.
It's a Canadian ship covered full of Beyond Meat.
Right, yeah.
All right, Peter, quickly before we let you go, I just want to get your thoughts maybe on one thing you're looking at in this market that might give you a sense of where we go from here. I think today's intraday reversal, certainly concerning to a lot of investors. Is there one data point that you're keying off of right now?
I'm watching for this change in correlations. That, to me, is really key. If we see that shift in correlations, then I want to be out of all risk assets. The other thing, I think, we want this data. We need to see some slowdown in a country that seems to be reporting viable data. I think we need Korea or Iran or someone to say, hey, these things are under control. But I think we don't really trust the data that's been coming out of China And the data that's coming out of South Korea, now Italy, and the cruise ship are all telling us a very different message. So we need to see something resolved there, or otherwise I think there's just going to be more and more fear building up. And so far, the only solution to any kind of outbreak is restricting travel, putting quarantines on, which gets back to my immediate problem that it's going to hit the services industry.
All right, Peter Cheer, Head of Macro Strategy at Academy Securities. Always good to hear from you. Thanks for coming on today.
Thanks a lot for having me.
Coming up, we've got more Final Round. We're going to head to Cupertino, California for the latest on Apple Shareholder Day, what Tim Cook and gang have to say about the company and coronavirus. Right now, let's take a look at where big tech is trading.
Welcome back to the Final Round here on Yahoo Finance. Myles on with you in New York. Full house today. Jen Rogers, my co-host, as always. And we got Yahoo Finance Editor-in-Chief Andy Serwer.
That's a lot.
And Editor-at-Large Dan Roberts. Doing our best to keep everybody under control here on the desk. We got 30 minutes to go in today's trading session. Doesn't look from this angle like a whole lot's happened, but I can assure you it is not a great day out there on Wall Street. The Dow was up in excess of 400 points earlier in today's session. Now we're in the red. We had seen the NASDAQ up better than 1% at its highs. Now the NASDAQ up just 0.3%. Certainly this market trying to get something like stable footing. But coronavirus headlines continuing to dent investor confidence and just not a lot of support from buyers out there in this market. For more on today's market action, let's go to Inez Ferre. She's live on the floor of the New York Stock Exchange. Inez.
Yeah, Myles, just want to show you some stocks that have been in the green all day despite the turnaround in the markets. Take a look at Beyond Meat. This is after Beyond Meat said that it will collaborate with Starbucks, adding Beyond Meat to Starbucks breakfast menu in some 1,400 Starbucks in Canada starting in March 3rd. Also, TJX Companies all day in the green today, in the green. This is after beating on the top and the bottom line for its latest quarter, raising its quarter dividend by 13%. Also, comparable sales were up 6% year over year. The company said that it saw strength across all divisions. And check out Peloton. One of the traders just actually texted this over to me. Peloton is in the green right now. This is after a note from Needham with a Needham analyst, very bullish on the case for Peloton because of coronavirus in places like Italy, like Germany. Germany, which is one of the countries that Peloton recently has been introduced into. And this is because people are just will be staying home more, using Peloton. And so you're seeing the stock in the green. Myles?
All right, Nez Frey live on the floor of the New York Stock Exchange.
Apple's 2020 shareholder meeting is well underway in Cupertino, California, and Yahoo Finance tech editor Dan Howley joins us live from the event with the very latest. So, Dan, of course,
there's the spaceship behind him.
There,
right?
he's there on the scene, and we are seeing what's happening in the market. Coronavirus still front and center. Is it front and center out in Apple land?
Surprisingly, no. I mean, Tim Cook addressed it at the beginning of the shareholders meeting. When we went to the question and answer portion, though, nobody brought it up. There were questions about when they're going to be entering India and how they're going to be using that market. Tim Cook said they'll open their first brick and mortar store next year, which is huge for them in India, and they will have their online presence available this year through their official online store. Then there was a question about why Apple didn't go and get the Friends reunion rights. He responded to that they want to work on their own kind of content, but no questions from shareholders with regards to the coronavirus, which, is surprising considering that Apple had to revise its Q2 guidance downward, not giving us a new range, basically saying, look, we know this is going to hit us pretty hard, but we don't know yet. Factories there were closed. The actual stores themselves were closed, so consumers couldn't go out and purchase the goods. So that is the actual situation, and there's fear that it could stretch into Q3 now because the factories still aren't up to full speed. Now, there is some light at the end of the tunnel where some analysts and investors are looking to this as a potential boost for the iPhone 12 that'll come out in around the Q3, Q4 time period in September. That would be huge for Apple, considering it's already expected to do well with the 5G capabilities that next iPhone is supposed to have. So that's really where investors and analysts are looking. But again, nothing here on coronavirus from them, just questions on the India expansion as well as what they're doing as far as the content on Apple TV+.
Well, and Hallie, not every annual meeting of shareholders can be the Berkshire Hathaway annual meeting of shareholders, but one would imagine that for the largest company in the world, there would have been more than, I think I saw 8 questions were all that was asked to Tim Cook, that there would have been more folks there, whether it's, you're not a shareholder, so you can't ask questions, but if you bought one share and you're an analyst, you should show up and be asking things, because this is a crucial time for Apple. But in your reporting, it sounds like things kind of came and went without incident.
Yeah, and it was interesting, there were only 3 proposals from shareholders this year outside of the obvious proposals of reappointing the directors to the board. Those involved tying sustainability efforts to executive compensation, Apple supporting free speech. That's kind of a nod to the fact that it had to take down apps in the Chinese market. And that's really, all that we saw. Those were voted down, by the way. So Apple obviously going ahead and pushing those back and saying, look, we already do enough with sustainability. We don't need to tie it to our executive compensation. And as far as China goes, we have to work within the laws of each country, saying that it thinks it's a benefit for them to offer their products and provide consumers privacy there rather than not being in the market at all.
Hey, Dan, I want to ask you an extremely qualitative question, and that is, what was TC's mood? I mean, was Tim, happy? Was he sad? Was it solemn? Was it serious? I mean, he's looking happy there, but you can't see. In any event, on the stage, was there any indication that, this is a serious time for Apple, or was it just like, we've got great products, the usual?
It was really, he came out very excited, pretty jacked up, as if it was a product announcement almost. Said he loves this event more than any other because he gets to see people that he doesn't get to see year round. And it really did have that kind of exuberance to it, that it was almost like a product rollout. He did obviously show some sense of somberness when he talked about the coronavirus, as well as discussed the Pensacola shooting. There was a question on why Apple wasn't fully cooperating, or the accusations that it doesn't fully cooperate with the Department of Justice in providing a backdoor for its products. Tim Cook said that he was pushing back against that sharply, and he didn't agree with that characterization at all, and that Apple does work fully with the DOJ offering a backdoor, he said, would be an issue because it means that once there is a backdoor, anybody can open it. And he likened it to a house having a backdoor, meaning that if anyone has a backdoor on their house, someone can go through it. And that's something that security experts have also jumped on, that that's not a good idea or a good way to go about prosecuting different cases or looking into investigative efforts. A backdoor would just be a negative to that.
Hey, Holly, real quick, we're watching travel stocks sell off hard here. Worst performers in the S&P 500 today. You've just been on a plane. Andy was on a plane earlier today. Was it full going out to California? Did you notice anything?
No, nothing really. There was prior to the announcement, sign of talk of people preparing for coronavirus and maybe using extra precautions. Nothing weird here. As far as the airports, everything was fine. I didn't notice anything out of the ordinary. So seems like everything is mostly cool.
Our man on the ground in Cupertino with the Apple report and the travel report, Dan Howley. Great talking with you. So I was a little surprised today in the Apple news when they said, I didn't know they didn't have a store in India. I would have thought that they had a store in India, that this is going to be their first store. Are we going to start hearing
people
about
with iPhones there? I don't know about store.
Are we going to start to hear about India as a big growth market, the way we did about China a couple years ago?
Amazon.
That's what it's going to be China. It's going to be China. Or is it a huge risk, right? Look what happened to Amazon there.
Well, not only with what happened to Amazon, regulation to tech more recently has been unfriendly there in India. So I think they've tempered the expectations. Amazon was all about India for a while. Oh, that's the big next market. Kind of pulled down a little bit after they saw that regulators haven't been so friendly. But more to the point about coronavirus, we also heard earlier today from a sporting goods person, the CEO of Modell's actually, that ironically, I think, a lot of these sports apparel names are better positioned right now amid coronavirus than they would have been because during the tariffs, they started to move their supply chains away from China. So it would have been kind of a double whammy, and instead it hasn't been because they were better situated. And just some irony there, they couldn't have seen that coming. That was pre-coronavirus. Now, one more little point here. He said to Dan Howley, can't believe there weren't more questions about this, or really questions, period, for Tim Cook at this event. I mean, it can't all be Berkshire, yes. Well, I know a reason for that. I mean, sorry to say. The kind of people who are going to the Apple event, they're too rah-rah Apple. I mean, Apple gets rooms full of people.
Berkshire is rah-rah Berkshire.
Have you been to Berkshire? People, Kraft Heinz, it didn't go so well. What are you going to say to that? I just think these Apple events, everyone in the room, too much of the Apple press, but then also the analysts, it's, how are you so wonderful? You're so wonderful. How do you do it?
You know what tech needs? They need one Mike Mayo who buys a share of every company and goes to every shareholder meeting and asks the most annoying question of all the CEOs.
He's right. I mean, yes, Berkshire's a love fest, but this is more of a love fest, and people do ask those guys tougher questions. And they're called fanboys. Right? And they're primarily boys, and they're primarily fans.
The new AirPods are so awesome. Can you tell us about the next awesome AirPods? What'll those be like?
And Apple does a good job of managing the people in the room, shall we say?
Yeah, and at Berkshire, they're setting it up with journalists and with the analyst community as well as with shareholders. So it's much more open and diverse than just the shareholders.
I mean, you don't
Maybe
get
we
like
should propose this to Tim Cook.
It's
we come sit at one table and we'll ask questions.
Right. At Berkshire, actually, it's interesting because you don't get communist firebrands. Because that would be really like, you, sir, are a thief, robbing the American people.
Sometimes
I've never heard anyone do that.
Rock, protester.
You
don't get any of that.
Yeah.
It's interesting, too. I will say, with Apple and Foxconn, and we talk about how Zoom has been doing well amid coronavirus because of telecommuting. I mean, you do have to wonder right now. We talked about the Foxconn plant offering bonuses to people to come back to work. As this stuff grows in certain countries, it's not just about factories. It's not just about supply chain because it becomes even just regular offices. This is a little bit of an example of everything is everything, right? Because when it really gets large in certain, you mentioned Brazil earlier, now we're talking about Italy. What about just regular office jobs being affected too?
Right.
I'm looking forward to Berkshire now. Now I'm just playing it back in my head.
You want the communist firebrand or all the people?
It's very folksy, and the two of them. It's kind of amazing that they're both.
There's nothing like that.
They're both still alive, and they sit there, and you look at them alive answering these questions.
Absolutely right.
It's incredible.
There's nothing like that event.
And
I'm not sure viewers would want to watch the Apple.
They literally eat the peanut brittle and drink the Coke all day long.
And not only do they answer questions from analysts and journalists, but also a lot of children.
That's right.
That's the big thing. That maybe that's what you need to do to get a question at Apple. Bring a child.
And then Japanese shareholders.
Yes.
Those are
Good life wisdom. Eat the peanut brittle, drink the Coke.
There you go.
Right?
Coming up, we'll have the very latest on the coronavirus and its possible effect here in the U.S. Expert Dr. Brian Garibaldi of Johns Hopkins will join us for that conversation. But first, take a look at where Big Pharma is trading right now. 20 minutes to go in the session.
Iran and South Korea are among the countries reporting climbing numbers of coronavirus cases. The global death toll is now over 2,700. And joining us to discuss is Johns Hopkins Biocontainment Unit Director and Associate Professor of Medicine, Dr. Brian Garibaldi. So, Doctor, we are getting headlines here pretty quickly on, let's see, the latest, Reuters saying that a cruise ship can't disembark in Cozumel. We have reports of Nassau County, some 80 people being monitored there. When do you think, because we've been told by the CDC, this is a matter of when, not if. When does this become an issue here in the U.S. when we're going to have businesses closing or schools closing? Do you think that's going to happen?
Sure. I think it's still a little bit early to tell when that's going to happen, but we're obviously worried that there might be person-to-person transmission happening in the United States. We haven't seen any sustained transmission in the U.S. yet, but we also have not been testing as many people because the CDC definition is still based on travel to China, and I expect that's going to change sometime in the near future, which I think will open up testing to a lot more people as that testing becomes available.
Dr. Garibaldi, we also hear that the United States is not ready. There's not enough test kits, there's not enough masks. Is that the case? And also, do we need a coronavirus czar?
So, I think every hospital and health system, including our own, has been ramping up their efforts to make sure that they're ready to identify, isolate, and provide care for patients who might present that meet the definition for the novel coronavirus or COVID-19. I think the concern is that, if we run through these supplies too quickly, or particularly if people are using them when they're not supposed to be using them, there could be a shortage of critical things for healthcare workers like masks. That's something we're worried about, but there is a national stockpile of these that can be transferred around the country as we see potential pockets of infection, and health systems have really set up their own plans to be able to try to provide the best care for these patients as possible. We're definitely more ready than we were 5 years ago when we really ramped up preparedness efforts for Ebola. And here at Johns Hopkins, we've really benefited from those preparations and being the regional treatment center for Region 3 of HHS to be able to leverage that experience to now pivot towards a respiratory pathogen, which is something we've been expecting and hoping wouldn't happen, but we've been preparing for this for several years now.
Well, and so talk us through some of those things you learned during Ebola. I guess that was 2014, fall of 2014, and what that kind of procedure might look like if we start getting increasing or accelerating numbers of cases here in the U.S.
So I think the biggest thing is really trying to have a plan in place to identify potential cases and to make sure that as soon as there's a suspicion that someone might have COVID-19, that we put them in respiratory isolation. And that starts with health screeners in the emergency departments or people in primary care clinics, getting patients to wear masks right away if they have respiratory symptoms. Patients calling ahead to their providers, telling them, hey, I think I have an upper respiratory illness, so that they can immediately be put into an isolation room. Now, every hospital has the ability to put patients in these types of rooms for pathogens like tuberculosis or measles. But obviously, we may run out of the capacity to use those types of rooms. So it really just starts with trying to recognize cases as early as possible so that we separate people in waiting rooms and in the emergency department. And also being able to try to make sure that we don't overwhelm the health system. So people who aren't sick enough to come to the hospital, there's lots of things that we can do over the phone and through local city and state health departments to try to test people out of the healthcare environment so that we really reserve the healthcare spaces that we have available for patients who need to be hospitalized.
Dr. Garibaldi, it's good and also useful and instructive to hear you say that America is more ready than 5 years ago. That's comforting. And, in the same spirit of trying to sort of sift through what's real and combat the misinformation, there are a lot of overreactions out there right now, but there's also, the risk of underreacting, right? I mean, for a while here at Yahoo Finance, we obviously look at the stock reaction, and stocks are really shrugging off all this news. But now this week, the headlines really increased. And now, anecdotally, you can really see the panic. We've been discussing how more people seem panicked about it. I've heard a couple of people suggesting that what comes next would be something like shutting the ports and having people no longer fly in and out of the U.S., shutting down flights. Is that an overreaction, a bridge too far? We're nowhere near there. I mean, where should the average American be right now in terms of fear and concern about all this?
Yeah, so what I've been telling my patients, but also my friends and family, is that right now we're in the middle of a really bad flu season. And the same things that are going to protect you from COVID-19 are also going to protect you from getting the flu, which is, really good hand hygiene, staying home from work or school if you're sick, so that you don't, potentially expose others, colleagues, friends, family to infections. I don't think we're at the level yet where the average person needs to be panicking about this, but I think it's important to remember that we're still in the middle of this flu season, and those basic efforts can do a lot to prevent the spread of this virus as well.
Talking about just the flu that comes every year, I mean, we all get flu vaccines. So there's talk about a vaccine for this new coronavirus. When will that come? And is it just along the lines of the vaccines we already get, which I hate to tell you, I'm sure you know, they're not 100%. I've gotten the flu vaccine and then gotten the flu as well.
Yeah.
So is that the kind of vaccine we're talking about, or a vaccine that's more along the lines of something that almost, eradicated measles?
Sure. I think it's too early to say how effective a vaccine is going to be. Based on the experience for SARS back in 2003, I think it took about a year to develop a vaccine that preliminarily looked like it created antibodies and that would be effective, but thankfully we didn't see SARS again, so we never got to test that vaccine. I think we're probably looking at a year before we would have something available on the market, and whether or not it would be more along the lines of flu. I think it's likely to be more effective than that, but I think we have to wait and see what the data looks like before then. I think it's also likely that we're going to start getting data, particularly out of China, about the use of existing antiviral therapies that may have a role to play. There's a drug called remdesivir, and there's also other drugs that have been tested for or in use for viral infections like HIV that might have some benefit here. And there are clinical trials underway already in China, and we've just started here in the U.S., particularly at the University of Nebraska, looking at some of these antiviral therapies to see if they might be effective in the current outbreak.
Dr. Brian Garibaldi, Director of Johns Hopkins Biocontainment Unit. Really appreciate your time here.
Oh, it's my pleasure. Thank you.
Really useful and instructive to hear the idea of just think of it as a bad flu season. I mean, you have to keep monitoring the headlines and everything, but we all discuss. We've heard people panicking.
What causes
what's
the
happening
end
with
of the
stocks.
flu season?
It's a flu season.
Springtime.
Wash your hands. That's what I took away.
Wash your hands. Don't touch your face.
Pray
also,
for spring.
if you want to wear a mask, you're going to have to shave. Did you see that graphic the CDC
Yeah,
put out?
I'm not. I'm
People
good.
who have facial hair, that doesn't work. But you could go with this. You could go with the
Just
mustache.
tie the strap
So
tight.
Dan,
You know I care for the mustache.
Aaron
look, and that
Rodgers,
would work.
That'll be a
Abraham Lincoln.
Abraham
None of you
Lincoln.
guys.
By the way, you can't
Danny
get the mask.
Serwer, Dan Roberts. Have a great evening. Abraham Lincoln.
Well, he would, Jen.
No Lincoln.
If he
This
could,
man is
if
no
he
Lincoln.
did.
All right, coming up.
I have met Lincoln, and you, sir, are no Lincoln.
That's not where I was going. with that
Closing
at all.
bell, 8 minutes away. Jared
not at
Blicker's
all.
going to stop by. We're going to get techno with Wi-Fi interactive touchscreen. We're back with that right after this. All right, Jared Blicker joins me at the Wi-Fi interactive touchscreen. We got about 5 minutes to go in today's session. Jared, I mean, ultimately, we're not going to see a lot of movement, it doesn't seem like, on the major averages, but not a super constructive day for the bulls who tried to take control early in the session.
Yeah, I would have actually liked to see a gap down to begin with. So let's check out what's happened. Actually, we're going to go to the S&P 500 here, give us a more accurate picture of the support and resistance levels. But, 2 days ago, we were standing here and there hadn't been that much damage done to the market. And then yesterday did damage the market, closed a little bit lower than I would have liked. And we couldn't make much of a rally today. So no, not looking particularly constructive here. I would say that JPM's Kalanovich is out with a note saying most of the forced selling by dealers, by CTAs, volatility targeters, most of that's done. But if we get too many more headlines, definitely going to go south.
All right, let's take a look at the 10-year. That, of course, I think is where the action is really at. We had 130 on the 10-year, rounding up 131 on our chart, but record lows for the 10-year. I know you've been looking at 125 for a while, but just in terms of what the stock market is going to need to see out of bonds before we can kind of get bonds not really being the tail here.
Yeah, I think bonds need to capitulate in order for stocks to be able to move up. Haven't really seen that yet. We've seen big movements, but they've been incremental for the most part. I think 10 basis points was this move in here, which is pretty big. But if we get something that exceeds 1.25 to the downside, that might be the capitulation that the market's waiting for. Meanwhile, the VIX is still pretty elevated here, hit 30 yesterday, and I don't know if it's going to go that much higher, but we could get one final spike higher.
Let's take a quick look at the NASDAQ because we are seeing tech stocks in the green. We had the NASDAQ up well over 1% at highs of the day, so slightly more constructive here, but overall not a chart that inspires a ton of confidence, especially if we spend a few more days kind of in this gap lower. You're all of a sudden looking at something like an island top there for the NASDAQ.
Exactly.
So I learned something doing this segment for a while, let me tell you that.
Exactly. Yeah, so tech is a bright spot. I think people are buying the dip in some of the big names like Apple, Microsoft, and a few others, and that's fine, but that's not going to support the entire market. Market breadth is declining. The AD lines for the New York Stock Exchange really negative right now, and so I think it's the big cap names. In fact, we can just take a look at the NASDAQ heat map and see, okay, these big guys here, they're propping up everything. And if they start to sell off again, we will get more material lows. Just depends on the news flow, which is entirely unpredictable at this point.
All right, Jared Blickery live at the Wi-Fi Interactive Touchscreen. We got 3 minutes to go in today's trading session. On the other side of this break, we're going to have the closing bell. Plus, Wall Street getting bearish on Nike. How hard will the coronavirus hurt the world's largest athletic retailer? We'll discuss coming up right after this break.
Welcome back to the final round on Yahoo Finance. I'm Jen Rogers with my co-host Myles, and joining us right now is Brian Chung. We are moments away from the closing bell. Do I call it a mixed market? I mean, it's basically, it is, but it really is a down day for the street. That's the closing bell. Live pictures of the New York Stock Exchange and the NASDAQ market site. If the S&P ends lower here, this will be our 5th day down in a row. The Dow, of course, giving up big gains. That's going to do it for us. Taking a look at these final numbers. Of course, this is not the action that many people, dip buyers, people thought this market was conditioned to go higher. You got 2 down days. 10-year was going to bounce off that record low. Instead,
it's just sitting there.
Hit another, and we lost 100 points on the Dow. This cannot be encouraging for bulls. to see this?
Well, it's not encouraging for bulls, but at the same time, when you look at the spread between the 2-year and the 10-year, it's not necessarily signaling a recession trigger in the United States, right? And I think that's important to realize. Yes, across the board, Treasury yields are coming down. I think people are buying across the yield curve spread. But when you look at the 30-year, it's obviously it broke through that 2% in the last week of January. That was kind of the bad omen for all the other duration bonds that were coming down. The 10-year hitting an all-time low today. But again, I want to point out that the spread actually between the 2 and the 10 has widened today. It's 18 basis points as of what I'm looking at right now. Coming into today, it was 13 basis points. It was 12 basis points on Monday before we had the big sell-off in equities. So it just seems like everyone's just buying U.S. dollar-denominated assets, but they're not buying on the long end of the curve to the point where it might be signaling that people are saying, we don't want any short-term exposure right now.
I mean, we shouldn't do the seminar here on why the yield curve tends to have predictive value for recessions, but why does it tend to have predictive value for recessions?
Well, so, I mean, basically it's term duration, right? The idea is that if a lot of people are just so bearish on what's going on in the present, they're going to try to hunker down not only in fixed assets, but in future, in 10-year, longer term.
But the front end comes up because the Fed raises rates into a recession. So we don't have that environment. So I guess the question is, and I think this is something that's now going to come up as we go forward here, trying to figure out the economic impacts. If we go into recession, and I don't think we will, but like who knows, right? Everything seems to be on the table now. All the yield curve predictor types are going to say I was right, but they're actually not, because the reason the yield curve inverts, again, it's because the Fed tries to cool off the economy, and the Fed is not going to be raising rates. And so I think the yield curve conversation enters a weird place right now.
And especially with rates this low, right? I mean, yes, the yield curve inversion meant a lot more when interest rates were a lot higher, where it was a lot more dynamic when you had, yields moving up and down, not by 5 or 6 basis points, but by 20, 25 basis points. The difference is definitely something that's salient. And I think something else that's worth mentioning is that post-quantitative easing, post-Operation Twist, it's definitely the case that the yield curve is no longer an indicator necessarily of how people view the term premium. It's really about what the Fed is doing. But I think it's still worth watching. The market reaction when it soured in August shows you that people still care about it, though. So that's just what I would offer to push
And
back.
that indicator hasn't been proven wrong yet.
Yeah,
even
it's got
though
a pretty
they're
good track record since the 50s.
Yeah, and even though there are people that say, this time it's different, you can't, trust this yield curve inversion now that we have negative yielding rates other places and it's pushed everybody here. It's not a good predictor, but I don't know.
Well, so
still have time on that, 12 to 18 months.
Along the line, along the lines of the yield curve, though, I mean, I think the question that every investor is asking is, does this sell-off bring the Fed into play? And you just spent a couple of days down in D.C. At economics conference. We all heard from Rich Clarity yesterday afternoon. It seems like the Fed right now is not setting up markets to make a dramatic change when they meet March 17 and 18. Brian, in your view, how far away is the Fed from the market at this point? The market has already up to a 30% chance that they're going to cut in March. Now the Fed futures is kind of a synthetic number, right? I mean, it's not like a pure prediction, right? But anyway, we basically have markets looking at April now as a likely cut from the Fed, and it just feels like the Fed's language is very, very far away.
I mean, I would say this is probably the farthest that the Fed's been from the market since it really began cuts in last year. When we talk about the Fed funds futures,
like December 2018.
December 2018, really. I mean, the Fed has not signaled anything beyond the fact that they are comfortable with where they are right now between 1.5, 1.75%. But as you mentioned, if you look at not even just March, if you look at the April FOMC, 2 meetings from now, the Fed funds futures contracts are saying we have a 50% chance of seeing at least one rate cut by then. So if it doesn't happen in March, maybe it happens in April. Meanwhile, at the same time, you have Fed officials down in Washington, D.C. You have Loretta Mester, and you also have Rich Clarida, the vice chair, saying for right now, we don't want to overreact to any market movements, which is something we've heard before many times. But they were saying we don't see this as a material change to our outlook. And I think that's the key word. They've been saying since basically last year that unless they see a material change, they're not going to move on rates. And for right now, they say the coronavirus is not a material change.
It's the first time you're seeing in a while a number of analysts using the word in policy error phrase, policy error in their notes. I mean, it feels, and it depends on who you read or who you talk to, but there's a sense out there that the Fed might be walking itself into a policy error here.
Well, and you have actually some inside the Fed, well, I guess formally inside the Federal Reserve saying, yeah, that's definitely the case.
Right,
Mariano
Coach
Coca-Lakota, which I understand people associate him with being kind of more on the fringe side of the FOMC when he was part of
he was a hardcore hawk, and then he became the most dovish member of the
Right, but
FOMC.
he wrote that Bloomberg op-ed earlier this week saying that they should call it an emergency meeting and then cut by 25, if not 50 basis points immediately. Now, I haven't heard anyone inside the Federal Reserve System, although I have not talked to Jim Bullard.
I was just going to say, can we get Jim Bullard on the phone here?
Who have said that they want to do that at all. I mean, an emergency meeting would be relatively unprecedented, and we haven't heard a call for that since, I don't know, last year when President Trump was calling for that. So I think it's unlikely for right now, but again, all the Fed officials are just saying, I think as we would have expected, that we're just going to wait and be patient for right now.
Getting some after-hours earnings action here in the travel sector. Bookings, holdings, quarterly results just hitting the tape. Let's go to Seana Smith with those results.
Hey there, Jen. So the big focus here in these results are the coronavirus. Let's start with what bookings reported for the fourth quarter. So this is last quarter, largely in line with expectations in terms of revenue, coming in at $3.3 billion. The estimate was for $3.27 billion. Earnings per share on an adjusted basis coming in at $23.30. The estimate was for $22.05. That's an increase of 4% year over year. But again, it's that Q1 guidance. That's what the street is paying attention to today. Now, Booking lowering its guidance in a number of its divisions here for the first quarter. It sees Q1 adjusted earnings per share coming in at $9.05 to $9.65. The street was looking for $11.86, so much lower than what the street was expecting. Bookings also saying that it sees Q1 revenue declining 3 to 5%. They say they see Q1 room nights booked declining 5 to 10%. Also, Q1 gross travel booking declining 10 to 15%. In this release, Booking CEO Glenn Fogel did discuss the coronavirus very briefly. He did write in a line that while the outlook for global travel in the near term is uncertain due to the coronavirus, we will manage the business appropriately to enhance long-term value for our stakeholders. Now, the company in this release did go on to say that coronavirus has had a significant and negative impact across our business during the first quarter. It is not possible to predict where and to what degree outbreaks of the coronavirus will disrupt travel patterns. They went on to say the guidance for the first quarter is based on the trends observed in the quarter so far and considers the continued and negative impact of the coronavirus. The guidance ranges for the first quarter are wider than typically provided given the high level of uncertainty regarding the coronavirus. And they did end by saying while it is extremely difficult to forecast the results, these guidance ranges represent the company's current estimates of first quarter results based on currently available data. So again, for the fourth quarter, that was last quarter, there to end the year, bookings did beat what the street was expecting on the top and bottom lines, but the Q1 guidance coming in a bit light.
All right, Seana Smith, live in our newsroom with Booking Holdings' latest quarterly results. It's funny how fourth quarter earnings season came and went. It was like all this hype around what are they going to say for 2020? What's the full year 2019 really going to look like? Are earnings going to be up? And all those results we got 4 weeks ago are now dated. And Booking Holdings is part of this group that's now at the vanguard of the reports you really want to hear. And it's making this report, which the market is not really loving, and basically opens up Booking to a literally anything could happen kind of year after this, because they essentially are saying in this release they have no visibility on what the first quarter is going to look like, no visibility on what the rest of 2020 is going to look like. I think it starts to bring that April earnings season into like really stark focus of like, ooh, this is going to be bad for a lot of companies across a lot of industries.
Yeah, extremely difficult to forecast.
I mean, that's not a press release kind of word.
And you do wonder, I mean, because it's so difficult to forecast, are they purposely lowballing it? Right? I mean, it'd be hard to imagine a scenario where you have your FP&A people basically highballing it, because then you have a severely downside risk of missing those estimates. So you do wonder to what degree. I mean, this is already pretty bad. Year-over-year decline for total gross travel bookings when you control for currency of between 8 to 13%. I mean, that's pretty harsh.
Just given the headlines that we're getting on the cruise ships or the flights out of Dubai have been suspended for 48 hours. I mean, that doesn't seem like a lowball number. I mean, you could see these numbers, I feel, if we keep getting headlines like this, hit significantly more. I mean, I'm surprised they maybe didn't pull guidance
I was just
completely.
thinking that.
That's what you would imagine. I mean, it's not unheard of to do that.
I was just thinking
Companies
that.
say we can't give guidance.
Because, to your question, Brian, like, are they lowballing? Are they highballing? Like, what are they doing? I mean, they sit there, like, the people who work at Booking have access to the daily trends, right? They can see how many places have been booked, how many haven't, compared to prior years. So, I mean, I know this is guidance for the current quarter, which is underway, about a month underway for them, but I'm kind of reading into this. There hasn't been an inflection. If that makes any sense. There hasn't really been a bottoming. Maybe there's an accelerating in cancellations. I think for a company like Booking Holdings, so now we go to the industry level, they obviously are very concerned about the Italy news, I think, a lot more than what's happening in China. They're concerned that there's now cases in Brazil more than
Spain.
what's happening. Right, I mean, that is really where they're going to start feeling the pressure. We see it with the cruises already. And so you do wonder, do they have any sense, you do wonder why they even came out and offered guidance for the first quarter, and is this going to end up looking conservative when all is said and done?
And now that they've offered this information, they're going to get grilled on the call
That's
about
the thing,
it. And you do wonder to what degree, maybe like our conversation about whether or not this is on the low end or on the high end, if basically you're going to have the executives on the call telling the sell side guys, look, this is exactly how to interpret this, or don't interpret it. Yes, we had to include it as part of our release, but don't read into it.
Well, you want to
We'll see what happens.
upset the analyst community. Tell them they can't plug in a margin estimate for the next quarter.
One thing that's interesting.
What are we supposed to do?
It's crazy.
What do we get paid
The
for?
model can't have a
We
blank
have
cell.
Excel. We need to do it. Just looking at some of the action in Expedia. So Expedia was one of the worst performers in the S&P today. I think the fourth worst. It was off 6-7%. It's up after these earnings coming out from Booking, which is kind of interesting. It's up some 2% after hours. So I don't know, maybe people did think that Booking was going to be worse and giving a little bit because the floor was coming out of Expedia earlier today. Looking at Booking right there, a little green arrow. HSBC downgraded shares of Nike from buy to hold in part due to the potential impact of the coronavirus. Analysts wrote that a significant portion of sales and profits come from mainland China and Asia, and there is a risk that part of the supply chain could be disrupted due to the challenges in mainland China right now. What's new in this note? Because we kind of knew that, right?
Well, can we first note that this note is a rare bird of notes. Downgrading the stock from buy to hold, increasing the price target from 95 to 1.
Very rare move.
That is real sorcery, folks.
Melt up.
Yep.
It's also part of a larger note on the whole athleisure area. But Nike's one thing in here. Best in class, starting to be priced accordingly. But it's not just a valuation call.
Yeah, I mean, per the guidance, look, they walked through Nike's latest quarter and how strong it was globally and in China. So they had international business up to 18%. Global digital business up almost 40%. China business up 23%. The company is certainly not going to meet those numbers in the next quarter. And I think Nike is a real, and we have this with Apple already, but Nike is going to be the real question, Brian, of whether this is this delayed demand or are they going to lose something with their China business, which has really been magic for them in the last couple of years.
And all the things about those lofty targets are definitely tied to China. And I do want to note that this is not a coronavirus-related point. We have heard this before about their margins, right? They were basically saying that in theory, Nike could pass the 11 to 14% operating margin that it's had for basically 20 years, but they don't expect that to be the case. They say there has to be some sort of, maybe they're at the plateau and that it can only go south from here with so much competition, especially digitally in the space. Now, I think that within the context of, at least in the short term, the impact of the coronavirus, it's going to be really hard to see how China, being such a large part of their business, will be able to kind of get through that and still hit those margin targets that they've been basically guiding the community on. So that's definitely something worth watching. I've been thinking a lot about just the impact of the coronavirus, obviously on the supply side of things.
Yes.
I think when we talk about bookings, for example, right, that's all about the demand for those products. But I don't think we talk enough about the companies that have the supply chains in China and what that'll do to specifically inventory, because inventory is a big deal, especially with retail companies, not just Nike, Abercrombie & Fitch, and all those other types of companies. And I think when we look at their earnings calls in this quarter, it'll be really interesting to see specifically how the build-up, or maybe contraction of inventory, if you're not actually producing anything because the factories aren't on in China, how that's going to impact their earnings.
Chung shoes. Your supply chain.
Yahoo, if you will.
I like how they called them the LVMH of the athletic area. I thought that was interesting. And I also, we're going to have to discuss this another time, but they like Anta and Li-Ning. They prefer those to Nike,
It's a domestic. They just say
Adidas, and
domestic
Puma.
players.
I just went and bought a pair of Li-Ning shoes.
Big Klay Thompson energy there with those guys. Yeah, Chung's got the Nikes.
I've got the Nikes on, yeah.
Repping the Blazers.
That was in time with this.
Repping the Blazers today. Do you have this week's Yahoo U figured out?
I don't yet, if you have any ideas.
Well, because you could do, because when you, if we say Nike's main product is like shoes and clothes, all this stuff is ordered like a season in advance. So the question is,
and GDP numbers coming out tomorrow.
Well,
so we could,
I think the question is think about yourself as a retailer, as the Chung Shoes retailer. Are you going to be able to get all your stuff that you were hoping for the spring season that you ordered when your rep came by in December? Because you wanted to you get the biggest discount on a 90-day order versus 60 and a 30. So you ordered a bunch of stuff back in December. Is that still coming in April?
It's true. If I do it, will you play it on the final round?
Of course.
Okay.
Yeah.
Sure.
Only if you'll do it here first.
No. He has to do it.
I got to talk to some producers first.
Too much work for us. All right, coming up, we'll discuss how much the coronavirus could affect the Fed's rate cut calculus. We'll discuss with Newton Investments Global Equity PM Paul Markham. But first, take a look at the most active stocks in the market on this Wednesday.
You bet. Let's go to Seana Smith for a Microsoft Outlook update. Seana.
Hey there, Jen. So Microsoft coming out, shares are under pressure here after hours after the company revised its fiscal Q3 guidance, issuing an update here as a result of the coronavirus. Now, Microsoft saying that although we see strong Windows demand in line with our expectations, the supply chain is returning to normal operations at a slower pace than anticipated at the time of our Q2 earnings call. Their Q2 earnings call was back on January 29th. Now, Microsoft went on to say that as a result, for the third quarter of fiscal year 2020, we do not expect to meet our more personal computing segment guidance on Windows OEM and also Surface. They will be more negatively impacted than previously anticipated. And Microsoft also went on to say that all other components of our Q3 guidance remain unchanged. So again, it's that Microsoft saying that its Windows OEM and Surface have been more negatively impacted than what they previously expected, and that's why they're lowering their guidance for their fiscal third quarter.
Seana Smith with the very latest on Microsoft's Outlook.
All right, coronavirus fears driving market volatility this week. Our next guest believes this will create an earnings headwind for the market over the balance of 2020. Joining us now is Paul Markham, Global Equity Portfolio Manager at Newton Investment Management. So, Paul, we saw the market at the end of last year really enthusiastically price in what they viewed as a 2016 situation. You have a global upturn, everything would be fine, and that valuation stretch would get made up. You wouldn't have to worry about that. Everything kind of changed. How do you think the rest of 2020 plays out? We continue to see companies come out and really cut their targets. And I think there's, to use an analyst term, a complete lack of visibility on what the rest of this year looks like.
Yeah, I mean, if you think about the action last year on the S&P, it appreciated 29% in local currency terms versus an earnings gain of nothing. And I think that if you think that the market was thinking that this year was going to really repay that faith in the market, the first quarter is going to be a non-event. I mean, there's going to be nothing. So the market's going to have to make 4 quarters of earnings up in 3 quarters. And I think that's going to be a really tough ask. And I think that although 2018 was, to some extent, the other way around, we had earnings kind of leading the market, the net result is still that the market has re-rated over the last 2 years. And I think that it's going to be hard for it to justify that over the course of this year, should this current situation continue.
So Apple, Microsoft, we just had bookings come out with their earnings telling us really they can't forecast what's happening. If we get more and more of these, what does it do for the Fed's thinking?
Well, I think if you'd asked me that at the beginning of the year, I would have said that they would have stood pat for the rest of the year and that we'd have had a kind of flat Fed, particularly in an election year. I think, the job market looked reasonably tight, so I thought that was okay. As it is now, I think the probability is that we get a cut in nearer term rather than the mid-term. 2 cuts may be asking a bit too much because I think the Fed is very worried and concerned about entering into a sort of BOJ or ECB situation whereby you end up in a zero interest rate trap. But I think there will be a cut.
So when we look at the global picture, it seems like the interest rate story has been a big reason why there's been so much inflow and interest in U.S. assets. From an equity standpoint, is that still the thesis right now, or do you think that there is money going around in emerging markets or, say, other pockets of the world, or is coronavirus basically having everyone either bunkering down in cash or gold or something else?
Well, a normal scenario would be that emerging markets should benefit from the narrowing of the interest rate differential between the US and the rest of the world, and that should be positive for emerging markets and commodities. But I think given the fact that the center of the coronavirus is so much in that part of the world and the supply chain stuff as well with China, that may well lead to something quite different. And, previous Fed rate cuts have led to, some pretty good equity market rallies, particularly in those areas such as technology, which have tended to lead in those scenarios. But this time around, you may find that we're reaching the end of the monetary road. And the fiscal side obviously has started to get quite heavily stimulated here in the US, and that will happen elsewhere as well, I think.
And, all this coronavirus has really put aside a story that I guess was news, but now we forgot about it, which is Brexit, and where all that stands, and where I think business in Europe stands, because a big theme that a lot of investors liked was moving outside of the U.S. There's been such outperformance from U.S. assets. Does either Brexit or coronavirus or the Fed, does all that change that thinking? Because that was another one of these real consensus views end of 2019 is that international is we're gonna see a catch up. Does this put a wrench in that idea?
There's 2 big parts to that. One of them is that the markets outside the U.S. are much more value oriented. If you look at the sector breakdown of the international indexes, for example, they have a much smaller weighting in technology, much larger weightings in energy, mining, financials, those kind of value areas. And so they've tended to benefit when the market rotates, as it did from September to December 2019. In the market which is benefiting more from interest rate cuts and the steady growth stocks coming through, international doesn't do as well, unfortunately, and the valuation multiples don't seem to matter. I mean, there's a 4 PE turn difference between US and ex-US assets. So I think that's the one part of the question. On the Brexit side, I think the mood music this year will be very volatile. We're going to have a lot of news flow come from the trade negotiations. A big difference, I think, to the first stage of Brexit is that this time it's about the money. And I think that the French are going to want a different relationship with the UK to the Germans, a different one to the Italians, a different one to the Spanish. And that means that the EU keeping its unity and keeping its consistency of message is going to be much more difficult than it was in phase 1. Maybe I'm saying that as a Brit, but my suspicion is the UK may find this round a little bit more fruitful than it did round 1.
Well, and does any of that have to do with the state of some of those economies? I mean, is Germany going to be in a weaker position now than they thought they would be? If everyone in Europe thought they had that turnaround middle of last year, but now things are off the table, does that in a roundabout way, strengthen the UK's hand?
In some ways, I think the German situation is interesting right now because they're so heavily levered in terms of their industrial sector to China. That's clearly going to be a problem. Historically, the German economy hasn't benefited that much from fiscal stimulus, but they're going to have to do some. And it's going to have to be in that big sort of infrastructure style stuff rather than tax cuts, which traditionally doesn't work in Germany. In terms of the way that leads to the politics, I don't think it makes such a difference. I think it's really more about the fact that they want to sell certain things into the UK, but the pressure, for example, their auto industry may be suffering a little bit, maybe something which they feel during the negotiation period.
All right, Paul Markham with Newton Investment Management. Thanks so much for stopping by. Talk to you soon.
Hotel company Marriott International has out with earnings earlier. We are having a lot of earnings coming out. We're going to get to some of those later, but right now we are going to just check on the markets real quick. It's a mixed market here. We're going to be back in 2 minutes. And now here's Myles with a look ahead at what will be making headlines on Thursday.
All right, well, the rough week for markets didn't really get a whole lot better on Wednesday. The market right now down about 8% from its record high that we hit exactly 1 week ago, and investors are naturally asking when the cavalry will arrive. And the cavalry, of course, are the Federal Reserve. But many on Wall Street aren't convinced the Fed sees this as a situation worth reacting to, at least not yet. Jay Bryson over at Wells Fargo said this week that the Fed's next meeting, just 3 weeks away, is not going to have the kind of economic data flow that justifies a strong case for a rate cut. We also heard from Fed Vice Chair Rich Clarida this week, who said the Fed is ready to respond accordingly to changes in the outlook. But Ian Shepherdson over at Pantheon Macro said these comments indicate a Fed that is, quote, reasonably relaxed, especially considering the market reaction. We've got record low yields on the 10-year and the 30-year, and it might seem to some investors like that's an obvious pretense for the Fed cutting rates. But wanting the Fed to act and the Fed actually doing it, of course, are very different things. And at least right now, it seems like the market is simply wishing the Fed would notice all their pain, while the Fed is telling investors they're going to have to hang in there, at least for right now. And now turning to the calendar for Thursday on the economic data side, things will be a little bit busier. We'll get the second look at fourth quarter GDP, as well as the latest weekly report on initial jobless claims, durable goods orders, pending home sales, and the Kansas City Fed's latest manufacturing survey. On the earnings side, we got results out of Beyond Meat, Live Nation, Baidu, Discovery, and Dell among the notable companies set to report their quarterly results.
Beyond Meat. I don't know.
See how beyond it is.
See how exciting it is. And we have the
I got
president
nothing for that
speaking
one.
at 6:30 tonight.
Yeah, president speaking at 6:30 tonight. We'll see if there's any news there. Been a few rumors in the market that it could be market related, but we'll have to see.
Buy stocks. Is that going to be the announcement?
That's it.
I mean, anyone who watches this show
knows.
always knows to buy stocks. That's true.
If you are looking for love in your golden years, then look no further than ABC. The network's hit Bachelor franchise is launching a new spin-off show dedicated to those over 65. And it wants, quote, the grumpiest old men and the goldenest girls to participate. Brian Chung, we have heard that you're a fan of the original Bachelor.
I have watched before.
franchise.
I'm not one of those people that participates in like the fantasy pools and stuff, because that is a thing.
They do exist.
Which is ridiculous. I think it'd be really funny to see like a Dorothy Z or a Rose N, in a Golden Girls reference.
Well, yes, I would. It's good.
Okay, thank you.
Did you know that? Or did you look that up for the show?
I have watched episodes before. Like
You know the Golden Girls?
Yeah, I know.
I don't know the Golden Girls. I didn't know that.
You don't know the Golden Girls?
I mean, I just know Dorothy and Rose because that's my grandmother's name and my mother's name. So I was just going to say, on the names,
No way.
That's true. That's not true. That's not true. My grandmother's Dolores.
Close enough.
Dorothy, Dolores. I mean, she goes by D, so it's fine. I think what's funny is the names, though, because, right, like every Bachelor season now is just like Brittany's, Tyler's, Luke's, Caleb's, or whatever, and like.
Well, it underscores the lack of diversity for one thing.
Well, I mean, that's the show's ethos, though, right?
Right, it is. That's
the show's going for. Like every show has. Trying to think what right now Victoria's multiple Victorias.
There's always a Victoria, and like the Victoria's always the villain
Victoria
for some
F,
reason.
yeah, whatever.
What I think is, I mean, we have to
So it's
acknowledge
gonna
though, that
be
there have
like
been many
Dorothy's and
spin-offs
Bob's.
of The Bachelor. You obviously have The Bachelorette. There's The Bachelor in
course.
Paradise, which is a disaster. I think that though we have to acknowledge, we sometimes forget about it because we go, oh, the show is stupid. 6.79 million people tuned in to The Bachelor.
Stupid.
Well, people say it's stupid, right? Some people
Only stupid
people who like only
Yeah.
read nonfiction books or whatever, like, ugh,
Yeah.
I don't watch The Bachelor.
Yeah.
It's stupid programming.
let me-
6.79 million people tune in.
I agree. Look, you're going to learn more about the world watching The Bachelor than reading a nonfiction pop science book.
And do you know who tunes into TV?
It's true.
Old people. And so this is perfect.
No, but this is the only thing that young people will watch.
Well, maybe like the demo's changing, and so they're going to go old. I think it's nice. I don't
There is an
want to
aging
make.
population from the
I don't want.
demographic
Yeah,
standpoint.
aging population. I don't think we should make fun of it because
No, I think it's great.
everybody's going to be old if you're lucky, and if you end up being a grumpy old man, you're going to want one of the
I hope
goldenest girls.
this show's around in 35 years. Sign me up then. All right, coming up, we'll have more in the final round. Plus, newscaster turned meditation devotee Dan Harris is here, where he sees the 10% happier movement going after this. And we're right back after a short break. welcome back to the final round here on Yahoo Finance. Myles Udland with you in New York. I am joined, as always, by my co-host Jen Rogers. Also stopping by today, Yahoo Finance Fed correspondent Brian Chung. Let's take a look where the market finished on this Wednesday. When you look at the averages right now, it seems like a mixed market. Not a whole lot happened. The problem is that we had all three majors significantly higher earlier in the session. The Dow was up over 400 points at the highs. We had the NASDAQ up some 1.2% at its highs of the session. You can see the sell-off there. Midday, a series of coronavirus-related headlines really taking the life out of this market, and a lot of choppiness there in the last couple of hours of trading. We're expecting the president to speak tonight, press conference at 6:30 p.m. Eastern time. We'll see if there's any market-moving news there. But after we had our first back-to-back 3% declines for the S&P in nearly 5 years, not a whole lot of reprieve here for investors. Of course, today marks 1 week since we saw all three majors hit record highs. So the speed of this decline, we're now about 8% below record highs. Quite remarkable, and we'll see if we can kind of repair ourselves here.
It's hard to believe that was 1 week ago. It's been
Wanna feel
wild.
old. Yeah, Wanna feel old.
I think it's good the president's speaking outside of
Were you here last
market
Wednesday?
hours.
Last Tuesday you were out. Okay, so you were here.
Yeah, I was here. I was here for the all-time highs.
Who could keep track?
I know, I barely can. After, you're looking at the market there one last time. After an on-air panic attack, ABC's Dan Harris went on a personal journey. And lucky for us, he took us all along. He chronicled it in the best-selling book, 10% Happier. And now he has a mini meditation and mindfulness empire. He's got another book. He has podcasts. He has a newsletter. He has a movement, and he joins us now. Hi. Did you realize that?
I always say to my wife, what's it like to be married to your spiritual leader? It doesn't go well, as you might imagine.
I don't think that's what she signed up for.
No.
When did you realize that you actually had a business and not just a good story of your personal journey?
You know, it took me a while. Shortly after the book came out, which was almost 6 years ago, I was approached by a couple of entrepreneurs from Boston, tech entrepreneurs, and they asked me to help them make a meditation app, which became the 10% Happier meditation app. And so I've been working on it for a long time, but I don't think I really believed, I don't think I allowed myself to believe that there was a real business here until recently. Now that we have 30 employees, it's been hard for me to ignore.
And it feels like, you know, the mindfulness movement, however you want to characterize it, has, you know, aside from your own project, organically grown in the last couple of years. Yeah. And as you hear from your users and talk to other folks, you know, you speak a lot. What seems to you to be driving that in the culture? Because there's obviously some kind of low-level, perhaps high-level anxiety that we're all feeling, and we're all trying to seek solutions.
I think you just put your finger on it. We're seeing really epidemic levels of anxiety, depression, suicide, addiction, and I think there are many drivers: political polarization, opioids, technology, social media, many drivers, and just sort of the isolation of modern life. And as a consequence, people are looking around for solutions. And one of the positive things that's happened is that meditation, while it's millennia old, now has a robust body of scientific evidence behind it, and that has allowed a whole new generation of people to adopt it.
How do you advise people to get into that mindset of being able to just take the time out to do the meditation? I think especially here in New York City specifically, there's a lot of emphasis on just grind all the time, work longer than 40 hours. So how do you advise people to not only think about considering doing this type of activity, but actually taking the time out to do so?
Are you asking for a friend?
It might be. His name's Brian.
No, I mean, this is the big problem. People really, this is what I hear all the time. I get it, Harris, you know, maybe you're right about this meditation thing, but I don't have time for this. So there are two little mantras I've developed, and in part there's this little company you might have heard of. They're called Apple, and my company, 10% Happier, this tiny little minnow, has a relationship with Apple where we every year do a challenge for 150,000 employees at Apple. It's a month-long thing where during the month of October we help their employees meditate most days. So that actually gets to one of my two little mantras. One of them is daily-ish. If you aim to do it most days instead of every day, then you're more likely, I think, for the habit to stick. And then the other thing is, the other little phrase I have, little slogan, is 1 minute counts. So the challenge we give to the folks at Apple is, can you meditate 25 out of 31 days for at least a minute? And that we find, I can't give the stats out, but we find that the buy-in is really robust.
you've been in video for a long time, so doing television. But now meditation, at least when I do it, it's just audio.
Yeah.
And you have the podcast, and that we've been covering the podcast economy. Why do you think that podcasts, they're almost like the new self-help book? Why do they work so well in this area of trying to calm yourself or be a better person? What's the fit?
Intimacy. We're right in your head. And I mean, radio has always been an intimate format. They call it theater for the mind. It does, provoke your visual cortex, even though it's not visual. But the ability we have to get right into your ear, right into your head, wherever you are. People are listening on the subway, in the car, while they're doing stuff around the house. For me, I listen to podcasts while I'm getting ready for work, et cetera, while I'm stretching after a workout. You're really getting you in your life. And I think that intimacy is what gives people like me the power to say things that have influence.
Can I explain the news business?
Say that again?
Can I ask you about the news business?
Yes, you could ask me anything.
Well, I mean, because we talk about intimacy and things that are there, and we're in the news business trying to figure out a way to reach our consumers, and they're changing their habits. When you look at the way things have changed, I guess the question to you is, have things really changed dramatically in the last 5 years, or am I just experiencing that way as someone whose personal career has changed a lot in the last 5 years in terms of what consumers want, how they get it, what stories are being covered, how they're being covered, because it feels paradigmatically new, but I'm curious if you feel the same way.
Well, I mean, I think these are trends that have been going for a long time, where you see people, wanting information whenever they want the information. I'm going to pause for a second because I'm thinking of a great moment from The Daily Show about 10 years ago, back when Jon Stewart was hosting. They sent a correspondent to the New York Times, and he held up the physical paper, and he said to the editor of the New York Times, "Did anything in here happen today?" And so the desire for information.
It's probably what's his name? John Oliver. It sounds like. Right.
It wasn't John Oliver. It was Samantha Bee's husband.
Okay.
And I'm forgetting his name.
Jason Jones.
Yes, he's amazing. I love you, Jason, if you're watching. My point being, I think these trends have been going for a while, and people really want information right now. And so that's a massive opportunity for people in the news business, but it's also really a big challenge because, for example, if you're a traditional broadcaster the way ABC News is, how do you serve an audience that already has the headlines by the time they come to you? Yeah. And so we've done a lot of thinking about how can we provide context, how can we provide analysis, how can we give you a richer, more nuanced picture of the news than you would otherwise get.
And you also have a documentary out talking about nuanced and richer on the Amazon. There's so much to talk with you about. Dan Harris is ABC News anchor, author of 10% Happier. Thank you for coming in. And Brian Chung, you can ask all your personal questions now.
Outside.
We're going to release you together.
We're going to talk.
There you go. All right, coming up. Yeah, thanks, Dan. Virgin Galactic CEO George Whitesides is joining us to talk about what's next for its space orbiting business and why its stock has been red hot the last couple of weeks. We're back with that right after this.
Virgin Galactic missed analyst expectations on revenue in the fourth quarter, and shares are plummeting today. The stock, you can see there, sitting below $30. Virgin Galactic CEO George Whitesides joined Yahoo Finance from the New York Stock Exchange earlier today.
Well, we are working hard to make that happen. You know, as you said, we were really pleased to announce yesterday that we have achieved 20 of our 29 FAA verification and validation milestones. As you know, Adam, we already have our commercial launch license, so we were the first company with a real vehicle to get that license. That's the license that we will be using to provide trips up. We've already been flying powered flights to space under that license, and so that was a big milestone for the company. But obviously, we announced some other key milestones yesterday, which you may want to talk about.
Yeah, well, a small step. Let's talk about that, because you have almost 8,000 people who want to take these trips into space once you start doing this. And you started today the small step program. I think if I were one of the people who had $1,000, I could pay that. It's refundable. And then when new seats open up, I go to the front of the line for those new seats. Can you tell me more about this?
Sure, yeah. So, I mean, I think you just mentioned the two big pieces of commercial news that we released yesterday. Number one is that we have about 8,000 folks who have signed up with the intention, they've said that they would like to get a ticket at some point. So that's really exciting. It's particularly exciting because when we last announced the number, it was around 3,500 at the end of September. And so the demand has really seemed to go up a lot in that time. The other thing that we announced was the small step program, one small step for you Apollo aficionados, which is a chance for people to put down $1,000 and essentially distinguish themselves as somebody who really does want to go into space in the near term. So this is a way for us to start to narrow down our sales funnel. You know, we have about 2 million prospects, people who have about $10 million or more around the world. We've got these 8,000 folks who've said that they want to fly to space. And then down at the bottom of the funnel, we have about 600 people who have already put down substantial deposits and who have said that they want to fly, basically who've bought tickets. So what we've done is we've established one tranche down, and those are the people, these one small step people, they're going to sign up, and then they'll be first in line to be able to buy a ticket when we open up sales at some point later on this year. So they haven't actually bought a registration, but what they've done is they've put down a marker that they are really interested in going to space.
And you bring up the $10 million, the total addressable market that might be out there, but it's even bigger. What 1.5 trillion is what space will be in just 20 years from today. I want to throw a quote at you from the earnings report and call in which you said, "We have in front of us an initial market opportunity that we believe is strong and highly profitable." Space tourism is only a small portion of the much larger plan that your company has. And there was a figure that jumped out at me, $900 billion, the commercial aviation market. And you're already a part of this with the technology you're developing. Explain to the investors, because your stock shot up over 200% since you started trading publicly. Explain to investors why that is such a key component, that $900 billion commercial aviation market for you.
Yeah, so I mean, I think one of the really interesting things about where we find ourselves today is that we've been going the same speed in jet travel for almost 50 years, since the beginning of the jet age. You know, there was the blip of the Concorde, but other than that, we've basically been going the same speed. What we are doing is essentially the only company that's going to be taking people, admittedly up to space, but taking people inside a winged vehicle at faster than supersonic speed. So we're the only company going to be doing that with a winged vehicle. And that's a really exciting thing for us because it can translate into going from point to point on the Earth's surface. And this is something that I think everybody wants. Who wouldn't want to get to go, across the ocean or something significantly faster? So what we're working on now is to try to take some of the technologies that we've developed for our Spaceship 2 vehicle and to apply that to a future vehicle that could go from point to point. And as you say, the $900 billion TAM, that's the number, that's the amount that of the global aviation services market. We think that we can access the the premium side of that, which is depending on how you slice it, order of magnitude 300 billion. So even if we were to capture a relatively small portion of that, we're still talking about a huge TAM. So this is what's I think got people excited. It's what makes us excited. The opportunity to bring people together and to really change the way how the world connects.
Yeah, on that earnings call, you talked about transforming the global transportation market, but there's also defense contracts. I mean, Space Force. You had one of the slides, you talked about the potential to help Space Force here in the United States ramp up to what it needs to do. Do you have any negotiations you can share with us with the Pentagon about that?
Well, nothing that I can share in specifics. We do have one small contract on the defense side, and I think that, broadly speaking, there's a lot of interest right now in high speed. There's a saying now that speed is the new stealth. And there are some good technical reasons for that. But I think, a large platform with a super cruise capability is something that's going to have a lot of different applications, both in the commercial and the national security space. So, we've got some conversations going on in that area. And as those mature and broaden, we'll be able to talk more about them.
We have the video of the situation that happened just 2 weeks ago where VSS Unity transferred out to spaceport in the Mojave Desert. You've called that a crucial step to get Sir Richard into orbit. Why was that crucial, moving that plane to spaceport?
Well, in many ways, Adam, it was the final step of our relocation to New Mexico, right? So like last May, we announced we're going to take the big leap and take a big chunk of our team and move them down to New Mexico. Obviously, our main operation or our main manufacturing base is in Mojave, California. We're going to move a bunch of these people down. We're going to move down all the ground support equipment. We moved down the carrier aircraft sort of roughly over the summer. And then this was the last piece, to move the spaceship down to New Mexico. Spaceport America is an unparalleled site for commercial spaceflight. It's inside the sort of restricted airspace of the White Sands Missile Range. So it's going to give us the ability to conduct operations at a frequency that is really unparalleled, I think, in the continental United States or even the United States. And, it was a big deal for our team. These are people who have been waiting, for months for this vehicle to move down. It was a great day to have the spaceship come down. And, we're excited to move to the next step, which is going to be to restart our test flight program.
All right, coming up, we're going to have what you missed here on Yahoo Finance on this Wednesday. We're back with that right after this.
So it's impossible to calculate right now what the damage will be. I mean, obviously there is going to be some damage, even in the U.S., aside from China, obviously. But look, I think there's going to be, damage to GDP growth. Just looking at the obvious sectors like airlines and cruise ships. But you have supply chain issues that are already starting to alert business decision makers in the U.S.
Is this the time to buy right now? I think we could go down a little further. I think if you're really looking for a cheaper valuation to come in, I would wait more until, let's say, end of second quarter, third quarter, when we see better clarity and earnings estimates stabilize. I don't think it's time to jump in. And I think we could easily go down another 9%. That would take valuations down to about 17 times, which is actually much closer to our 3-year average and a more healthy valuation point than what we are now, we're still pretty rich.
This is going to allow Bob to move off from the day-to-day, which could be becoming more burdensome because of the coronavirus that continues to spread, and focus on what he does best, and that's content creation. And they're at a very interesting time with the launch of Disney Plus, the end of the most recent Star Wars trilogy, and just acquiring these Fox assets where you can restart some of those franchises and Disneyize them.
Spaceport America is an unparalleled site for commercial spaceflight. It's inside the sort of restricted airspace of the White Sands Missile Range, so it's going to give us the ability to conduct operations at a frequency that is really unparalleled, I think, in the continental United States or even the United States. It was a big deal for our team. You know, these are people who have been waiting, you know, for months for this vehicle to move down. It was a great day to have the spaceship come down, and, you know, we're excited to move to the next step, which is going to be to restart our test flight program.
Wealth inequality is a big problem for our nation. That's why people voted to reject the status quo in 2016, and it's not sustainable. The current progress of going to a few rich people and lots of poor people doesn't work for anyone.
Some of our companies under our coverage are very financially sound. So if you look at a Booking or a Marriott or Hilton, they have very high margins. And we think they'll be able to weather that storm.
What I've been telling my patients, but also my friends and family, is that right now we're in the middle of a really bad flu season. And the same things that are going to protect you from COVID-19 are also going to protect you from getting the flu, which is, you know, really good hand hygiene, staying home from work or school if you're sick. Those basic efforts can do a lot to prevent the spread of this virus.
A final look at where the markets finished. It does not tell the full story of those numbers. The bulls gave it their best shot. It was not to be. Dow falling 100 points. NASDAQ holding on to gains. Fifth down day for the S&P 500. All-time record low for the 10-year yield. Disney, the worst performing stock, following news that CEO Bob Iger is turning over the CEO reins. And tomorrow, it's anyone's guess.
I mean, Trump speaking, 6:30. Microsoft cuts guidance. Booking cuts guidance. Whole mess out there, folks.
Wow. That's going to do it for us in New York. I'm Jen Rogers with Myles, Udland, and this is the final round on Yahoo Finance.